Hey everyone, and welcome to today's Fair Launch Summit. This is a free online summit put together by Alchemist, Sushi, and Yearn. I'm Daniel Worsley, and I'm on the operations team here at Alchemist. During this summit today, we're going to bring together a group of intelligent people from a range of relevant disciplines and projects who have all been involved to or have expertise that are tangentially related to fair launches. Hey everyone. And welcome to today's Fair Launch Summit. Over here. This is a free online summit put together by... Sorry about that. Okay. Today we're going to aim to surface some of the issues that fair launch and no companies projects face when scaling. And we want to empower projects to learn from each other in order to build a fairer future for projects launching into the crypto space. If you're watching through YouTube today, you can interact directly with other viewers as well as ask the panelists and presenters questions. If time permits, they'll attempt to answer these at the end of their presentations. If you're watching through an embedded stream of this video, potentially through the fairlaunch.wtf link, then you may have to visit youtube.com if you want to into the comment stream and ask questions. The panels will be split into 8 parts today over 6 hours with over 35 panelists and presenters from some of the world's most known, the most well-known projects within crypto. It is important to note that none of the information provided here today by panelists or presenters should be taken as investment or legal advice. Okay, here we have our agenda for the day. So we're going to start off with an introduction to fair launches with WTF is a fair launch and liquidity bootstrapping pools, smart pools for fair launches. Then we're going to follow by a panel, VCs, how funds look at fair launches, followed by a presentation on Treasury management. Then we have some more panels on is fair launch a misnomer, lessons learned in fair launches, regulatory risk and compliance, scaling, team coordination, incentivization and onboarding, and finally a panel on governance, the road from inception to community-led decision-making. Okay, that's it for the day. So without further ado, we will jump right into our first speaker. Okay, let me just, are you there, Ree? You're muted, Ree, by the way. Right into our first speaker.
Hey, everybody. Give me just 1 second to share my screen. Hey, Daniel, could you enable screen sharing?
Are you there, Ree?
Yes.
You're muted, Ree, by the way. Okay, I've just enabled it now. I think that should work for you.
Okay, give me 1 second. All right, can you see my screen now?
Yep, we should all be able to see your screen now. Thanks, Ray.
Great. Thank you. So thanks for the introduction, Daniel. My name is Ree, and I am a member of the Alchemist community. And I'm here to answer an important question. So what the fuck is a fair launch? This is something we'll be discussing and refining throughout the day. but I am presenting an initial kind of version of this, and hopefully by the end of the day, we'll expand on it and learn more about what exactly a fair launch is. So the lens I'll be looking at a fair launch through are, well, three lenses. Fair launch as a value distribution philosophy, community engineering primitive, and the fair launch as a meme engine. And we'll go into more depth on each. So a value distribution philosophy. To answer that question, we first need to understand what even a launch is. So in the context of an idea, a launch is basically the point in time when that idea acquires a community. There's very many common, well-known examples of launches: a startup being launched, a platform being released, in crypto, a protocol being released or forked, or even traditional businesses like a coffee shop being opened. So these are all examples, and to really understand what a fair launch is, I think it's important to first understand what an unfair launch is like. And for that, we're going to take a look at initial public offerings, IPOs. So as you know, in the US, when a company IPOs, it's kind of the culmination of a product maturing. And along the way, you basically start off with an idea, and then you grow, refine it, you build a community of users or customers around that idea. You get VC funding along the way in order to support your operations. And pretty much all of the parties involved in growing that idea, except for the users and the customers, get to have a share within that idea. There's equity distributed to team members, to VCs, all along the capital raises involved in kind of growing that idea. And the user base or the customers don't really get to buy into the idea until the very end, when the company is ready to go public and create a market for basically a stake in that idea. So after the IPO is the first time users can finally buy into the success that they helped create. And without those users, this final step wouldn't even have been possible. So it's pretty crazy that that's how it currently works. And not only do those users buy in at a significantly worse price than everyone else that earned stake in that idea along the way, but they're also essentially providing an exit opportunity for everyone that's bought into that idea before them. So users that helped create the success of the project don't get any stake in it all along the way, while VCs and insiders do. And then when they finally get to buy into it on the open market after multiple funding rounds that preceded them, they get dumped on by everyone that decides that they want to take some profits. So the IPO is a pretty obvious example of an unfair launch. If an unfair launch is all about if a fair launch is all about rewarding everyone involved in an idea's growth equitably. So this enables us to answer this important question: what the fuck is a fair launch? We now have this example of an unfair launch, and kind of an analysis about what makes it unfair helps us figure out what is fair. So a fair launch is when all of an idea's stakeholders can buy into the idea or earn stake within it without any group of individuals being privileged over others. So there's no pre-sale, no VC allocation, and open access for everyone. And everyone has the opportunity to benefit from an idea's potential upside. And there have been a number of examples of successful fair launches, and this list is growing, and there's many I didn't name, but Bitcoin was the OG of fair launches through its proof of work mining. Then we have a pretty successful example for Yearn, and they had liquidity mining as a way to distribute value amongst the idea stakeholders. Then we have Sushi with a fork and liquidity mining. We have the Alchemist community with a balancer liquidity bootstrapping pool. And I'm also including a kind of stranger example here, a t-shirt being fair launched. So this is not just limited to businesses or communities. You can also have fair launches for ideas that are more physical in nature. And next up, we'll take a look at the fair launch as a community engineering primitive. So fair launches are a great way to get a community invested and excited about an idea, because they really blur the lines between an idea's founders and the community that then gets invested into the idea's success. They give both parties equal ability to put skin in the game. And so they incentivize the community to learn more about the idea, support it, and grow it. And it places the burden of action upon the whole invested community and not just the original founder or team of founders. So it's a way to distribute the responsibility for managing that idea and growing it. And it's a great alignment mechanism, early alignment mechanism. And so the fair launch is also a meme engine. You basically spawn new communities that have their own set of memes and kind of ideas. And by doing so, with each new success, it further reinforces the fair launch meme. It reinforces the fact that an alternative model for bootstrapping ideas is possible and growing communities around those ideas. Once individuals experience a fair launch, it becomes very difficult to imagine any other way of bootstrapping ideas and communities, because who doesn't want to become part of an idea they care about with equal opportunity to both impact its trajectory and profit from that idea's potential upside? So really, just based on these new projects that have started popping up in crypto, and it could spread elsewhere, we're seeing that the traditional structures are not necessary for something to grow and to build stakeholders, build community, build governance. All of these things are possible in a very radical new way. So yeah, basically this is the future of France, and welcome on board. I hope you enjoyed the panels and the presentations today, and we all learn from each other, and we learn about the nuances involved in fair launches, can keep iterating on this mega meme and further grow, refine it, and give new projects, new ideas, new communities an opportunity to learn from these lessons and further expand the space of what's possible. Thank you very much for joining the Fair Launch Summit, guys.
Thanks a lot, Ray, for the interesting presentation about the issues with unfair launches and how we can progress to a stage of more fair launches. So next up, we have Jeremy from Balancer to do a presentation on smart pools for fair launches. Hey, Jeremy.
Hi.
Hi, thanks for taking the time, Jeremy, and I'll let you take it from here.
All right. Yeah, just give me a couple minutes because I just got let into the stream.
No problem.
All right. Is everyone seeing my screen?
Yeah, we can see your screen now.
Okay, great. So yeah, I'm Jeremy from Balancer. Thank you. It's great to be with you all here. Thank you for inviting me to share a bit about LBPs, liquidity bootstrapping pools. Disclaimer: this presentation is a bit outdated, but I will skip past any pages that aren't relevant and make sure that you guys are getting relevant, up-to-date information as I speak. I'm going to be kind of freestyling it because it's just been a very insane time. So, but I'm glad to be here speaking with you all. Let's see what we got here. Yeah, I don't know if people still find this important, but we can quickly just glance over why teams are choosing IDOs rather than IEOs. IDOs being an initial decentralized sale of a token, and an IEO being one that is done on a centralized exchange. There are definitely a lot of reasons, such as aligning with, if you're a DeFi project, if you're a crypto project, and you want to follow a path that is aligned with your mission, your beliefs, your philosophies. If you believe in open permissionless systems, if you believe that you want your token to be accessible to anyone in the world who is a supporter of your project and who it wants to be an investor and wants to support you. And if you want to conduct your token sale in a transparent manner and not, pay some big portion of what you raise or of your tokens offered to the platform that is hosting the sale, then an IDO is probably for you, and an IEO is probably not for you. But these are options that every team has. Yeah, this is when we get into some old shit that we can skip. Let's jump straight into Balancer LBPs, how they work, what they are, and we'll do that sort of first through the lens of the community, by looking at what members of the crypto community have had to say about LBPs, so that you're not just taking my word for it. So this is Luke from PrimeDAO, who PrimeDAO initially did their token sale using a different platform, and they sort of came to the realization that LBPs are, in their opinion now, the best platform, based on sort of what they learned, the challenges that they went through during their sale, and the features and functionality that they see on Balancer LVPs. And as a result of that, they've undertaken a really exciting project to bring a whole new user experience and interface, sort of as a launch pad for token sales using Balancer LVPs. So we're very excited to see that being built and launched hopefully very soon. Yeah, Chris Berniski, well-known investor from Placeholder, is also a big fan of LVPs because of the anti-FOMO nature of the design, which we'll get into, and basically the belief that because of the way LVPs play out, as they have so many times, the community is best served, and the launch is done in a very balanced way as far as the opportunity to participate for people throughout the community. So some of the characteristics, high-level characteristics of a liquidity bootstrapping pool is the design of the pool creates a consistent downward price pressure from the start of the sale to the end of the sale. And this pressure, downward pressure, which creates an effect that's very similar to a Dutch auction, enables this downward price discovery process. And this process allows the market to decide it's sort of like, let's start at a price that everyone knows is too high, right? We're just so that like everyone can agree. It's hard for everyone to agree on what's a fair price. It's easy for everyone to agree on what is not a fair price and is way too expensive and no one should pay, right? So the sale starts at that price. And over time, and this depends on how long you choose your sale to last. Typically it's 24 to 72 hours from what most teams have done. During that time, we see this sort of continuous downward pressure as price drops until it reaches a point where the market, actors in the market decide that it's a fair price and they start buying. That creates buying pressure, which of course goes against the downward selling pressure, and creates a very smooth and natural price discovery process. This chart here in front of us is from the Perpetual Protocol LVP when they sold their token initially. And this chart represents a really healthy pattern for the market figuring out what they think this token is really worth. Not kind of exploding into some crazy FOMO driven, spike where whoever was able to buy before the spike got a good price and everyone else gets screwed. One of the reasons why this process was designed this way is because we want projects to have the opportunity to create a level playing field for everyone who wants to invest. It doesn't matter how much capital you have. It doesn't matter whether you're, the most like brilliant, sophisticated, technical person out there, or whether you're, someone who's a supporter of a project and doesn't have the skills or tools to kind of outcompete everyone else to buy a token first, or to manipulate gas prices or whatnot. So in a reverse price discovery process, you are competing with others based on your opinion and your ability to identify fair market value. and nobody is, you know, unfairly advantaged in that game. So LBPs are fully customizable pools, and they are token sales in which a project can choose any reserve token, which means that's the token that they're fundraising in. So at the end of the sale, what is the token that you will have gained? You know, you can choose that to be any ERC20 token that you see fit, and usually that ends up being you know, stable coin like USDC or ETH. And it can be both as well. You can have multiple reserve tokens for the same sale, and this is a really valuable attribute for teams that are thinking ahead to, after this sale, what is our treasury going to look like? What do we want our treasury to be made up of? And like what percentages, what do we want that allocation to look like? All of that can be decided and programmed into the LBP so that when the sale is over, that's what you end up with. So distribution of tokens is a really important topic because as I touched on earlier, if you're a team that is doing a public token sale, it's in your best interest, just so, you know, from a strictly, like, if we look at this from a selfish perspective, which there are obviously many other relevant perspectives, but just starting from like the most, you know, self-interested perspective, for your project to have the best chance to succeed in the long term and to have the supporters that are going to stick with you and to, you know, stay behind the project and contribute to it in bull and bear scenarios, whatever happens in the market, you know, if you know, get hacked or you know, something happens, some shit hits the fan, and who's going to be willing to stay dedicated to the project? It's going to be people who own the token, right? So how do you ensure that your token is widely held, it's distributed well amongst a diverse community, and you have many individuals, ideally, who feel that they have skin in the game in your project and are willing to go to bat to do everything they can to help it succeed. So that's, I think, one of the most important, if not the most important, characteristics of LVPs and why teams have been choosing them more and more often, why they've become such a popular mechanism for token sales, is that even distribution. So this we're here looking again at the perpetual protocol sale and looking at a chart of token holder distribution immediately after the sale. It's, as you can see, extremely diverse and well distributed. You have very few addresses that are holding more than 1%. 1, 2, 3, 4, 5, 6, 7. Yeah, about 8 addresses out of everybody that have more than 1%, and you know, everyone else is you know, has super small slices of the pie in a pretty even fashion. Oh, and then I'll also mention the point that LVPs are designed to require minimal upfront capital to launch a sale. And the way, we'll get into how that works actually. Just take that point and we'll get back to it. So I mentioned that LVPs are designed with like an anti-FOMO quality. And that's because you don't want to front run a sale that starts at a known, like knowingly overvalued price. If you front run it, then like that's to your own detriment. And I will mention that in many LVPs, that still happens. Maybe I think it's like a learned behavior that people have running bots in crypto, and when there's a token sale, it's like, all right, like, let me set this up so I'm the first one to buy. You just screw yourself if you do that, because teams that use LBPs are thoughtfully considering what is a price that no one should be willing to pay, and you're almost guaranteed that if you front run and buy right away when the sale starts, that you're going to get a bad price compared to most other buyers. Of course, there can be, and there have been, LBP sales where the final price, I mean, there's so much buying pressure and there's so much demand that the final price actually ends up higher than the starting price. That's usually an indication of, mispricing of the sale, or not optimally designing the token weights of the pool. We'll get into that again, but that rarely happens. And even in cases where that has happened, there's still way better prices available in the meantime before things kind of skyrocket. So yeah, front running is not a good idea. And that is why I bring this up, is because it's a problem that has plagued a lot of token sales in the past on other platforms. All right, so let's talk about how LBPs work under the hood. So to understand an LBP, first you need to understand a balancer smart pool. And a balancer smart pool is a liquidity pool that is controlled by a smart contract, and that a liquidity pool that has the power to change its parameters dynamically while it's running with live liquidity. By parameters, do we have a list of parameters here? We do. So these are the parameters that you can change in a smart pool. You can change the tokens that pool contains. Add one that wasn't there before, take one out that used to be there. You can change the weights, you can change the swap fee, you can whitelist the liquidity providers. That's important for LBPs, because in an LBP, the project team needs to be the only liquidity provider. So they're the ones, putting these tokens into the pool and making them available to investors. And you need to be able to change the weights, because that is actually the magic. That's the mechanism that creates this downward price discovery process. When an LBP first starts, or actually before it starts, you as a team set the starting weights for the pool. Weights meaning the percentage of token value, percentage of pool value to be held in each token that's in the pool. So let's say you're selling your token TKN for USDC. You have a 2-token LBP, and the weight distribution between TKN and USDC is going to start in one place. The sale is going to last a set amount of time, let's say 3 days, and then at the end, those weights are going to be different. And you're going to start with a pool that is highly concentrated, highly weighted towards your project token. That can be 80%, 90%, 95%, anywhere up to 98% is the max. So let's say you start with 95% in TKN and 5% in USDC. That is the mechanism that allows your upfront cost to be very low, because you only have to provide upfront 5% of the total pool's starting value in USDC. Vast difference compared to a pool that is 50-50, for example, where you actually have to come up with 50% of the value upfront in stablecoin, which is a huge barrier for startup teams, of course. So you started, let's say you're starting 95.5 and you're setting a 3-day sale period and your end weights are 30.70. So at the end of the sale, the pool will contain 30% of its value in TKN and 70% in USDC, effectively meaning that you have sold most of the TKN and you have raised a bunch of money in USDC. When the weights shift on a periodic basis, there's a poke weights function that basically tells the pool to rebalance and to reset its weights. When the weights are reset, the pool is immediately out of balance. When the pool is out of balance, it readjusts its prices to favor the token that it needs to have more of, and to disfavor the token that it now has too much of. That's going to be your project token versus the reserve asset, meaning that the price of your token drops. So every time the poke weights function is called, the price of your token drops, downward price discovery occurs, and that is a mechanism for downward price pressure. Let's look at how some LBPs have gone in the past. Again, this is like not the newest presentation, so these are not the newest results, but that's fine. HydraDX, they did a 3-day sale. They sold 430.5 million tokens to 5,200 separate addresses. And the sale reached a total volume of 48.5 million, and the team raised 22.7 million. So definitely a successful sale. Radical, they did a 2-day sale. They sold 1.7 million tokens to about 2,000 addresses. Volume hit over 60 million, and they raised about 21 million. Razor, also a 2-day sale, sold 14 million tokens to 1,650 addresses. Volume was at 20.7 million, 20.8, and they raised 10.5 million. Okay, and then of course Perp did a good one as well, and bottom line they raised 15.3 million, and that is that. You guys can let me know if you want to do some Q&A or what comes next.
I'm just having a look at the questions that have come through now. Someone asked, can you explain the relationship between bots and balancer pools, and if it protects against bots at all?
Yeah, so the way that it protects against bots is by negating the advantages that a bot would have on top, like over a human. So as I mentioned, there have been many token sales in the past where bots get in and like they can place, obviously they can act a lot faster than a human participant who's just on their computer, right? And they can put in an order to buy the token, the instant that the sale goes live, even before the team announces it, because they can detect that the pool has been deployed, and they can jump in there. If they do that, they're just wrecking themselves. You get wrecked if you do that. So this is a game of like waiting and seeing when price reaches a level that you think is worth it. And bots are not necessarily better than people at doing that. So that's how LBPs protect against bots. And I wanted to mention something within that. What was I going to say? yeah, I don't know. If it comes back, then I'll let you know.
We had one more question, and that was, why not launch at a price of like 0 BTC or 0 ETH in this case?
Because then everyone can buy your token for free. And then you'll raise no money. So you want to, the way this mechanism is designed is if no one buys the token as the price continues to drop, it will reach 0. But you are confident in the fact that your token is worth something, your project is worth something. There's demand from investors. You've done a good job of like explaining your project to the community, letting them know that you're selling a token, you've done the marketing, you've done all that stuff. And you have people who are waiting to buy your token, and they're not going to let it go down to 0, because anytime someone buys the token, they are creating upward price pressure. So the only way that your token goes to 0 is if nobody wants to buy it. Nobody knows that you're selling it, nobody cares about the token, or nobody thinks that it's worth anything.
Awesome. I think we have one more question here, and that is, what strategies does a protocol need to think about in order to have a successful LBP?
Yeah, so you want to, we have great tools and documentation on LBPs. We have simulators that you can use to plug in different numbers and map out different scenarios, and to look at, what would it cost us? How much would we raise? How many tokens would we sell? Kind of all those questions, which are very subjective and personal to each team based on your goals and your objectives, and also what you believe is achievable for your project based on the community that you have, and all the factors, and how much demand you think there is for your sale, etc. So number one is the mechanics, the math, the parameters that you want to think through and set up leading up to the sale. Then there's also the other side of things, which is the communications, the marketing, the awareness, right? And all the work that went into your project before you got to this point where you're ready to sell a token, right? Because ideally, you've been working on this project for a while, you've been building a community for a while, you have people perhaps using your product already, people who believe that it's amazing, and believe that it's going to grow, and believe that you have a model that's going to be successful, and that they want to own a piece of it, and that they want to support your project. So all of the groundwork for a successful sale happens well before the sale, and that's obviously has nothing to do with Balancer. It has everything to do with you, the founder, the developer, the builder of this project, who has that very tough duty of building a community, building support, building demand, building a product that solves a problem, and that works well and is secure, and all of those things. And when you do those things and you communicate well, you communicate not only your offering well, but you also communicate your token sale well. You make sure that people understand when it's happening and how it's going to work, and how they can participate, and all that stuff, so that when the time comes, all of those factors can combine together and create a successful sale.
Awesome. Thanks a lot for the time and taking the time to answer all of the community's questions.
No problem. Thank you.
It's time to move on to the next panel now. So we have the next panel is VCs, how funds look at fair launches. And joining this panel, we have Weaver from Yearn, Spencer from Variant, we have Tom from Dragonfly Capital, Mathis from Maven 11, and Michael from Framework Ventures. So they'll be joining in just a second. And joining this panel, we have Weaver from Yearn, Spencer from Variant, we have Tom from Dragonfly Capital, Mathis from Maven 11, and Michael from Framework Ventures. So they'll be joining in just a second. Can you guys all hear me?
Yeah, loud and clear.
Awesome. I'll bow out now and let you guys take it away. Thanks.
All right. Hey, everybody. I'm told that YouTube doesn't love anons, or at least doesn't love when you have your camera off. So camera's on with a piece of paper clipped in front of it for those of you that maybe can't see my pretty little birdie picture. But so yeah, so I'm Weaver. I work on growth at Yearn and have the pleasure of moderating our panel today. Real quick background on me, and then I'll pass it around to the panelists to give a little intro on themselves. But just joined the team at Yearn just a few months ago. I've been following along a bit longer than that. And the fair launch is definitely a part of what attracted me to work on Yearn. So I was excited to be a part of this conversation today. I've been in crypto for a while, but earlier in my career also worked at several venture-backed startups. So know a thing or two about the space, and I'm really excited to see not just this conversation today, but see funds playing in this space and supporting fair launch projects. So yeah, excited to get into this with you guys. Spencer, could we start with you for panelist intros?
Yeah. How's it going, everyone? I'm Spencer Noon. I'm general partner and co-founder at Variant. We're an early stage first check crypto VC. And so, yeah, we invest across this thesis called the ownership economy, which is this idea that the next generation of technology and internet platforms will be built, owned, and operated by their very users. So yeah, excited to dive in on this topic today.
Awesome. And Matthias, am I pronouncing that right? Could you pronounce your name for us and do an intro?
Yeah, it's Matthijs in Dutch, but Matt is fine as well. Pronouncing my name in English seems impossible.
Right on.
Yeah, so I work as an investor at Maven 11 Capital. We're a crypto venture fund based out of Amsterdam. I think the only European VC here. I do most of the venture investments at our fund, and I would say we are mainly focused on DeFi because we think that intangible assets are more likely to take off on a blockchain for now.
All right, awesome. And yeah, we'll go with Matt. Appreciate that. Michael, over to you.
Hey, I'm Michael, one of the two co-founders and general partners at Framework Ventures. We're a venture fund that has primarily focused on DeFi since founding in 2019. We have since kind of moved into more Web3, so NFTs and gaming and social tokens as well. But really excited to be here and talk about fair launches.
All right. Well, thank you all for being here, and thanks everybody in the audience for all of the questions submitted. I'm pretty sure we have more than we'll be able to get to just from those pre-submitted, which is awesome. But definitely keep them coming in the chat as well. And Daniel will help us sort of weave in the best content that we can into this. So let's jump in. I think folks that have been watching the first chunk of the summit today have heard a bit about fair launches versus unfair launches, and we heard about LBPs from Jeremy at Balancer. But first one, let's just start with the basics. And Michael, I'll throw this one to you, in part because I know that you and Vance at Framework know a thing or two about working with fair launch projects like Yearn. But just in general for folks to think about this, I mean, if fair launches by definition, exclude early or otherwise preferred access for larger investors, how does that fit in with the VC model where traditionally, not just in crypto, where traditionally VCs trade that risk taking for being able to get in early with their money and having some preference there? How do fair launches jive with that model?
Yeah, great question. So I think the best way to think about it maybe is to say the traditional venture model, you had these private rounds where, they would call them seed, Series A, Series B rounds of private investment. Now with tokens and with DeFi and kind of the broader decentralized finance ecosystem, you basically have two kind of modes of investing, and maybe three if you want to call this a venture round. But the first one is the private rounds, and those will be capital that goes into a project, usually in purchasing either tokens or equity in a company that's building something, and the company that is behind it could be a company or it could be just a DAO. The second mode of kind of acquiring capital is purchasing from the Treasury or purchasing it on the open market once the token is actually out there and tradable. And the third would be staking or kind of acquiring through participation. I think new venture funds in the space, and one of the big differences between venture funds like the three we're talking about today versus others who are in the traditional model, is that we're kind of form fit to be able to traverse across all three of these different modes of investment, whereas traditional funds are not. They really can only invest at the earliest stages and buy equity in private companies. So for us, we think about this in terms of fair launches as being just something that leaves out the private rounds, because maybe you don't need the R&D investment, maybe you don't need the capital going in for the year or two of time that it takes to build the technology or build the team or whatever it is that you're doing behind the scenes. And you can just go straight into a token that's tradable that could be staked, a token that's tradable that could be purchased, or even Treasury purchases themselves. So we've invested across the spectrum, where we've just done Treasury purchases, where we've just staked, or we've done some combination of the both. But that's kind of how I would break it down between traditional and kind of DeFi investing.
That's fantastic. Thank you. Spencer or Matt, anything you guys want to jump in with on that sort of intro question?
Yeah, I do think it's, as Michael says, right? It's the traditional venture funds fund for the R&D, etc., and the product development that's needed the first few years. But I think this also does somewhat apply to crypto, right? If you have a project that says like we need to work 3 years before we have any product live, they can still use venture capital money to do so. To just, yeah, they need to live, they need to eat, they need capital for doing so. So you can't just spin up a balance liquidity pool and throw a token out there and then say, okay, we're out for the next 3 years. I think we all saw how that ended in 2017.
Yeah, right on. So Spencer, maybe I'll throw to you for a question that builds on this one. And as Michael mentioned, I think we have something unique in this panel where you guys all represent firms that are actively playing in this space versus others maybe that the only model that works for them is one where they can get in early and get out early and maybe dump on some folks in the process, but we won't go there. But I do wonder for fair launch projects or other things in this area and in DeFi in general, where you've put in capital, like could you maybe give an example or two of a project that did make sense for you to get into in this space, what that looked like, why it made sense? You're muted.
Yeah, sorry about that.
Right.
Yeah, I'm happy to. And actually, if you don't mind, I'm going to take a stab at your earlier comment about like basically VCs who get into projects and then get at an early price and then dump on people afterwards.
Yeah,
and by the way,
please.
I think that like criticism is totally valid, right? If we've looked back at the last 5 or so years of crypto, you have a lot of investors who build themselves as venture capitalists who in reality they're hedge funds, right? They have no kind of semblance of an investment period or holding on to tokens for long-term investments. They've actually, frankly, like build themselves as something that they were not, so that they could further their own kind of gains. And so I look at that as like variant as being like quite frustrating, frankly, because a lot of the bad activity and behavior that happens isn't really the venture capital that we frankly play in. And so when we invest in an early stage project, whether it's by buying equity from the team that has a warrant for tokens at a future date, or buying tokens directly from a treasury or on the liquid market, we're doing so with a venture scale time horizon, and that we're holding for 5 to 10 years, perhaps even longer, right? Because we believe in the kind of underlying fundamentals of these projects. And so yeah, I mean, like can't really speak to a specific project that we've done in this space, but I will say, we're looking at many of the same things that any investor would be looking at when it comes to a crypto project. So it's the on-chain metrics, it's the fundamentals, valuation, value capture, et cetera. But yeah, I do kind of take a little bit of, I just wanted to talk about the characterization quick, because it's frustrating for me personally.
Yeah, no, I appreciate you jumping in on that. I mean, I think, from where I sit in this space, it's easier maybe than it is for a lot of folks to see the very different kinds of outfits that are out there playing in this space. And yeah, I mean, maybe to go a little deeper on that for folks. I mean, one of the things I found very interesting in getting into Yearn is that, I mean, there's framework, there's Parify, there's Polychain. Like, there are a bunch of big and active VCs that hold Wi-Fi, right? And none of them got it early. None of them followed that traditional path, and so you get the good pieces of working with firms like this without the dumping in the way that it is characterized. So no, Spencer, I appreciate you calling that. I mean, I think there is, with fair launches in general, it feels like we're seeing this shift in the space, and we're seeing it in VC too. And I do think it's unfair for firms like the ones on this call. And I'm hand gesturing right now and realizing that nobody can see that, but maybe that's better. But yeah, you guys don't need to speak for firms that maybe act in different ways than you. So I appreciate you calling out the distinction then.
One quick thing that I'd add there is that it's totally okay, as you're going through the process of fundraising, to ask the potential investors that you're talking to what their fund structure is. If they tell you that they have an open-ended structure, that it's just kind of a pool of capital, that's a big red flag. I can't speak to anybody else in the call, but I'm pretty sure I'm aligned here in that when you're talking to a venture fund, it's usually a 10-year vehicle with a 2 to 3 year investment period, which means that you're investing for 2 to 3 years and then holding for 7 to 8. And so that should indicate, who is aligned for the long term, and definitely a question that you should be asking.
Yeah.
Yeah, I might be able to jump in here, because we currently have 2 funds, and fund 1 used to be open-ended and a hedge fund like a structure, as Spencer alluded to. And when we started in 2015, that was sort of more the natural fit for our investors. But as we started moving more towards venture investing, we had to create all sort of legal stuff in order to be able to maintain our positions for a long time, even though investors might want to redeem. So we sort of shifted into that locked venture fund model. And our second fund, we did exactly as Michael just described, with a long investment period, then a long holding period, because it does feel way more natural if you invest with a long time horizon.
Yeah, and maybe one final thing I would add to just help people understand why we're long-term focused. I think, we all kind of have this intuition that playing a highly volatile field like crypto on just a short-term, speculative basis is just not optimal, right? If you're really trying to create a lot of value long term. But there's another piece to this too, which is the competitive landscape among all of the funds that we have in this space, right? So we have, over the last year, a lot of venture capital LP money has flown in. It's all going towards projects. Well, put yourselves in our shoes. If we invest in a project and get their tokens and immediately dump it, then the next world-class entrepreneur that comes along, they're going to hear about it and they're not going to take our money, right? So we're incentivized to be long-term aligned. And that's really where it goes back to, is kind of knowing who your VC is and doing diligence on them as well. And that is for, you know, any project, regardless of if you're doing a fair launch or not.
Cool. Thanks guys for all that. I think really helpful background for folks to hear from you guys directly, and actually bonus, you kind of answered some pieces of the audience submitted questions. So we're a very efficient panel. Thank you. So yeah, so let's get into some audience questions, and this one came in before the summit, but works really well with the agenda for this summit, because the question, and maybe we'll start, Matt, with you on this one. As a VC firm, are you interested in providing liquidity pools for fair launches with vehicles like LBPs from Balancer, which folks just heard a great overview from Jeremy on this earlier? Like, how do you guys think about liquidity pools in this area?
I don't see why not. If it's an interesting enough project, we do usually want to speak to the team prior to doing so, because it does feel a bit like a venture investment. But if that's a way to get exposure, then I don't see why you wouldn't participate. And obviously you start, it takes 72 hours usually. Then you start looking for a nice price. You don't go in hour one, as I just heard. So there's still that sort of trade you're making in that 72-hour window. But then you can just, I don't see why not. You're just investing in a project.
Cool. Any of either of you other guys want to jump in on that one, or same thought?
Yeah, generally same thing. I think it's just part of the spectrum of opportunities that you can take part in. And if there isn't any private round because the team doesn't need it or doesn't want it, and LBP is the first chance, then absolutely with Matt, that's going to be a place to get in. I would add, whenever we're doing an open market transaction, we very much prefer to be buying from the treasury or from the team, because we want to make sure that the capital that we're outlaying goes back to the team and goes back to the proliferation of the network. But also agree that we want to talk with the team and work with the team. I think one of the things that is differentiating now, and maybe this gets into more questions later on, but differentiating for VCs, to Spencer's point on the level of competition, is capital is 100% commoditized. There's so much capital, it's not really fair to compare $1 versus another. And so you have to differentiate on other things. And that comes by way of either, software solutions like trading systems or liquidity providing systems, or, running nodes, or it comes from help and guidance and governance. And so I think having that initial touch point with the team is a requirement, but, an LBP or a treasury purchase is just part of the spectrum.
Yeah, cool. So Spencer, I'll throw this next one to you. I think in a couple of the areas we've gotten into so far, we've talked about working with the team and getting to know the team and things like that. And another question that came in from the audience, and I think it's fitting that the guy with no video is asking it, but how do you enter into investment or lockup agreements with anon projects, no company projects, shadowy super coders? Like, do you require a one-on-one docs before investing? How do you handle anonymous projects?
I think it's a case-by-case basis, honestly. We have to look at if we feel convicted about kind of entering into an investment, we're going to look for the most optimal way to do that. I would say we don't need to necessarily dox a team, or if it's anonymous and they have a track record of creating value, and we believe that that will continue in the future. There's no reason that we would demand anything in addition to what they're doing already. So yeah, I don't know if there's like a whole lot more that I could add on this point. I think for crypto funds, for crypto VCs, flexibility is key. And so, all of our mandates are kind of structured as such to be able to take advantage of this evolving market. So yeah.
Cool.
To the earlier point of that question, how you enter into without a contract, I think that's exactly what smart contracts are for, right? To create vesting conditions without having a legal agreement in place.
Yeah. Right on. Okay, cool. Another question from the audience, and this gets more into um, uh, really into operating strategy or operating models for fair launch projects. And I mean, quick plug for some of the later panels in the day that really get into the the struggles and opportunities of growth in this space. But question for you guys, that again came in from an audience member. But what are some of the models that you've seen or you would recommend for fair launch projects to fund their early expenses, right? Their like audits, initial team hiring, things like that. And I'll note as I ask this, right? I mean, obviously, there's different kinds of fair launches, right? There's the make it available for free to farmers. There's more of the like transparent and fair fundraising approaches, like we've been talking about. So there's a bunch of different ways to skin the cat, but in whether it's in those structures in other ways, I wanted to maybe get thoughts from you guys. Maybe Michael, I'll throw to you to start us on this one if that's cool. But yeah, your thoughts on getting some operating capital.
Yeah. So once again, I think with any of this stuff, it's so case dependent. But some of the models that we've seen that have worked, and maybe some of the ones that haven't worked and needed to be changed, I think the ones that haven't are where the token is completely distributed and the team who's the core contributors don't have any incentive model for continuing forward. That stuff just never works. Incentives are the most powerful thing in business, and we have to keep that in mind as we're building incentive models on chain. So that's number one. I think one of the interesting models that we've also seen that worked is retroactive funding, where there's an expense that's been accrued over a period of time, and the fundraising goes directly to paying off that expense that somebody accrued. And it's a milestone-based funding model where if you hit certain milestones, the expenses are paid and kind of in a retroactive manner. You can also do that looking forward, where you say, okay, here are the very prescriptive things we need to do, and we're going to be funding X amount of millions of dollars, and that's going to go into funding, each of those different milestones. And if those milestones aren't hit by a certain date, none of the rest of the funding goes forward. You can get really creative with it, but I think ultimately, kind of the broad thesis here is that incentives really, really matter, and funding operational costs early, I think, are very small in the long-term idea of making sure that everyone's aligned with a unifying coordination mechanism.
Yeah, I think those are some good points. I would add maybe another area for like raising capital and funding is projects can look into like non-dilutive models, and I think this is kind of emergent right now. Grants programs are one, right? Like you have a number of treasuries across the DeFi ecosystem and others that are looking for whether it's entrepreneurs or just builders to leverage their infrastructure. And so like, for example, if you're doing something that uses Uniswap, I would encourage you to go and talk to the Uniswap grants program. And perhaps there's a way that you can get some funding from that. Another option is to look at doing something like an NFT sale. So, one of our portfolio projects is Mirror. Mirror.xyz, like highly encourage everyone to kind of go take a look at this. I mean, there are a number of people who, so what you can do with it is you have these like fundraising modules, and maybe you want to do some type of project, you create a Mirror post on it and you let contributors pledge money towards that. They receive an NFT in return. There's no, like obligation or expectation that you will do anything for them after the fact. But sometimes people just want to be a patron, right? They just want to invest in causes and projects that they support. And so I think that's something that I would definitely look into if I was a project looking for funding.
One final one I also really like are these initial Discord offerings, which have become a bit more popular, where you really have people who were early contributors to the community and give them a chance to buy in early at an early stage and also take the upside.
Yeah, cool. So one thing I'd love to do if you guys have some things to throw in on this, I think really fair to say that, you know, that so much is unique at a project level. I mean, so much is unique about this space, right? It really does evolve faster than anything else out there. So I think something that's helpful for folks maybe to hear is projects or products where you feel like it's being done right, or where there's interesting things going on. Like Spencer, you just mentioned Mirror, I think is a really good example. I wonder if as you guys think about, you know, folks in this space, like who is doing interesting things, who is breaking new ground and helping us all learn more in the way that fair launches go. Matt, I see you nodding the most, so I'm going to start with you.
Yeah, I really like the approach by the Rari Capital team, where they did a liquidity mining distribution of tokens, while also keeping a certain amount for the team themselves. As Michael said, incentives are everything, so I think they pulled that off well. I also like the Olympus DAO and the Alchemist approach. Did a fairly good job at being a fair launch. And then, yeah, these are the three I can think of. Yearn, of course, but I think we already mentioned that one quite often. So,
yeah. No, this is not meant to be a Yearn commercial. Michael, any other projects you wanted to talk about?
I mean, obviously, shameless plug for Yearn, but I also really agree with Rari. I mean, they're rethinking a lot of, you know, how you can do fair distribution, how you can have liquidity mining. They've also gone through a couple of product pivots and have thought through kind of the new models for Treasury going forward. You know, one of the things that I think, and I'm gonna kind of change the answer here, and I think one of the things that I think becomes really important after you figure out the incentive layer is the governance layer. And one of the places where I think that is happening best right now is on synthetics. Also, you know, a portfolio company, but you know, the number of DAOs that they have governing all the different sort of layers of the different decision-making processes is really kind of humming on all cylinders right now. And seeing that happen in real time is just really kind of, it makes me really excited for the future of just distributed governance and decision making, because historically, I think if you're more distributed, it means that decisions get made fewer and fewer and with more and more time. And so having that speed of decision making, I think it's a best in class example for that aspect.
Right on. Thank you. I was trying to pull through while we're talking here and see some of the questions coming in the live stream, which is at least for my lizard brain slightly tricky when we're looking at each other on Zoom, and I've paused the live stream with my wonky Wi-Fi. But I feel like we've kind of gotten into a number of these things. Actually, I'll just, you know, in the spirit of real time getting shit done, have you guys seen stuff scroll through in the comments? If you've been able to go over and look at that, anything you wanted to speak to or jump in on, or topics from earlier where you had a additional thought to add?
I can feed some questions in from the community that's live on YouTube now. That's not a problem.
My man. All right.
Yeah, we've got one here. If you're buying from the Treasury, how do you decide what price to buy in relative to open market? I guess here there's a balance between optics and community opinion versus getting the best deal as a VC firm. So it would be interesting to understand sort of how VCs play at that balance.
I can jump on this, having done a few Treasury transactions. So I think the kind of typical way of doing it, and there's no set model here. It's just really kind of a discussion with the core team. The core team wants to maximize the amount of assets that they're receiving, and you want to maximize sort of the alignment of the investment that you're receiving. And so I would say, usually what happens is a multi-year lockup first and foremost, and with that multi-year lockup comes with a discount to spot after a trailing 30 days or trailing 15 days average price. So anywhere from 10 to 30%, I'd say is pretty typical depending on the lockup, but it could be anywhere from 1 to 3 years for that lockup. And if you use any sort of volatility analysis like that, that's actually a pretty fair price for the team. usually because, with a 10-year horizon, 3 years doesn't really matter.
Yeah, I think that's a good point. And I often see a lot of pushback, like why do VCs deserve a discount? And I think the lockup is a key piece of it, as well as the like kind of stated value add that they're going to provide. And again, like this goes back to kind of my original point on reputation. Like there is an incentive kind of that's soft that, where these funds have to do actual work. But one, I think, guiding principle for fair launches and even other projects that extends with this treasury purchase is, I think I've seen this just a little bit now, mostly in the DAO space, right, where you have these like kind of emerging investment clubs that are beginning to take shape. But they're offering the same terms that they are to VCs to anyone, right? So like, if Framework is going to invest or Variant in something with a 3-year lockup and a 10% discount, and that's enforced via smart contracts, well, you as a retail anonymous person on the internet can take place as well, or participate as well. So that's something that I'd love to see a little bit more of.
Cool. And building on that, another question that came in the stream is around like, and I think there's a general side of this, and maybe something that gets more nuanced at the project level, but it's around how VCs determine when to take profit. And I think in the token model versus the equity model, it's obviously top of mind. And you mentioned earlier, Spencer, like you're gonna burn your entry into projects really quickly if you're seen as just sort of coming in and dumping. I think folks get that. At the same time, the idea is to get a return on your investment. But in a model where you are directly active with oftentimes with communities of token holders, where where maybe the markets aren't as liquid as they are in other places. Like, how do you guys navigate all of the components that come to exiting your position or taking profits, however you want to think about it? There's so much that goes into it, and I think certainly different than sort of traditional like tech equity investing. Like, how do you guys think about any of those sort of pieces in this world?
Yeah, I can take this one. So cool. Again, like the for us as a venture fund, 10 plus year kind of time horizon, that's forget what happens maybe at the end of the fund, but like before that, I think we think about exiting positions in like under two circumstances. Number one is when the thesis that we had originally has been like wholly invalidated, right? So we do diligence before any investment, and if we're kind of basing it on the facts that we have at present day. And if that no longer is the case, then that's a reason that we would look to like exit from a position, from an investment. And then the other is when the fundamentals of that investment well exceed the price of that investment, right? We have a fiduciary duty to our LPs to do that basically. And I would say, it's a lot easier today than it was many years ago, because a lot of the DeFi protocols out there and Web3 NFTs, you kind of name it, they have cash flows and revenues that kind of resemble real companies. And so if something's trading at 1,000 times price to sales, right? Like obviously that's extremely overvalued, and we would look to, potentially pare back our position in that case. But yeah, I think we want to be very specific about when that happens, because ultimately it's not the scope of our fund, at least, to be entering in and out of positions. That's not what we're good at or what we do.
Yep. Only thing I'd add is that there's also sort of this, has the whole realization of the vision or sort of the white paper dream been realized? So not just invalidated, but has it been validated and realized? And with any of the time horizons, with any of the investments that I think any of us have made, we're not even really close to that being a reality. And so I think when that time comes, whether it's in 1, 2, 3, 5 years from now, that'll be another factor that's part of the evaluation. But then the other part too is there sufficient decentralization so that the support that the venture firm is giving, whether it be resources or governance or staking, what have you, is it sufficiently decentralized enough so that when that support is pulled back, the growth of the project can continue unencumbered? And this is the equivalent basically of a venture investor selling either at or close to an IPO. It's sort of, okay, we're transitioning the ownership of this company over to the public. And that is a very tricky thing. And, it'll be something that all of our funds really kind of have to figure out over the next 5 years.
Yeah, maybe that also becomes some sort of portfolio management at some point still. If one position just does very well and it's 99% of your fund at some point, it makes sense to exit some and to start investing in new ventures. And then usually when that's the case, these projects are big enough to stand on their own feet as well.
Yeah, that makes sense. Matt, maybe we'll stick with you. One other question that came in as we're talking that was, I think, touched on, but not directly hit in here, is do firms buy the dip? Actually, maybe I'll just put it out there, especially relevant in the market we're sitting in today.
Yeah, I think especially for projects like Yearn, that you can't enter via venture investment. If you have your eye on it and you want exposure anyway, and I think when the price goes down might be a good time.
I think I'm sure many do, and it obviously kind of depends on the fund. I think for us at Variant, every single investment that we make goes through one of our investment committees, and when we've gained conviction on it, when it comes to a liquid investment, we try to allocate across some amount of time, right? And I would say have just to make it really general, have a sort of algorithm basically that accelerates or decelerates based on price action so that we can kind of get in thoughtfully. So yeah, I mean, I think it's obviously entry price is really important in this market, and that's important for everyone.
Yeah, that makes good sense. Let's do 2 more from the audience here, and then Daniel will pass it back to you after that, unless any other burning questions come in. I think these are good to sort of get into maybe some more detail of things that we've touched on a little bit, but let's see. So Michael, maybe we'll go to you on this one. And I think we have talked about Yearn quite a bit, but somebody asked in the chat, and I think it's a good and relevant question. But what's about the right or acceptable token allocation for the team, and then they mention Yearn and the minting, which is obviously was a topic of much debate, which I think is a really good thing, right? That sort of played out for everybody to see in the governance forum and what have you. But at the end of the day, it gets back to the idea of what's fair. How do you think about, how do you help teams that you're working with think about what's acceptable in terms of team allocations and how to navigate all that? Simple question.
I mean, another instance of just so much it depends. It depends on the team, the number of people that have contributed so far, the amount of work that's gone into it, what you expect the future state of the team to be. So, you can kind of think about it in 2 parts. There's sort of the existing team that has built everything to date, and then there's the future potential team that will need to continue to be incentivized for the proliferation of whatever's being built. And so, we kind of break it down into those 2 buckets. I would say probably across the board, the total amount of team ownership when all is said and done on average is somewhere between 15 and 30%. And that's probably, even 30% might be a little bit much in terms of, total ownership where it's existing team and future potential team. But one of the things that I think is really important is treasury management. And treasury management, could be just an allocation of tokens. It could turn into allocation of tokens in stable coins or other crypto assets, what have you. But the real kind of kicker here is that if you have a massive treasury, you can have the elements of granting new projects, new access or new funding. You can have the potential to pseudo acquire new projects that are coming out, and we just saw this with the graph kind of giving a really large grant to Streaming Fast. Those types of opportunities come if you have good treasury management. So I think it's at least the initial team needs to be incentivized, but going into the future, it needs to be the treasury as that incentive mechanism too.
Cool. Spencer or Matt, did you guys want to jump in on that question, or we can jump to the last one? All right, jumping over. Matt, we'll throw this one to you. We've talked a bit about sort of equity investing versus token investing, and a question from the audience is, I'll paraphrase, but basically, like, do you think about these things in terms of, like, do you want to balance your portfolio between equity versus token investments? You think about them in that way. Do you try to maintain a certain ratio, or like how does that how does that differentiation fit into your investment thesis?
No, not really, because usually the legal structure that's chosen can also make the tokens seem very valueless. So you essentially get these in addition to the equity, or the other way around, where you pay for the tokens and equity is more an add-on. Whereas I think all of us here believe that the value often accrues to the token. But how you value that on the fund accounting side is a different story.
Yeah.
So we don't really try to balance it. Sorry, go for it.
Yeah, I was going to say we don't either. It's case by case. For many projects, I think it's quite clear that the value is going to accrue to a token, right? And so optimizing for an exposure to those tokens is what we're looking for. Although I will say there are other cases where an equity investment I think is appropriate, and actually, frankly, in many cases. One is if the kind of IP and things that are not governed by the protocol itself, so it could be a front end, for example, could accrue a lot of value, right? So if that's the case and it wouldn't be owned by the protocol itself, then I think having exposure to the equity is the best way to align incentives between the investor and the team, right? And that's really important. And the second is, if the team is early on and might potentially pivot, right, or do something else, in which case, like, the token would be kind of irrelevant towards that new venture that they're doing. So we're big believers of like value accruing to tokens, but being really opinionated about receiving and investing in equity, because we believe it's the most kind of founder friendly and investor friendly, of course.
And to chime into that, for some businesses, I think it also just a token doesn't make sense. We recently invested in an auditing firm. This is, I think, a clear example of an equity only investment.
Yeah, right on. With that, we will wrap on time. Thank you guys all for joining for the panel today and taking the questions. I think awesome. Like the vast majority of the questions here came from the community, from folks in advance and from folks in the live stream. So seems apropos for the topic of the day. So thanks for joining me on this ride today, and have a good one. And Daniel, we'll pass it back over to you, sir. Or maybe we'll go right to the llamas.
Hey guys, Next up, we have a presentation on treasury management for decentralized projects. And this is a presentation by Llama. So yeah, feel free to take it away, guys. Thanks for joining.
Hey, everyone. I'm just going to share my screen. Let me know if you can see this full screen. Okay, I'm gonna assume everyone can see it. So today we're gonna present about DAO treasury management, and we're from Llama. I'm Shreyas. I'm joined by Austin and Matt, also from Llama. We are basically creating the building blocks for on-chain treasury management, and we work closely with a bunch of top DAOs on treasury management and related strategic initiatives. We've worked with Aave, with Uniswap, Pull Together, Gitcoin, FWB, and a few other DAOs. And our goal is really to build products that let anyone, any service provider, DAO, individual, really plug into simple UI and like sort of underlying primitives and propose treasury strategies that push the DAO and protocol space forward. There's billions of dollars in DAO treasuries today, and it's quite an interesting problem because treasuries are basically pools of crypto assets that are managed by these open source protocols where token holders and community members can decide what to do and how to allocate. And this is there's obviously some similarities with say corporate balance sheets or university endowments, but the difference is just the open nature of it. Imagine if Stripe just opened up its balance sheet for anyone to decide what to do with it. You just have an interesting type of engagement, and treasuries are probably the most important use case of governance. The reason for governance decisions is mainly what do you do with the treasury? How do you allocate it? How do you spend it? And this is why the problem is sort of interesting. There's pieces of it that can be automated, pieces of it that can't, pieces of it that can be just made more efficient, but you still need the menu of options available for our community members. All right, I'll give it to Austin.
Awesome. Thanks, Shreyas. So first off, with treasury management, I think it's important to set the stage that it's not purely about financial ROI. Like we see with, maybe something with like a traditional investment fund, what makes a treasury management for a DAO treasury a lot different is that they're optimizing for other things. On the financial side, treasury management DAOs definitely want to provide, downside protection during bear markets, and you want to ensure your capital base grows, but it's certainly not the full story. What it's really about is maximizing the adoption and longevity of your protocol. And when it comes to protocol DAOs that aim to last forever, a protocol's treasury management strategy should have an infinite time horizon too. And so to provide a simple mental model for thinking this through, we divided the life of a protocol into 3 phases: startup, growth, and maturity. During the startup phase, which is where a lot of DeFi protocols are operating in today, we expect to see more aggressive strategies to capture market share. These protocols are typically pre-revenue, and all financing comes from the initial treasury DAO allocation. It's expected to see a higher spend on user acquisition, a focus on bootstrapping the developer ecosystem, typically through grants programs, and more of just an overall focus on marketing and brand recognition. Using funds to improve your product by providing liquidity, for example, or as we've seen, most importantly, running liquidity mining programs have been the most common user acquisition tactics that we've seen here. The next phase is the growth phase. Some of the largest DeFi DAO treasuries are starting to move into this phase now. And some of the characteristics of this phase are that treasury operations are beginning to be partially financed from revenue. The community is also much more active and vibrant. And so this means there's naturally an increased focus on things like unit economics and just overall spending discipline. It's more difficult to sort of get away with with spending on things that don't have like a clear short-term or long-term ROI for the community. The final phase we describe here is the maturity phase. No protocol has really entered this phase yet. This is when we'll see operations be fully profitably funded just from revenue. And communities will prefer to build up large treasury funds to finance long-term strategic initiatives, and use their growing capital base to really fund things with a much longer, a 5-year or a 10-year outlook. And so as we see best practices form around things like mergers and acquisitions and token buybacks, we expect to see a more sophisticated, longer outlook uses of capital.
Thank you, Austin. So what we're seeing in DeFi at the moment across the space is we see a lot of protocols that hold a very large position in the native governance token. So having an overweight position in the native governance token reflects confidence and belief in the community in what they're building. So they want the upside to prosperity they're building within their own community. So because they have a very heavily concentrated position within a single asset that's quite often very high volatile and moves a lot with the markets, what we're seeing is these treasuries, the value of them moves and swings with the market price, quite often very much so in a small illiquid token price. So there's big changes in the treasury's valuation. So what we're seeing now is we're starting to see treasuries diversify into, say, low vol assets, so something like a stable coin, which basically offsets some of that high vol risk that we're seeing in these governance tokens. So most protocols don't have the ability to accumulate tokens in something other than a native governance token, which really shapes them towards basically building up that safety net in the stable coins. So what we're seeing now is recently we've seen a few like strategic raises happen in the space where protocols have opted to basically sell their governance token to outside investors, helping to grow the protocol and basically help accelerate the growth through basically expanding the network, their reach, and then broadening out into utilizing some of those traditional finance networks they're building through basically distributing their token out. So what we're seeing there is by bringing in these strategic partners, they're looking at aligning the objectives of the investors, in this case partners, to suit and line up with the objectives what the community is trying to achieve in the longer term. And the way that this is typically happening is with like vesting periods and lockup built up into these deals, and that's just to help align some of these communities. Now, bringing on the stable coins initially into the portfolio just reduces the exposure to market prices. It gives the community that sense they can get through any kind of downturn because they've got that funding, which then allows them to hold on to that overweight position in the native governance token. So if you think of it like that, then these partners bring in a lot of value. And yeah, Trace.
I actually just want to confirm everyone can see the slides, right? Then I'm.
Yeah, we can see the slides on the screen.
Cool. Yeah, so the next way of diversifying is through token swaps. And the thing with token swaps is that it's way more than just a means to diversify, because it's also just a way for two DAOs or many DAOs to just form an alliance. And what this can help with is, one, participation in each other's governance, but then also just, because of DeFi composability, there's ways that products and protocols can integrate with each other and build on each other, and use the Treasury swap as sort of means to align these communities. And one protocol that definitely comes to mind is Yearn, where they've sort of built these relationships, especially during hacks and exploits, where they've helped out Ready Capital, they've helped out Pickle, and these are sort of ways to, I think, buy trust and form alliances, and then I think over the long term, really be able to have this like competitive edge with the community composability element. We've been working with two significant DAOs on a largish like alliance and token swap. There's and we've been thinking through a lot about what the right template and implementation for this is. And the model that we've walked through is basically initial delegation of Treasury tokens to each other's governance for voting, followed by a stream of Treasury tokens to each other's Treasury over 2 years. So basically the funds will be sent to a smart contract and then streamed to each other's Treasury over 2 years. There could be a rage quit mechanism for, say, the first 3 months of the period where each community can get out. But at any point during the 2 years, either community can just have a governance vote and decide to stop the stream. And the goal is for this to lead to broader engagement, as well as like potential product integrations and other ways that the communities can benefit from each other. The other way to diversify that's quite underutilized right now, along with the token swaps, which is quite underutilized, is through revenue, which is thinking through ways that you can actually earn stable coins in the treasury. For example, like Aave through A tokens is building this stable balance in their reserve factor, which is different from their primary treasury. You can have ways that you basically think through what an ideal like strategic allocation is. Not, as Austin said, you don't want to think through it in an investment function, but at the very least think through it in terms of, okay, you want some stables in your treasury to pay OPEX for a few years, and maybe there's ways you can actually earn income in stables to achieve that instead of selling your tokens or borrowing or doing something else. One way to do that, for example, is to if a DEX like turns on fees and accrues like a long tail of tokens, it's a different problem. You'd have to manage make sure that allocation is not like out of whack. But that could be an interesting way to get to owning more than your protocol tokens. Another way to diversify through revenue is through collaboration with other DAOs. So for example, if a DEX wants to get into lending, but doesn't have the marketing and other resources and dev resources to sort of get into lending, they can potentially have this collaboration with a lending protocol, and each of them can basically come to an agreement where they send a portion of their revenue to each other's treasuries. And so it's sort of you have this like almost like Web3 native like merger type thing where you're having this revenue share, and the revenue is diversified because it's a different sort of category of project, DEX versus lending, and you could sort of expand your what you do without spending all the initial resources to get there. So to conclude, Llama is working through a lot of interesting treasury problems, and if anyone has questions, or if you're a DAO and wants to sort of collaborate or think through ways that we can work together, feel free to reach us on Twitter at llama community _ or email us. You can email me at shreyas@llama.xyz. And we're sort of, I think, at the forefront of a bunch of treasury problems, and we'd love to get thoughts, feedback, or questions on any of this stuff.
We have had one relevant question come through the chat just now, and that is, what percentage do you recommend of the treasury that projects should keep in order to incentivize development, and I guess to also ensure their project has enough longevity?
I think in terms of having longevity for like just stable assets, like I would say, I wouldn't look at it as a percentage, but like probably a few years of operating expenses should be in stable coins to fund critical expenditure, irrespective of what happens to the native token. And by critical expenditure, it could be like dev expenditure is probably, if you are funding devs through the DAO, that's of course like the top priority. And then after that would probably be just some ability to not just like maintain like existing marketing growth spend, but probably ideally like expand it, right? Like if there's a drawdown, you should be able to if you have some buffer, you should be able to increase spending during that time and do better than sort of other DAOs. So I would look at it in terms of like at least a few years operating expenses. Yeah, I think the funding of developers, like, it depends on how the protocol is structured. If it's structured like the Uniswap Aave compound, where it's most of the developers are still in the Genesis team, and most the dev funding right now isn't happening through the DAO Treasury, but it's slowly happening through these grants programs. Then you have an estimate of what these grants budgets are. It's like a few $1 million a quarter. But then if it's a protocol like Yearn or Sushi, where things are being funded by the DAO Treasury, then I think that's something you want to spend like top dollar on, and it's like you sort of do what it takes to hire top talent to build your protocol. And as long as you have some runway of a few years, like, it depends again on the phase that Austin mentioned, the startup versus growth phase. But you can sort of think through the runway you think is reasonable, and based on that, you if you're in the startup phase, you want to spend to grow, and same if you're in growth phase.
Awesome. Thanks a lot for answering the question, and yeah, thanks a lot for taking the time to chat today. It's been great, and everyone, you can reach out to these guys on Twitter or through any of their channels if you have any further questions. Thanks, guys.
Thanks, Daniel.
Okay, the next panel that we have today is called "Is Fair Launch a Misnomer?" And joining this panel, we have Scoopy Tree Pools, Zaki, Ivan, and Kobe. So let me just stop sharing my screen and we'll drop them in now. Hey guys, can you hear me?
Yeah, I can hear you.
Oh, we could have all pretended that we couldn't hear them all together.
You see me talking by myself. Coin Alchemist, you're on mute at the moment.
Can you hear me now?
Yes, we can. Perfect.
Okay, perfect. So, yeah, as you said, we're going to be going over is fair launch a misnomer? And we have some questions that came in yesterday, and we'll be taking questions from the community.
Ivan's just joining now, so yeah, feel free to take it away, guys.
Okay, there we go. My apologies, I had a feedback issue.
Is this being streamed somewhere, so I need to tweet a link or whatever?
Yeah, it's being streamed on YouTube. I'll send you the link now.
All right, thanks, mate.
So yeah, we're joined by Kobe, Ivan, Scoopy, Church, and Daniel. And we have some questions from the community that came in. We'll start with what's the best token design that you have seen?
Is there someone specific that wants to go first?
Let's see.
Just to touch base, Church and I are just moderating, so we won't be taking part in this panel.
Oh, my apologies. Okay.
Yeah,
So
no
Scoopy, Ivan, and and Kobe, we'll let Scoopy not answer first since they're just waking up.
I could try to throw in. Yeah. Hi, everyone. I think it really depends on what exactly you're looking from the token to do. Like from the recent ones, just on the top of my head, what has proven to be working. I think the CRV tokenomics makes sense for the industry and the part of the cycle where you really need to inflate with incentives in order to grow the TVL, but it helps mitigate this selling off with the VCRV model in there. And I think the VCRV model was adapted / improved by Andre with the recent one, with the Forex token, with how I think gouges are made on the lockup terms. So I would say in terms of the working ones, that one seemed to be pretty well, doing pretty well considering this cycle.
I think the best token design is like it's difficult to beat Bitcoin. It has like this sort of irreproducible and almost biblical genesis event where the like market conditions are now completely impossible to ever replicate. So you're never going to be able to beat that. And then it like onwards, it really depends what you're optimizing for. So I think a lot of the tokenomics discussions get wrapped up in these red herrings where people are just talking about different optimization functions, such that as an investor, there's a tokenomics design that is exceptionally good for you as an investor. Like you find out about it, and that's the like. There's a structure that's really good for you. There's also a different tokenomic structure, which is the best possible structure for a new project that wants to retain a large percentage of float for growth, incentivizing behavior, for like building over, you know, a 10 to 50-year timeline or something. So it like I think a lot of it depends what you're optimizing for, and often projects are not incentivized to make the best possible tokenomics for a retail buyer because a project wants to like build something that like wins the market. So I think it's difficult to say. If you're going like what's the best token design that sort of checks all the boxes and is like good for retail participants and also good for the project, you end up with like the Uniswap model was pretty alright. I think they retained a small amount themselves and did a decent airdrop to a lot of users. And I think Aave, I don't know how you're supposed to say that. I always get it wrong. And Synthetics are the I know Synthetics did a lot of work on the token, but were good just because the point at which they launched was important. Like, if you do stuff in a bull market, it's very different to doing it through the middle of a bear market.
Scoopy, how you feeling now? You get your coffee in you?
Yeah. So, I mean, thankfully, people already said a lot of what I was going to say. Like the three that I think I like the most as far as like tokens on DeFi goes are Curve, Synthetics, and Aave. Curve because they have like the ingenious vested curve system that gets all the TVL in there, but at the same time creates kind of like a game theoretical model where people are like trying, should I lock, should I sell, how can I maximize my profit? So I think it's a really cool dynamic that they have there that kind of stabilizes the price of Curve and creates a very good like kind of yield generation venue for other protocols and other people. And then with Synthetics, I think it's really cool because you have to always constantly be monitoring like your debt in the system. And if you play it well, and if you do good as an individual, then you're rewarded relative to other people. And I kind of like that in Synthetics. And that you get to share in with like, the growth and the usage of the network as well. And then with Aave, I really like their security module. So if like something happens in Aave and there's a shortfall event, then it'll kick in the safety module that'll slash the stakers up to 30% of their staked Aave. And then that's used to make the system solvent again. And I think that's a really good idea because, a lot of these staking projects, or projects with farms, people will stake things, but they have nothing at stake really, unless they're in pool 2, then, they're playing with fire there. But I think, making people actually put something up in order to get a reward and take a risk for doing that, I think that is very good tokenomically. It aligns interests for the stakers and just the protocol in general. And then I guess like kind of like on a big level, then yeah, Bitcoin and Ethereum are both also attractive to me, especially Ethereum after 1559 goes through.
Zachy, welcome.
Hey.
How are you? We were just talking about best token designs you have seen. Are there any standout projects in DeFi or in general that you see as the best token design or most ideal?
I don't think we have the slightest idea what the best token design is. I think we're still in like the early days of trying to do token designs. I think I would agree with the statement that like the curve system is pretty interesting and cool. One of the things that I think is one of the things that was like harped on is that when you tie political power to engagement with the system, that seems to be like a really cool Skinner box of sort of rewards and mechanisms designs. The thing I'm probably most familiar with is the sort of first big fair launch in the Cosmos ecosystem, which is Osmosis. And it has this really cool like mechanism also where there's an epoch time. So it's like 10 a.m. Pacific, and 10 a.m. Pacific, everyone gets their staking rewards. And then everybody rushes to like sort of, assign them to various liquidity pools and do various things with them. I think that's been a cool, like the 10 a.m. time window has been like a really interesting thing, though I have not started to, my attention to 10 a.m. has fallen off. But there's still a lot of people there because I run a validator node and I always see the traffic just like spike at 10 a.m. So it's been an interesting, I think, like I said, I think these like the way in which we design these like reward systems and the way they like interact with human psychology, I think are ripe for experimentation and are a really interesting part of the system.
That's a great answer. So this next question is a good one because it kind of follows through with what with the speakers that were on just before the two speakers that were on previous to us. How to fund initial development for fair launch projects in a fair manner, with fair distribution and no one really having too much control. We'll start with you, Scoopy.
So at least in Alchemist, we self-funded everything prior to launch, with the exception being the liquidity pool that we launched with on Sushi. We sourced some funds from friends and family, e-girl included. And then with the team, when we wanted to launch, we had 6 people who were on the team before we launched, and they all kind of joined at different times, but everybody had been on the team for about 3 months before we finally launched. And everyone was very pivotal in the success of Alchemist. And we decided to keep our organization very flat, and all 6 co-founders have equal share of team tokens and things like that. So we have like no one person who's getting more than anyone else. And we think that creates a good dynamic amongst the team because we know that everyone, is getting the same amount of ALCX tokens. And that we assigned, around 15% of the supply to the team, 15% of the supply through a pre-mine to the DAO, and then the rest of the ALCX goes to farmers in our system. So, we got a decent amount from our side for the devs and for the DAO, so we can continue our development. But I think we thought giving the vast majority of the tokens to the community would be the most fair thing to do, as far as what we were looking for, as far as getting a good distribution of token holders. We thought that liquidity mining, that's an additional benefit of having liquidity mining.
What's the how long does it take for that like remaining 70% or whatever it is to be fully distributed?
So for Alchemist, the current emission schedule, it reduces weekly for 3 years, and then it'll be around 2,000 ALCX a week at that point, and it'll be just flat tail emissions, so we can have kind of long tail rewards and incentives in our system with minimal inflation.
That makes sense.
And Kobe, with your experience and through Lido and all the projects that you've been involved with on an investor level, how do you see the fairest way to fund development?
I mean, if you can self-fund, then it's by far the fairest way, right? Because you're not only putting in like sweat equity, you're also putting in your own funds, and it's very difficult to argue that you should not be rewarded with a share of that. I think the fairest way to fund development, if you really need to raise money, the fairest way, and not the way that I would recommend people do, but the fairest way would be to have some kind of like live auction, well publicated ahead of time, like basically an auction token sale, right, where anyone that wants to buy can buy, or maybe some first come first served token sale, but basically something that's open to anyone, so everyone's on the same terms and can attempt to purchase some quantity themselves. I think that would be the fairest, but I think it just comes with so many headaches and hassle. Like the reg risk of doing something like that is much higher than doing like a private fundraise with like professional investors. And if you have unprofessional resale people buying your initial token sale, you have an incredibly loud and irritating often like group of people whose investment timeline is like 3 weeks rather than often VCs look at like at least good VCs look at like 3 to 10 years or something.
Yeah, the guys
sort
earlier
of
were saying that.
Yeah, so like the fairest way to do it, I think, puts a lot of pressure on the project, which is like probably suboptimal for creating a successful project. Gives you additional work and additional hurdles anyway, and it increases reg risk. So I think it's complicated. Like if I were doing a token project tomorrow, I would do a private fundraise from people that I know are exceptionally helpful and would be value add to the project, or I would just entirely self-fund it myself. I think the fair option of like a token sale available to everyone is like almost the last thing I would choose, because I just don't think it's possible to even make them fair really either. Like the fairest you can make them still don't end up fair.
Ivan or Zach, anything you want to add on that?
Go
ahead.
No, go ahead, sir.
What I would say is, I think the most disappointing thing about these sort of fair distribution mechanisms is how much, like when you have done fair distribution mechanisms, the results don't look that different from a private sale. I would my main experiences is like we went through so much work and effort to do the atom distribution in as fair a way as possible, and like jump through all kinds of crazy regulatory hurdles to try and make it legal, and like used a window of opportunity that doesn't really exist anymore, and still ended up with like roughly like the same kinds of people that we could have just done a private sale owning the majority of the atom distribution, right?
Yeah.
And that I think there are opportunities, and there are projects that I'm involved in right now that are trying to do fairer distributions, but they have to operate like almost like secret societies for years. Like if you want to do like a fair distribution, you basically have to be in the situation where like it's like, hey, like I hang out in this one weird corner of the internet, and that's how you ended up getting tokens, or like I know these people. And like it doesn't mean these things aren't public, but it's like the minute you're like, hey, like here's this big vision that we're trying to do, you're going to attract capital from the usual faces.
So is like the meme airdrop the optimal fair distribution? Like just get a bunch of people on a Telegram, fill out a Google form, and now you're distributed.
I mean, you have to define like what is fair, in my opinion.
Yeah.
Like what do people think is a fair distribution? Is it like no centralization of supply? So the supply is like uniformly distributed amongst as many people as possible, like the maximum potential participants? Or is it just that everyone had the same opportunity to enter on the same terms at the very beginning? So, no one was at an advantage getting a private price that was better than other people's private prices. Like, what do you define as fair first? Because what the airdrops do well is they make sure that loads of people get a very small amount, and then there's the sort of hybrid airdrops where it's like you get a small amount and then you get a bit more based on your usage, which rewards people that were contributing to beneficial network effects or whatever. And they're pretty good as well. But as people learn about these things, they just start farming them, right? Like people get loads of accounts and try and farm whatever airdrop they can by creating a bunch of addresses or creating a bunch of Discord accounts or whatever. And then CoinList has the sort of KYC as Sybil resistance element for their airdrop / sales, and people just pay people to make CoinList accounts, and you can buy KYC CoinList accounts on dodgy telegrams. So they're all circumventable, I think. And it comes back to how do you define what fair is? And the reason I don't think that it's possible to do a proper fair launch anymore, all you can do is optimize for as fair as possible, but you can't do a proper fair launch because there is so much capital and attention in the space now that people will flood into stuff with high conviction, whereas the real actual fair launch of Bitcoin was 10 years of market cycle with building conviction and people going, this thing's going to zero, and and that distribution over time creates something that ends up much fairer than now, when Justin Sun or Alameda or Three Arrows can just ape several billion into a staking pool and end up with all the supply, even if it was fair, and you've got 2 ETH trying to farm some. I don't know. I don't see how it doesn't just perpetuate people's current wealth.
Yeah, I would have to agree with Kobe there and with Jordan, sorry. And to start off the reply the same way, I mean, we could, of course, debate what fair is. So just quickly about fair, I think in traditional space, Robinhood sends in an article, hello, ring our NASDAQ bell considers to be community friendly, right? Because they talk about it. While in crypto, if you don't apply to community, you're already unfair. So it's a very different degree of fairness. So the question is, why are you actually trying to be fair, I think? So let's say fairness is subjective, but fairness is only done, I think, for the sake of incentivizing one or the other action from the community or the user base you have. So when you're looking at it, I think in the context of, let's say, Andre's launches like Wi-Fi or the Forex recently, I think it was about having the fair access so everybody could do that and at any point and from anywhere in the world. But from my, let's say, slightly nihilistic perspective, is that what is the actual point of it? I'm more of a fan personally of a retroactive public goods distribution. And you could say it is unfair because you cannot in advance as a contributor know that you would get anything or that your time is not wasted and things like that. And you rely on the core team essentially deciding whether you were helpful or not. But I believe that's essentially the same thing end of the day, because it's about, you always have at least a few people who work on it the most, right? And then you have, let's say 1% of the entire project community works the most. 9% are people who are speculators, but they're passionate about it. So they read, sometimes comment, help distribute news, product, give ideas. And then 90% are just retail traders who will never read your articles or anything else. And that's just a fact. You cannot change these numbers. I think they're just the same way in physical liquidity flocks to one certain point, right? The same way here, it just amasses into the same thing as gravity. So in that case, I don't disagree with the idea of giving an edge to some people early on who actually work on the product and contribute. I do think they should be rewarded. And because the edge will be found anyway. For example, you were first online, you have an edge. A slight edge, but you have an edge. You have more capital to start farming, you have an edge. So I think it's just the question of how you choose to give an edge to people. And if, as the core team, if you are having good intentions and you understand these balances, I think you can design something that's not fair launch, but essentially have similar effects to that. Because let's say, sorry, just the last thing. If a fair launches now, in half a year, it will essentially be forgotten. I think the effects of that are like marketing. So then you're asking, okay, are my contributors still incentivized? Is everybody still intact? Is everybody still working on the product? And then you will have to come up with new mechanics. So a fair launch is more like a strategy to start off. And if you have another strategy to start off, you can actually become fair later in the game by having, let's say, your votes distributed, the voting weights not being in the hands of two VCs or two core team members. And then you are in the same trajectory as, let's say, a fair launch project a year ago.
Yeah, I think a truly fair launch is probably just you own the percentage that you built or contributed to building, and no one gets any for free. That's actually much fairer. If you don't do anything, you shouldn't get any. That's fair.
But who will vote then on actually who gets what? That's the question, right? If nobody had tokens in the first place, who is the one voting? And then I think it's more akin to retroactive public goods distribution, right? So it's about like 2-3 people in the core deciding that, which is fine. It's fine by me, you know. It accomplishes the result you want to see.
Yeah.
That was all great. That actually leads great into the next question, which is how would a fair launch project monetize for the initial audit or initial team building if you're not seeking private investment or getting some type of funding first? Is it that you just have to self-fund, or do you see any type of mechanisms that you could put in place to source funding with still providing a fair distribution?
If your developers are good enough, you could just do a few rug pulls.
I mean, I've definitely seen, I've seen people trying to do things like selling options on future tokens coming from DAO contracts, basically. So like, there is that methodology of like, hey, what are you fundraising? Well, like if we assume that like this fair launch project will exist, that it'll want to pay the core team something, and we will, skim off some portion of those tokens that are skimmed to the core team and like give them to you, private investor, based on like what you gave us right now.
You mean like green strategy?
Yeah.
Okay.
I think UMA just did something like that where they issued like debt bonds or something.
Like I know for Alchemist, like we were self-funded. I played the role of like mini VC in the early stages because I was like an early farmer and I had, done very, very well. So I was like, any like little like small item that's under a couple $1,000s, I can take care of it. With that kind of in mind, we were able to, kind of bootstrap things together along with like, a lot of like free developer time. I know that won't work for everybody. That's for sure. If you have a good like network of friends and stuff like that, then getting them to kind of like give you guys some early stage capital to invest, is one way to do that without getting like some big name investors in. And I'm sure that like as long as you have good relationships with other people in the space, then there will be people who would be willing to support you and stuff like that. So that's always one option. For how you can like self-fund the team. One thing I found that was really hard is that like we didn't do any self-funding, like any like fundraising for the team itself. And then I had promised somebody before launch some Alchemist tokens for helping me build some stuff to complete the project. And I promised them like 100 tokens. And at the time I thought like we're going to launch like at like $15 per token. So I was thinking, yeah, that seems pretty reasonable. $1,500 for like a job that lasted a week. And like a day after launch, we like more or less like 50x'd from that. And I still had to make do with my payment to the guy. I told him I'd give him 100. So I was like, all right, here you go, even though it went up so much. And like the moment that those funds left my wallet and went to the other dev, and then that dev like sold it, people were like, the devs are rugging, get out of here. And I'm just like, oh no. I had to go and do damage control. And at that point I realized, like, any move of our tokens is going to be heavily scrutinized. And so the team was a little bit spooked from trying to sell anything more. And we were in a dilemma where it's like, we need to sell the token to fund our team because we didn't take any funding from VCs or anything like that. And then luckily somebody, an e-girl CL, reached out to me and says, yo, there's lots of, investors who want to get a piece of Alchemist. And this is, after we launched. And then we were able to put together a couple of deals with some, some investors and pay the team that way. Which ended up being a pretty good thing because we have a number of good investors that we like. But, that's something that, like, optics wise, it ended up almost being better for us to sell to investors than it was for us to dump our tokens on the market for funding.
I think a bunch of that stuff's just about how you communicate it, to be honest. Like, if you do like this is how the developers are going to sell schedule, or like it's not framed as silently dumping, the community is often fine with it. Similarly, like an investor raise, it's fine with it. Thing is, often crypto communities see an investor raise as bullish because it's a sign of conviction from professionals that like your current price is a price that they would like to get in on. But then at the same time, in a different breath, they also don't like VCs and think it's unfair when they get to buy. So can never win, can you?
Yeah.
All right, Ivan, anything you want to add on that?
No, not really. And I think just another important thing is the importance of the cycles, because often it happens, a cycle comes in, washes out 90% of the people or even more. So you have to understand that you will have to repurpose into another mindset. Like, change is the only constant, right? So whatever you had before, whatever even community you had around you, as the cycle continues and let's say goes up, down, whatever, not trading here, I think it will change also a lot of that perspective. Like a fair launch wouldn't maybe have the same effect once the market is in a different stage. So then we will be talking about 5-year lockups being good again. Market is bullish, you'll be like, no, everything is unlocked, is the best. It's just, it changes that. So yeah, that's it.
I think Curve changed a lot of people's perspective on that, because prior to the lengthy lockups you saw in Curve, I would have laughed at, locking something up for 4 years as, just an individual, not an institution investing level. What
about Hex? Staking your Hex for 15 years.
Yeah, staking Hex for 15 years. Those guys are something else, but now it's Pulse, whatever Richard comes up with next. So the next question on here is it possible to have a fair launch in any capacity when there still exists private early investors who are likely to get a better price? And I think this falls back on like what we consider fair or a fair launch. So it ties in well to the question we were talking about, the topic we were talking about 2 questions ago. So can you have private early investors who are getting better prices than the general public and still be considered a fair launch?
Question here. If you lock up private investors for 3 years, and then the people at the beginning actually have the same, let's say, liquidity margin, so community full distribution, is that fair launch or no? Because you can say the effects of the first 3 years absolutely minimal of the early participants, right? Yet they actually work from day 0, even before day 0.
I think like it's the same. You're taking the framing and you're saying, right, like, can the team sell team tokens and the launch remain fair? Because like you could devolve it a level further, right, and say, can the team have team tokens at all and the launch remains fair? And I think getting in the weeds of like what is a fair launch is a red herring. I think there are ways to do a private fundraise and optimize for fairness and optimize for making sure that like this is done with the community in mind and not done with the like profits of VCs in mind, and that's significant lockups, a fair price that would be like generally based on market versus the risk that they're taking and stuff like that, and be very transparent and clear about the terms of the fundraise and blah blah blah. Ideally, you'd let anyone that wants to participate also participate in that fundraise, but there's a bunch of reg concern for that. On the flip side, you've got stuff like Definity, which had several iterations of private sales before public launch, and then didn't even let any of those people sell while loads of tokens were somehow sold. So I think it's like it's not a binary yes no. There's like a scale of how much you give a shit about your community and how much effort you put into trying to make that fair. But I think that in general, you can do private fundraisers and you can have team tokens, team own some of the supply while remaining fair. Otherwise, you could just you can end up in a Wi-Fi type situation, right, where like the team doesn't really own any, and later they get added some, and like does the theater of which way round they acquire the tokens really matter if the distribution ends up the same?
I mean,
that's a good point.
Yeah,
Zach, you kind of go ahead. My apologies. I was just going to say you kind of touched on that earlier. That what Kobe was saying, that the distribution could still end up the same anyway. So like, how do you even put a structure in place to ensure that if someone is getting it for a better price, that it's still fair, let alone even if you offer it to everyone for the same price, that it's not taken advantage of by the same people that would have if you did the private sale in the first place.
Yeah, I mean, I think like the term fair is very subjective. So, I think everyone starts at a different place when they think about like what is a fair launch or what is fair in general. And I think I agree with like Ivan here in that, like, if, early stage investors have a 3-year lock and then the vast majority of the rewards are then distributed during that lock period of time, then I mean, I honestly think that that's extremely fair. Because the early stage investors, they took a significant risk in order to get their tokens, and they have to hold on to them for 3 years and stuff like that. So while they got a better price, there's no telling if their exit price, 3 years later is going to be any better than what their entry price was. And as long as like there's a majority of the tokens being distributed via farming or some other fair mechanism, and I think that that's fair enough. Like at the end of the day though, like if it's liquidity mining, even that is like only somewhat fair. I guess it's fair, but it's not like fair in the sense that like, the little guy is getting, more than a big person, like some wealth redistribution. If anything, it concentrates wealth even more, because, somebody who's farming with like, $50 million of money, they can afford to compound every single day. And the gas, costs are negligible to them, where somebody only has like maybe $5,000, $10,000 in their farming, they have to think really hard about like when to compound like their farming, when to take profits. Like they're very sensitive to gas price. So it's like, they don't have nearly as many advantages as like some of the more industrial farmers do. So it's not as fair to them, but they still have the same access as anyone else. So I think like, until we get like decentralized identity and like proof of like uniqueness, then like putting like caps on like the amount one person can contribute or mine or things like that is unrealistic, because you could just Sybil attack it. I know Based, when they did their distribution last summer, that is like you could only put in $10,000 in any one pool. So I spun up 10 different accounts and I put $10,000 in each one in order to mine Base. Like, it was just a headache, but it didn't stop me from doing it.
Yeah.
Good point. Do we have time to pull some questions from the stream? I know there are a few that popped up in there.
Yeah. We have another 10 minutes, so we can squeeze a few questions in there.
All right, cool.
Do you want me to feed them through, or have you got them?
I'm in. I've got the chat pulled up, so I can run through them.
Awesome.
So Nariman, we'll say R. He asked, can a project be considered fair launch if it holds a large treasury allocation, like 40%? I mean, that's a lot, but we'll just say, we'll rephrase this to what's the largest percent of native tokens that a treasury could hold for future growth, VCs, team, et cetera, and still be considered fairly distributed, or having enough tokens out in available through liquidity mining, in liquidity pools, et cetera, for it to be considered fair, quote unquote.
Let's say you start with a 90% in the DAO, but then you have only three main voters in the 10%, which are the core team. And then you say, wow, 90% is to community in the DAO, right? And then they vote to actually allocate it to the race, and another portion goes to developer that essentially a company is paying for. So this is very much semantics, because you can, depending on who the early voters are, especially with the recent DAOs, it really changes on how much it's like projects back in the days having an R&D fund, foundation allocation, marketing and incentives, marketing and partners, and something else. Essentially, it means the same thing team is selling. So it's very much semantics. So I don't think this percentage even makes sense.
Yeah, it depends. What's the time period you want to become fair within? Like, do you want to launch and within a day or a week you're instantly well distributed and fair? And then is that fair because it was only fair to the people that were there on that particular day? So if you were getting your hair cut, it wasn't fair. But if I think you can hold a large treasury if one of your goals is to have to increase the unique holders, for example, to reduce the centralization of supply to single holders, and to make sure that everyone is able to acquire the token, for example, for free, by providing liquidity or behaving in some way that is beneficial to the overall system. Then maybe it will take longer, but holding a treasury back might increase the fairness over time, because it wasn't just like Alameda aping 8 billion into a farm for a week to get some of the supply. At the same time, there's price discovery that happens during that, and then it gets less fair because people understand the value more and as time goes on. But so I think it's really, really difficult to say, and the focus on fair launch is probably mostly a marketing tool for projects these days to say, look, we did it fair, when really fair is inachievable.
As fair as possible, I think that's the goal. I don't think you can ever have anything be 100% fair. Somebody's going to have an advantage. I mean, this is blockchain. Even in one block, it's questionable whether it's fair with people who are extracting value and stuff like that. So I think we just have to do the best that we can do. I mean, if somebody can iterate on the model and find something that's truly fair, I think that would be awesome. And I think decentralized ID, or at least proof of uniqueness, is something that could go a long way to that.
Have you seen that thing where they're going to scan your eyeball?
I know. I was just sitting there, and you were laying out all the way, the logical train of that thought gets you to WorldCoin.
Yeah, but if you were doing WorldCoin, right, would you not? I don't think you'd scan eyeballs, would you? Because isn't Apple Face ID pretty good? I don't think I'd go straight to retina scanning.
I've seen there's vein scanners. They hook up to your wrist, and apparently that's something very unique, just like your fingerprint. And they can identify you that way as well. So that'd be pretty cool. Just scan, take a picture of your wrist with a special phone, and boom, you have a special
proof of wrist
unique ID.
I think the biggest fair launch that doesn't get talked about as a little bit of as honestly as a cautionary tale is the handshake GitHub airdrop. Like that was a massive amount of effort that was put into what was effectively a fair launch, to the point where they invented novel cryptography in order to enable people to claim with credentials that they had people had used with GitHub, and like it sort of didn't work. It mostly didn't work because no one built the tooling and the marketing engine to like get people to go out and claim their airdrop and start using the system. But then there was like all of these perverse incentives between the people who were active in the system, who kind of like didn't want all of that supply to come online. And so, yeah, I think there's, like I said, I think there's a lot of room for experimentation, and I want to continue to like play around with new distribution modules for as long as I'm in this space. But it's tricky to find something that like works, that jumpstarts your project, that gets you a large distribution, and doesn't and holds your project together. It's a tricky mix.
Do you remember the NEM launch on Bitcoin Talk? Anyone?
I remember it.
You say NEM?
I was around it. But,
NEM. Yeah, what they did was they did this. The distribution was a Bitcoin Talk thread, and you had to, when the thread went up, you had to post as quickly as possible, and then the page number that you were on the forum, in some way, like referenced a price per token that you got. So if you were on page 1, you got like, let's say $1, and if you were on page like 50, you got $1.50, let's say. So it was like, I don't remember the scale, but it wasn't as aggressive as that. But the maximum that you were allowed to buy was 0.1 Bitcoin, and back then Bitcoin was like, $300 or something, maybe 500 or so. So you could buy like $50 each, but they also didn't allow Bitcoin Talk accounts that had less than 50 posts or less than X posts in a period of time. So it was virtually impossible to create a new account. You had to have multiple accounts already, and it was like rough and like hacked together. But people didn't have more than 0.1 Bitcoin of NEM when it launched. Maybe it wasn't NEM, maybe it was Zem. Maybe NEM was a private one. But it was a fork of NEM that tried to do a more fair distribution, and like it worked pretty well in that no one really had a big bag and it was really well distributed, and then it pumped like fucking mad. It went crazy. That was the old polo days, I think. And that worked pretty well, but it was like rough and rugged, and just relied on the fact that everyone had an account on this forum basically back then, and it's probably not true today.
So
that was pretty good.
Farmer. They did Know Your Farmer and a bonding curve before it was cool.
Yeah. But I don't think it was NEM. I think it was Zem. NEM, I think, did a private sale. Yeah.
But what did it achieve, though? You said it worked pretty well in terms of distribution, but what did that distribution actually achieve? Like, it meant that fair distribution, and what then? Like,
yeah, it meant that there wasn't a massive centralization of supply, right? So there wasn't one person that owned loads. Instead, there was a maximum amount of people owned a little bit of it, which means there isn't like these weird incentives by like one single party behind the project. So like you had like the distribution was as fair as possible in that if you were online in those days, in the period of time you knew about this thing, you were able to get some roughly for the same price as everybody else, and you had a rough cap that was the same as everyone else's. And the bonding curve was not super aggressive, but like maybe if they hadn't done that, that would have made it like even more fair. But that bonding curve is just done for FOMO, isn't it? Get people to like comment on there quickly and then get like 100 pages of comments, and clearly this one's popular, because back then there was a lot of these like rug coins.
Zachy, when you brought up GitHub, it reminded me of Gitcoin because we were talking about different distribution models and whatnot, and incentives. Do you think that like a quadratic reward, like drip for LPs, or we'll say LPs just in general, is a more optimal way to fairly distribute tokens so that the people who have the capital advantage don't get the reward advantage that's so overweighing to the little guy that would be in the pool?
So the trick to making quadratic airdrops or like any sort of quadratic distribution system is you have to freeze the identities before people know that the airdrops are quadratic. And so, you know, when Osmosis launched, Osmosis did a quadratic airdrop to the Atom holders, and I think worked really well. I thought it was a really clever thing. It was also no one saw it coming, right? Which was, I think, clever. And so, you know, I do know people who had, for other reasons, lots of like tiny accounts on the Cosmos Hub who got lots of disproportionate amount of osmosis, and you get these weird effects. But I think those are all fine. I think the trick is you end up in this like tricky place where you have to, where like the fairness is created by like where you freeze the identities, and there's discretion there, and then you got to do it right, and there's always going to be winners and losers who are going to criticize the fairness of like where you froze the identities. And then how do you let new identities in the pool? Because it works once, but like then where do you, under what circumstances do you let new identities in the pool? It can be very powerful. I think like doing the quadratic airdrop was a great way of, I think quadratic airdrops are great ways of reaching out to communities. And being like, hey, like what we're looking for is what we're doing is we're reaching out broadly to this community, and we're going to dampen the effects of capital preservation. And to the extent that, especially if you can like do it on top of like a live economic system, but you still have to freeze the identities on that live economic system at some point, and that's tricky.
Thanks a lot.
Like build hype, get everyone in the pool.
Yeah.
Take a snapshot and then tell them how you're doing it.
No, that was exactly what Osmosis did. Is they used the IBC launch upgrade state as the snapshot, but didn't tell anyone until afterwards that it was quadratic.
I think we're going to have to wrap it up for the next panel here, guys. But yeah, it's been an awesome panel. Thanks a lot, everyone, for joining today. I think it's really interesting to talk about what really is fair when it comes to token distributions. Do we focus on opportunity to obtain the tokens? Do we focus on outcome of distribution? I think that's a really interesting concept to discuss. Cheers, guys.
Thanks for having us, Daniel.
Thank you.
Thank you, sir.
Zachy, what are all those gold things? Oh, he's gone. I want to know what the gold things were. I ain't got no gold things in my room. He had like gold things in the background, like he'd won loads of stuff.
Oh.
Medals.
Okay, the next panel we have today is called Lessons Learned in Fair Launches. We have Dan from Yam Finance and Nascent. We have Jacob from Hydra DX. We have the Ghost Step from Alchemist and Flashbox, Zeus from Olympus DAO, and Jeremy from Balancer. Apologies if I pronounce anyone's name wrong, but I'll drop you all in now and turn my screen off. Hey guys, I think you're all online now.
Hi, so we're here. We can get, so we've got, oh, Zeus is still connecting. But I see Jeremy.
Pronouncing it. I'll drop you all in now. My screen off.
I'm here. I don't think anyone can see me though.
Yep.
Hey guys, I think you're all online now.
Great to be you.
Hello, everyone.
Hey, everyone. Thanks for having us. Zeus, if you're going to be on camera, if you want to quit and rejoin, you're welcome, or you can also be off camera, up to you.
Okay, I'll be right back.
Okay. All right. Well, maybe we'll just kind of get started setting the stage, and Zeus will be with us shortly. We are live, yes. Cool. I'm assuming we are. Stop me if we're not.
Yeah, you're live. You're good to go.
Okay, awesome. Well, thanks everyone for joining. So this is the panel to talk about lessons learned in fair launches. We've got representatives from a bunch of different teams. We'll go around and have everybody kind of introduce themselves. I think most of the projects are fairly well known in the community. So we can do a pretty brief description of your project for anybody who isn't familiar. My name is Dan Elitzer. I'm the co-founder of Nascent, which is an early stage crypto investment fund and I guess incubation funds, DeFi fund. We do a whole bunch of different things. And then I was also on the team that launched Yam Finance last summer, which was one of the earlier fair launch projects. And so we'll all be talking about some of the lessons that we learned from this. So maybe Stefan, do you want to kick us off? So just introducing yourself, project representing, a little bit about what that is, and how you guys approached doing a fair launch.
Yeah, sure. Sounds good. I'm Stefan. I work on two things mostly. Most of my time is spent working on a project called Flashbots, but I also contribute to a project called Alchemist. And it, yeah, I'm not sure what Alchemist is. I guess it does fall into the category of fair launch, perhaps by accident. It really was just a tweet that I sent out about some experiment I was doing, launching a token as an LBP. And it picked up a life of its own, and now has an extremely vibrant community that somehow managed to put this summit together. So shout out to Dan for all the hard work he's putting there. So I think fair launches are pretty interesting. My main interest in it are in their ability to bootstrap really powerful communities. So happy to talk more about that.
And just in case anybody kind of missed that, so for that, I think the Alchemist project's a little bit different from the other projects represented here in that it started around just like a token. There literally like wasn't a protocol or anything to go with it. A community formed and kind of like organically came together and started making things. Is that the right way to describe it?
Yeah, the meme is the only plan is there is no plan. And I think this is an approach that people shouldn't be afraid to take, but for some reason, a lot of people in the space are really interested in making big promises of what they're going to build and what they're going to deliver. I wonder how much of that is like sort of an offshoot of the VC funding model, where you sort of need to go and have a business plan, have a pitch deck, and like try to sell your vision. And then have some kind of commitment that you're going to build on top of it, versus if you're just out there building stuff from day zero, you don't really need to make those kinds of promises. You sort of focus on delivery instead of generating ideas. So yeah, the project has been sort of from day zero just about putting stuff out there and seeing where it goes on its own.
Awesome. And so maybe let's jump to the other end of the spectrum. Jeremy with Balancer, you want to give an introduction of yourself and Balancer? I think you guys is having started very much like white paper, raised some VC funding prior to launch, all that. Maybe talk a little bit about how that has come along.
Yeah, sure. Jeremy from Balancer. First about what Balancer is, it's really three things. It's an AMM that traders use to exchange any ERC20 token. It's an automated portfolio manager that investors use to deposit assets and generate passive yield and to maintain automatically rebalanced portfolios. And third, it's a platform for development. It's a financial primitive for DeFi, for the creation of all kinds of products and services because of the customizability and flexibility of the protocol. As far as token distribution, most of Balancer's tokens are distributed through liquidity mining. Just so it's to the individuals who are using the protocol and earning the tokens and receiving the governance power over the protocol. So that's one part of the answer, but the other part is, which I think is maybe more the reason why I'm here, is because Balancer has grown into this platform for many other teams to fair launch their token, just as the Alchemist team has. We created smart pools, and smart pools are liquidity pools that can dynamically change their parameters, and that gives birth to many very interesting use cases. One of them being the LBP, the liquidity bootstrapping pool, which is a mechanism for fair launch IDO token sales.
Sorry, and maybe just very quickly, so the idea behind liquidity bootstrapping pool is Balancer does not just have 50-50 balanced pools. You can have up to, I think, 8 different assets, but generally people are doing 2 assets, and you can start with different ratios that will, in a programmatic way, change the balance over time, thereby adjusting the price if no trades are happening in the interim.
Yeah,
So
and I gave a full presentation on it earlier during this event, so check that out on YouTube for anyone who missed it. But yeah, cool. Thank you, Dan.
Yeah. Okay, and Zeus, I feel like let's love to hear about Olympus.
Yeah, so I'm Zeus. I'm a contributor on Olympus. We launched with a IDO, an initial Discord offering, which I think we might have been one of the first to do so. The goal was definitely to get our supply in the hands of our community. So the offering was kind of, if you were in the Discord just randomly, without warning, after this cutoff, if you were there beforehand, you had access to this equal, offering of tokens at a very low price. Like the goal was definitely, I think that with any like currency or money project, you need to have a very wide distribution of tokens among many different people. It gets tricky when you have too much centralization of supply. And so, there's definitely some downsides that I can talk about, but I think on an overarching level, it was a pretty good way to distribute out supply pretty equitably, and without too much nuance.
Actually, since we're talking about lessons learned, would love to get into some of the downsides or challenges that you've had, coming from that approach.
Yeah, so we launched at a very low valuation, which I think is really powerful. As Go was saying a minute ago, definitely bootstrapping a very strong community is a large boon for a project. That can be one of the most powerful things you can have. And so offering at launching at a very low valuation and putting that in the hands of your community is definitely a strong catalyst towards growing. But at the same time, if you have those valuations increase too much, it just is expensive on the market. And so that's definitely, there's just like a financial cost to it. With that, I do think that there are positives to that. It kind of reminds me of on the previous panel, Kobe was talking about with Bitcoin, like how it spent like years of different market cycles and people building increasing conviction. And I think a big part of that is just people's conviction being tested. A good way to have that tested, I think, is to have a lot of people that suddenly have way more money than they did a couple weeks ago that all decide that they want to sell at the same time. It really tests hands. So in that standpoint, it's definitely caused some pain for us, but I do think that it's hardened the community. It really weeds out the people that are there for a quick buck and the people that want to build something. If maybe they get that quick buck anyways, but at least you can get rid of them and kind of filter out people until you have a stronger group of people that actually care about what you're building.
And I guess actually I was asked to join in as the kind of moderator role, but also want to talk about my experience with YAM too. For those who may not have been around at the time, YAM was a project that when we launched, I guess it was last August. It was one of the early fair launches. We were very inspired by what Andre had done with Yearn and the Wi-Fi token just being launched not too long before. That was based on essentially early version of liquidity mining, just the Y curve pool, I believe. And I think we were the first one to then start including tokens from specific other communities that we wanted to have come in and help bootstrap the community around YAM. Shout out to Mechanism Capital and Ray Kwang. Our Andrew Kang. He did a fantastic job suggesting, I think initially, that we include Wi-Fi in there as one of the distribution mechanisms, not just to do USD. But while it was very exciting seeing like that mechanism really took off, and I think it allowed for relatively broad distribution across multiple communities early, it was still very capital intensive. People with more capital were able to get more. I think all of these projects that are represented here probably have come since and have found other improved ways of getting to broader distribution that doesn't weight things as heavily just on having a lot of capital. And so it's been exciting to see how people have improved on these mechanisms over the past year. So slipping back into moderator mode, I think wanted to ask maybe Stefan, for Alchemist specifically, or to the extent you're able to talk about any other projects you've been involved with, are there things about the distribution, either initial or any ongoing stuff, where you feel like this didn't work as well, and if you could go back with the things now, you would have done things differently?
Yeah, so it turns out like tweeting a token and doing zero marketing is like not the best way to get high engagement in your LBP. So I think one of the things Jeremy mentioned at the start is, most projects end up having a product out there and they sort of have an initial plan of what they're doing, and then they launch LBP and there's sort of traction that builds on top of that, and it serves a distribution mechanism or a fundraising mechanism. For Alchemist, it really wasn't about that. So the idea was, we have a bunch of tokens here, and they're sort of created from nowhere. All we're trying to sort of achieve is find a way to distribute them to whoever is interested in sort of the aesthetic of the project, so that then they can go on and determine what goes, where the project goes. So the thinking was, okay, there's 1 million tokens. We want to sell them all, so no pre-mine. And then every single ETH raised is just pumped right into a liquidity mining program. And the whole purpose of that is to provide then a channel for future participants who like the project and want to participate in it, to have the liquidity to be able to enter a position and contribute. So despite the LBP not in and of its own attracting a huge amount of attention, it seemed to still have attracted sufficient attention that it sort of bridged the gap to the next wave of contributors. So I think at the end of the LBP, there was maybe like a few hundred addresses, maybe less than that, that were holding the token. After that, once the liquidity mining program launched and all the ETH raised was circulated back into the program, that's really where it picked up, because with the added liquidity, it was much easier for additional contributors to participate. So I think that brought us from low hundreds of holders to I think around 5,000 plus holders, and that's really where we saw the big inflection point in the attention the community was having, and huge amount of interest. So still, at this point, not much really happening in terms of product development, but the sort of seed of a community was there, and from there it grew a bit more. So I think there's probably different ways to go about that that are going to make it easier for the LBP to be more successful. Right, like these reverse Dutch auctions can probably be run for a much longer time than what we did, which was like 3 days, I think. It was also launched at the time where I think gas prices were spiking pretty high. So even participation, I think, cost $50 to be able to send a transaction to the LBP and make a purchase. So there's definitely some gas efficiency that could be improved there. I know actually Jacob from Hydra did some pretty neat stuff to be able to compensate for the gas used during the LBP. That's maybe worth talking about.
Yeah, let's hear about that. I think that's worth talking about.
Yeah, hello everyone, I'm Jacob. I was helping to bootstrap Zprime Capital in early 2019. And as I was playing with all the DeFi protocols live in those days or upcoming, we were really missing something as a Hydra, something what would be like really community oriented. So I was like that annoying colleague of my other colleagues within the team, still pushing them to start building this. So I stepped down from Zprime in early 2020 and go mostly focus on building Hydra and our great community, which we have right now. So that's pretty much about me.
Jacob, so sorry, I forgot to include you in the introduction earlier.
Just to comment, I think it's very interesting to hear Stefan and the Alchemist origin story, and how the role that an LBP played for them, which is extremely contrasted to the way Hydra GX's LBP went. Both of them now have like very engaged, vibrant communities, and it was a good launch pad for them. But in Hydra's case, they had over 5,000 addresses that bought into their LBP. Like they had over 5,000 token holders after a 3-day token launch, and they raised over $22 million, and their LBP pool had almost 50 million in volume. So they had a very strong level of demand coming from their community, and they had a lot of awareness and a lot of public visibility for their sale.
Yeah, to be honest, sorry.
No, go ahead.
To be honest, we were like very shocked from the from immersive amount of interest about our LBP, because we were like little bit scared from too high retail participation, because there was still unclear if our Omni pool will be live soon, or when it will be live. There was also still some uncertainty those days. So we spend on marketing really $0. We refuse all marketing offers. We refuse any paid marketing offers. And still, despite that, and because of that, we were modeling. We were using this a great sheet for LBPs from Balancer team or from Perp about modeling LBPs, and we spent really a lot of time on the 2 weeks or something like that. We created hundreds of models, and there was no model which were even close to this, because we were trying to secure the lowest possible participation around raising 2 million. And then our median or optimistic or realistic scenario was something around 5 million, and then super optimistic was between 8 to 12. And when we saw even first days, it was crazy. But still, we realized how even LBPs which were trying to be set as much in favor of community could be like hard for retail users, and especially for the users who never interact with any AMM or with balancer, and during like very high gas fees on it.
Yeah, I mean, it feels like there's this this challenge with like you want to be inclusive with projects, and then there's almost like in some ways like too much making things too easy can be a problem sometimes. I know that one of the things from Yam that propagated a lot was that front end that was also an open source front end that Clinton Bembry had designed, and then like DeFi Summer, like every project started using that same front end, and it just made it super easy because people were super familiar with it and they could just ape in easily. And in some ways, like it feels like there may have been some benefits for like Alchemist and for Olympus with some of the things. Like it was not, it sounds like, easy to like necessarily discover this, and in some cases maybe even like participation was like just like a little bit more challenging. And it feels like that there's a concept there of like useful friction that may contribute to not only distributing something widely, but then like some semi-gating to people who like care enough that they're willing to take a few extra steps to figure things out. Would others agree with that? I don't know. Zeus, has that, have you seen that to play out? Or Stefan, yeah.
Sorry, Zeus. I love that kind of entry friction. You know, it's so much of UX design is about minimizing friction, but it completely ignores social psychology of creating an in-group when you're able to make people jump through hoops to be able to participate. It creates such a higher sense of belonging into a community, and so that friction up front for participation is like one of the strongest tool I think that early communities have to really get engagement.
Yeah, I super strongly agree. I feel like the ideal scenario is that you make it easy to like hear about it once, but you don't make it that easy to really dig into it and know what it is. So you know, it's on that person to really take that next step to like learn more, because, you know, I think especially doing that prior to like any money being involved, where, you know, you're learning about this and getting interested just off of personal interest, I think has much more longevity than like, you know, if you're really just trying to throw in people's faces like, oh, you know, you could make money doing this or whatever.
So another piece, and maybe, and this is, I don't know how much relevant this is to every project, but in a lot of cases, right, the goal is not just distributed ownership, right? The idea is that these are communities. We do want people actively contributing, and there can be an issue of like essentially like free riders, right? If people hear about it, they tend to be just like good about hearing about projects early and just like they've got capital, they invest some in, but then like, are they going to contribute to the growth of that versus not? I'm curious, you know, for any of you, I know, well, actually with Balancer, I know you've got the Ballers program to kind of like incentivize community contributors on an ongoing basis, but how do you guys think about this kind of like non-financial contributions? Because in some ways, those who don't have capital to put up but are willing to put in effort, they're maybe like the hardest to find and the most valuable contributors. So what role does distributing to those types of folks play into how you think about fair launches and community growth?
In our case, we were very much aware of all the help which we got much more early before LBP from some key community participants. So when we launched our grant program, which is called New Deal, we encouraged them to like really put the proposal where they will highlight all of their contribution, non-financial contribution, and we were happy to let the governance vote, and like basically all these like votes pass very easily, because also everyone was really aware about their added value during like really like early days. So many people in our community which were with us from like early days, they they got pretty decent rewards, like much bigger than they would be able to buy in LBP, and that was our goal. Also, what helped a little bit with like Gini coefficient was when we made the gas reimbursement, as Stefan was pointing out, when we saw how big issue was, like, for example, failed transactions because of like slippage limiters on balancer, which was not their issue. It was also not issue of balancer, because the buy pressure was so high. Like when their transactions were waiting in mempool, some other whales or some bigger participants moved the price too much. So many people who, for example, were contributing like 200 DAI, all of their costs were like 500 DAI or something like that. So we made like analysis of all of these gas spendings and all of these failed transactions, and we realized that this could help with distribution also a little bit, and like increase the Gini of our ownership.
This is such a weird thing that we see even with NFT launches now, which is like people are spending thousands of dollars on gas to just get reverted transactions. And it makes me so sad because it's really not necessary. There exists plenty of tools that you can do to be able to prevent that from happening. I think usually with these like LBPs, probably that's a signal that the initial price was not high enough, right? If people are still aping in and bumping up the gas price. But in general, setting like absurdly high initial price for the LBP should be like the standard approach, because you completely get around these gas issues. You can do other things like use flashbots for routing the transactions, and then you never get reverts. I haven't seen anyone launch a project using that, but I think it would be like a neat approach.
I think
that's
it was
something we might see from the Alchemist community.
Sorry, Stefan. I think Pendle Finance.
I don't know. We'll see.
I think Pendle Finance, they used flashbots during their LBP.
That's cool.
I'll have to check that out.
But there was one small mistake, or they had same issue what happened to us, that they didn't deploy even their LBP contract via flashbot. So their launch was like front run, and the same happened to us. So there was like small FUD about our launch, that someone from like internal team is like trying to push price even higher. So whoever do the LBP, like I would advise them to even like deploy contract via flashbots.
Okay, so we've got two very concrete pieces of advice. If you're using a liquidity bootstrapping pool or any other launch mechanism like this, if you don't want to advantage those who are, I would say, like playing with advanced technical tools, you should yourself, the project deployers, should deploy via flash bots or some other mechanism that gets around the public mempool, so it is on chain, and then people will see that after the fact. And also start with an absurdly high, whatever you think is like an absurd price. Just like start at like 10x that, and launch at that price within liquidity bootstrapping pool, so that it has space to do what it's intended to do and allow for price discovery. Are there other best practices? So that idea of the Pendle team using the flash bots so people don't have to pay for the reverts, that's a cool thing. More people should do that. Are there other things that folks have seen projects other than their own do that you're like, oh, that's really cool, more people should use this?
I think what we realized, and what was also advised by PERP team very early as they pioneered the LBPs, it's like, don't be afraid, set higher trading fee in your LBP, even something like 2 to 5%, because you don't have like any secondary market for your token. Like it's not an issue, and actually it's like very beneficial for you, as if you have like whales playing these like whale games even during the LBP. It just means that they will leave much more liquidity for your token later, because like 5% or 2% from 100,000 buy is something much more than obviously from the like 1,000 purchase.
Jeremy, have we seen people do that? I know it's possible to have dynamic fees, right? A lot of the pools now have Gauntlet managing fees dynamically, but for liquidity bootstrapping pools, is that something that you guys could like make standard practice? Maybe start fees off at 5% on the swaps, and then as you're adjusting the pool balances, also adjust the fees down over time as well?
Yeah, so as far as like starting LBPs with high fees, that's becoming a more common practice, and it's something that we have suggested to teams, because it has the effect also of like either deterring front running or just like really capitalizing off of front runners that get involved, like by setting a really high swap fee at the beginning, when the price is like way too high for people to logically buy it anyway. I like that idea of, shifting fees as weights shift. That so LBPs are being launched on Balancer V2 very soon. They haven't been released yet on Balancer V2. All LBPs so far have been on V1, and with that, dynamic fees can be utilized for purposes like the idea that you mentioned. So I would love to see someone experiment with that.
Awesome. And if you do tag folks in this panel, we'll help get the word out. Be a good experiment. Zeus, you got some to add?
Yeah, this one's a little bit more intangible, but goes back to what we were saying before, where like, I think give information on what you're doing, but like try not to kind of hype your launch. I think the high fees in an LBP kind of fit into like, there's a classic rule in like VC where you never want to have a down round. We have these like 24/7 perpetual markets, but you can still have the same effect where if you're launching too large, there's kind of only downside, and it's very hard to recover from that. You want to kind of start on a strong foot with like people who care about what you're doing, and not so much just trying to like ape the launch event and then dump on a pump. So I would just say like try not to go full like marketing cycle on a launch event. You can save that, I feel like, for when you're actually pushing things and not so much just launching a token. Probably results in a better community, I would say.
I have another point to share as well, which is actually I think it should be part of the process of planning and setting up your sale, is what is your optimal strategy for migrating liquidity that you've raised right after the sale ends. Like what's the next step as soon as your LBP is over. And I wrote a piece about this recently, making a case for Balancer 80/20 pools, creating an 80/20 pool between, for example, your token and ETH, 80% token, 20% ETH. The reason for this, there are several reasons for this, but I would say primarily, to summarize, it's like when you take your IDO funds and you use them to seed a 50/50 liquidity pool, for example, on like Uniswap or Sushi or Balancer, you're putting your newly minted token holders in a tough spot where they have to try to choose between supporting your project by being a liquidity provider, which involves the sacrifice of like high and permanent loss risk. And if they don't have the counter asset in abundance, then you're asking them to like sell a significant percent of their tokens immediately in order to be an LP in the pool, or to just hold on to their tokens, not be a liquidity provider, not contribute that value to your project in being an LP, which is really important. The liquidity of your token is a really important component of like the long-term success of your project. So as an alternative, creating an 80/20 pool on Balancer means that you can provide a better sort of impermanent loss risk, improved risk of impermanent loss, and allow LPs to still maintain heavy exposure to your token while at the same time making that decision easier for them to be a liquidity provider and contribute in that way.
Probably the best example of that, or at least the largest, would probably be Aave, where they've actually incorporated that into their kind of like staking, their safety module, using those 80/20 BPTs. Yeah, I'm a big fan of that approach. I want to see more projects like using the 80/20 pools as a way of doing governance, because it lets you keep a lot of skin in the game with that particular project. It's also helping support the project long term and allow for new entries because you're providing liquidity and not just keeping it entirely off the market.
Right, exactly. You know, you're looking to, from the project's perspective, you're looking to get people off the sidelines and into, you know, market making for your token, but you also want them to feel that they still have significant skin in the game, and they're going to be there to support the project through its ups and downs, and they're going to contribute, and they're going to have that incentive to be an active, engaged community member. So when you can have both, that's the ideal scenario. Last point, you know, as you mentioned, there's a baller committee within Balancer, which they govern. They're in charge of a lot of important decisions in the community. One of them is they govern liquidity mining incentives, and they've just started sort of a new initiative where they are prioritizing projects that have done an LBP to receive liquidity mining incentives if they migrate their liquidity into a Balancer pool, such as an 80/20 or whatever the weights may be. So even more of a reason to take advantage of that.
Stefan, I think you had something to add there.
Yeah, Dan, I was wondering, I learned a lot about fair launches and liquidity mining from the YAM experiment. I'm wondering what you learned from it.
Thanks so much. I think a lot of it has just been it was foundational for a lot of what's happening today, but we've moved so far beyond that. When I see folks now try to do like single asset staking, it's just like, why are you doing that? That's like, you're like an entire cycle or 2 or 3 behind now. I think the idea of using liquidity pools as a way that you are thinking that you're incentivizing primarily makes a lot of sense. We had a pool too. There's others making use of it. I think the 80/20 thing makes a lot of sense. I think one of the things that we learned was that was intentionally at the time. It was meant. We did not view that as like it was going to be a going concern. It was kind of like a short experiment. I think if we viewed it as something that was likely to continue a long time, we would have maybe approached it very differently. Doing the very fast distribution, I think Yearn had just done one that was very, very short, but giving a huge amount of tokens away with only like opportunity costs being what's paying for them too, I think is very, very tough. You end up with a lot of very concentrated ownership in the hands of people with a lot of capital. And it doesn't necessarily target it towards the people that you want and who are going to be there long term. So I think the biggest lesson to me is like, if you want a healthy community, it's really helpful if you can distribute over a longer period of time. Having that organic growth that Zeus talked about is really helpful. Like we had a ton of hype and that made it really, really hard. So you want to try to keep, if you believe in what you're building and you're really trying to like make it last and like become something meaningful and significant, like none of these projects matter the day they're launched. They only can matter like months and years into the future. So having low hype initially is fine, and just like keep delivering, keep executing, keep building out the community. I think that tends to be the hallmark of like truly great projects, is that they try to stay as close have the hype match as closely to where they actually are today as possible. You don't want to get out over your skis. So I think we're basically at time. I mean, are there any like, let's put out a request here for folks. Are there any tools, right? We've talked about a couple best practices. Are there any tools, things built, mechanisms that you think need to exist, and if they exist, will help lead to better and more fair launches for projects?
I can make a couple plugs. I think the Alchemist ecosystem is trying to build a lot of tools that make doing fair launches a lot easier. I think one interesting one is the Copper Launch, copperlaunch.com. It's just a UI built on top of Balancer LBPs that just make it sort of a cleaner experience for participation and launching. Really interesting there is you can look at the history of all the LBPs and see how the configuration worked and how the price action sort of came out of it. So it's a good tool also if you're just like looking to do research on how things work. The other tool that I think projects should consider when considering a fair launch is inflation. I still think inflation as like token economics is very underutilized in the space, and a critical part of transferring value from early contributors to later contributors and providing a lot of longevity to a community. So I think that's something people need to experiment with a lot more.
From my point of view, what would be easier to get, and there are already some solutions for it, are like time locks for liquidity mining. So people needs to lock their liquidity for some like certain or maybe uncertain longer period of time, because really most of the liquidity mining initiatives which we could saw in like last year, they were like very wasteful and they lead like very concentrated ownership, as Dan mentioned. The something more advanced, but I'm not sure how how feasible would be something like social graphs of people who were like important in early days of protocols. So they would have like some bonus ratios in liquidity mining if they were like voting a lot in governance, or if they would be like recipients of like very successful governance proposal or something like that. Because the other issue with all crypto currently is like very low voting turnout. So it would be great if we can somehow indirectly motivate people to vote more and participate more.
I don't want to like toot our horn too hard, but like, I do think that, our bond mechanism is quite cool as an alternative to pool 2 for projects. So this concept that like, especially early on in your project, the goal is just to kind of get your token into the hands of people. But you have this issue with pool 2 where, that and kind of any incentive scheme where like, if you're dependent on these incentives in perpetuity to enable your protocol, then you're kind of just running on a treadmill where like, if you discontinue them, then you lose whatever like baseline thing you need for your protocol to work. So, with these bonds, like, it fits pretty well in an early distribution scheme where, the protocol can just purchase, the liquidity that it needs or whatever. And then now it has that in perpetuity, and it can actually be a productive asset for the protocol, because like, especially, if it's your own tokens pool, anytime people trade in that, the protocol is earning fees back. So we're actually working to get a tool out where, other protocols can pretty easily implement that. And I'm hoping to see, it start to get utilized. I think it's a cool model versus pool 2.
And so for those who might not be as familiar, what you're talking about is people essentially receiving tokens in return for transferring ownership of LP shares to the DAO. So then the DAO itself owns ongoing liquidity for the project rather than having to continue to pay for it in perpetuity.
Yeah, exactly. So on the protocol end, it's a little bit more of an upfront cost, because it's not paying some APY or APR. But for you, the participant, you're getting access to the token. It's providing you liquidity, and and on the protocol end, now it owns whatever that asset is.
Awesome. Okay, well, I think we are slightly over our scheduled time. So want to thank the Fair Launch Summit team for having us and letting us participate. And yeah, we're looking forward to catching the rest of the day.
Thanks a lot for joining, guys. Such a great chat.
Yeah, thank you.
Okay, so next up, we have a panel on regulatory risk and compliance. And on this panel, we have Gabe from Delphi Labs, Raphael from the Crypto Lawyers, Omakase from Sushi, and Ross from Sushi and LexDAO. So they're all just joining now, and we'll let them take it away once they're live. Hey guys, can everyone hear each other?
I can hear.
Awesome.
I can hear you.
I'll jump out now.
Testing.
So it looks like we're missing Sarah. Just make sure.
I like your lighting, Gabe.
Thank you. It's what do they call these? Fried. It's deep fried. That's right. Like the memes with like the super like lasery, distortion, right? They call that. I think they call that fried or toasted, right?
Nice and toasted.
Yeah, like this. Oh, you can't post.
Yeah.
That sucks. Well, I'm trying to find Sarah.
Oh, she's right here.
Oh, there we go. Okay, dope. All right, cool. I guess we're ready then. So do we just start, Daniel?
Yeah. Feel free to take it away.
Great.
Sorry.
Awesome. I didn't know we were live. Okay, cool. So this is a panel on regulatory issues regarding fair launches. I will be moderating. My name is Gabriel Shapiro. I'm currently general counsel at Delphi Labs. I've been a crypto lawyer of sorts for several years now. And before that, I was primarily a mergers and acquisitions attorney for technology companies. And I'll just go around and have everyone introduce themselves. So Sarah, brief introduction, please.
Sure. My name is Sarah Brennan. I've been an attorney for around 13 years now. I also started my career doing M&A work and venture capital work. And I do a lot of capital markets work as well. And I've been involved in a legal sense in the blockchain space since around 2017.
Nice. Ross.
Yeah, sure. So Ross Campbell, I work as a contract developer with Sushi Swap. Before that, I was a legal engineer with the Open Law Project through Consensus. And before that, I was a corporate attorney, mostly doing kind of startup work, shareholder litigation, and a bit of bankruptcy. Yeah, that's it for me.
Cool. Omakase, I'm not sure if I'm pronouncing the name right, but.
Yeah, that's correct. I'm a developer with Sushi Swap. My background is more in machine learning engineering, and have worked on various algorithms and for and standards on algorithms regarding legal approaches and how all of those can be made into more fair algorithms.
Very cool.
For general usage.
And last but not least, Raphael Jacobi.
Hey, Raphael Jacobi here. I'm the principal attorney at the Crypto Lawyers. I've been practicing, I guess, for about 5 years, and a majority of that has been in the crypto world, doing exclusively crypto work. But my background in law school and after law school was in securities litigation, and then it was kind of a natural progression because of the overwhelming demand for securities lawyers in crypto.
Right. Great. Okay. So what I'm going to do is I'm going to ask a series of questions, and I'll direct each of those questions to a specific person or persons to give sort of the initial response. But the rest of the panel should feel free to jump in with additional commentary, and we'll just kind of riff off of each question. So my first question is initially to myself, which is what is a fair launch? Particularly, what is a fair launch in the context of regulatory risk, compliance, law, et cetera? Are all fair launches equal under the eyes of the law, or is there a spectrum of launches that might be described as fair launches? And if so, what might be the legally important differences among different types of fair launches? So, to answer this very briefly, because, we've had a whole event where people have already talked about this, I do think that the term is ambiguous. I think the previous panels during this event, show that it's somewhat ambiguous. But the basic idea behind a fair launch is, I think we could say safely what a fair launch is not, right? A fair launch is not a situation where someone sets up a company that hires a bunch of developers or has a bunch of developer founders, and then goes out to venture capital firms, has them invest on a private basis, gives them token allocations based on the amount that they invested relative to evaluation, and then ultimately gives them those tokens either at the same time as the token gets distributed more widely to the public, or at a later time, or whatever. That's not a fair launch. But other than that thing that definitely is not a fair launch, there's a range of things that sometimes are called fair launches, and they might be more or less fair. The ultimate, one of the things that's considered sort of like the canonical fair launch, right, is Bitcoin, right? And I actually think that's somewhat debatable, right? But with Bitcoin, there were no investors in Bitcoin. Satoshi just kind of launched it, and the only way you could get the token is by mining, right? By contrast, Ethereum was launched very differently, right? There was a so-called pre-sale, right? So, Vitalik and others who were working with him, first of all, they decided that there would be some pre-mined ETH allocated among themselves because based on their sweat equity, essentially, and that also some people could pay money to get ETH. And so when it launched, the Genesis block has allocations to various addresses that were controlled by those people, and then from that point on, the only way to get it was basically by mining, right? So that's probably not considered a fair launch. But we're going to talk more about this. So why does this matter? Why is a fair launch legally distinguishable from like a venture-backed launch? Well, it turns out that the classic venture capital cycle is a more regulated thing, which we'll talk about. And so that's why all this is legally relevant, and why fair launches might be treated differently under the law than ordinary, venture capital cycle type launches. So does anyone else want to chime in on any of that before I move on?
I mean, I just want to briefly, there's a parallel to VC or early stage, which is a crowd sale, right? So you have to draw those analogies that there are securities laws that apply to crowd sales. And the earlier stage you are, there's factors in terms of, that the SEC put out in no action letters in this space that, could potentially apply if you're still building and that sort of thing, and you need the money and you're using it to sort of build out your products. So, it is not a VC raise, but we do have a parallel in securities laws.
Right. So I think the next question is directed.
Wait, Gabe,
sure,
sorry to interrupt. I do want to add one thing on the fair launch topic, only because I totally agree with what fair launches are not, and also that with Bitcoin it's debatable, but luckily it was mostly an experiment, and so that helped. And with Ethereum, not that fair, but it is what it is at this point. But I do hope that maybe we can try to construct something. It doesn't have to be a definition of what a fair launch is, but at least the principle that fair launches are trying to accomplish. And I think the principle is that they're aiming to be more decentralized or closer in the spectrum towards decentralization by not having one party who has overwhelming amount of power that they have so much power that it'll never be decentralized.
Right. More economically decentralized for sure. Yep.
Right.
Based on token distribution. Agreed.
Yep.
So the next oh, go ahead, Ross. Sure.
Oh yeah, no, I was also
we're gonna hit on a lot of these issues.
Yeah, I don't want to jam up the works, but
yeah,
maybe we can also distinguish between a launch of something like Stoner Cats, like an NFT project, versus a launch of maybe something that looks like network equity, where the token entails some sort of like access or actual like governance rights. So we can get to that in this call though. Yeah.
Cool. And how was the Stoner Cats launch done?
I think it was basically like whoever could kind of front run and sort of send ETH through the contract got sort of first come first serve mints of these NFTs, like a lot of other sort of these mint to own NFT projects. But I'm not gonna say, since you're more of a degen than I am, I don't know if I missed any important details there. But yeah, I think it's kind of one of those technical fair launches or something.
Got it. So it was technically a fair launch, but it was front run. Your point is, and due to the systemic factors of Ethereum, that particular structure actually didn't turn out to be very fair. I take it that's your point.
Yeah.
Cool. Okay, so we're going to hit on a lot of these themes, I think, as we get deeper into these questions and what really is fairness in these contexts. And maybe there is no such thing as fairness, right? I think that might be one of the points here. So, Raphael, I'll direct this question initially to you. My impression is that within the crypto law community and really the crypto community more broadly, I think people have a rough sense that fair launches, like the initial Bitcoin launch, perhaps like the Yearn/Wifey launch last year, which happened very rapidly in a week, and the team didn't keep any supply, and so on, are less likely to be heavily regulated than something like an ICO, right? I think that is a rough sense that exists in the community. And in the most extreme form of that, right, not only is there no venture capital allocation up front, but there's also no allocation to the development team, right? If they happen to be poor and the only way to participate is to buy, then the development team is kind of out of luck in terms of getting the tokens of the thing that they themselves built, right? So because of that, right, there may not be a common enterprise between the developers and the people who ultimately wind up with the most skin in the game. And although from an incentive perspective, that's absolutely terrible, because you want people who can build to be incentivized to keep working. From a regulatory perspective, that's very helpful, right? Because under the securities laws, we have something called the Howey test. One of the elements of that test is whether there exists a common enterprise between the issuer of the tokens and the persons who are purchasing the tokens. And if those people don't retain tokens, then it's harder to argue that there is a common enterprise. So it's not very likely to be a security, right? But on the other hand, things can get more subtle, right? Because even without outright keeping pre-mined tokens, a team can have subtle advantages, regarding a quote-unquote fair launch. For example, in Satoshi's case, he was able to mine on the network very early, and as a result, whoever Satoshi is has a lot of Bitcoin at his or her address. And so in a certain sense, that's unfair, right? He had a big early advantage. But on the other hand, it just comes from the fact that no one else was really interested in doing the mining, right? And there are more subtle forms of that. It's very hard to get that situation nowadays because everyone knows tokens have so much potential upside. But there are still examples of ninja mining, or teams could just be positioned to set the rules in a way that they quietly know favors them. For example, they could just not publicize a liquidity mining opportunity very broadly, right? They could just tell their friends about it, right? And then, they launch the liquidity mining, it's over in like a week or two or something. And voila, pretty much it's mostly their friends and people they like and themselves who have the token. And that could potentially be a form of unfairness or a form of ninja mining, right? So it does get subtle. So my question to you, Raf, is there in fact rough social consensus among lawyers and other participants in the community that fair launches have lighter regulatory burdens? If so, why is that? Is it a correct consensus, or is it just based on generalities and stereotypes that may not capture the full reality? And is a fair launch really that different from a legal perspective from a pre-mined ICO?
Great. Okay. Good question and good context for the question. So as far as consensus, I do think there is a rough consensus to the that a rough consensus that being fair is better and a fair launch is better, and that there's less regulatory risk with fair launches to the extent that we're using the definition that we just talked about a couple of minutes ago. So if we use that definition, I think most lawyers would agree that there's less regulatory risk to the extent that they also agree that every potential way you could do something is just a point on a sliding scale of decentralization and regulatory risk, right? Maybe some people take a very simple black and white approach that like they're all a major problem, right? And it's not, and that there's not that much nuance. And there's probably a bunch of conservative lawyers that would just say it's a non-starter and there's no point in even getting into the nuance about it. But I think for most lawyers in the space, because it's impossible to practice if you don't agree with this, you have to accept that there's just some things are riskier than others and some violations of securities laws are more or less egregious than others. Even if the law may not really take that into account, right? And there's not an intent requirement, right, for Section 5 or anything like that. So yeah, I do think there is rough consensus, and something I've been thinking about in the context of fair launches is what you mentioned about balancing skin in the game and decentralization, right? Obviously, you want decentralization as a means towards censorship resistance, right? It's a necessary end game for DeFi, I think. But you need skin in the game for good governance, right? I think you need skin in the game for good governance, or at least it sounds right. Who knows for sure, right? But so in the context of a fair launch, the major challenge that project creators have, or early contributors, or whatever you want to call them, is that they basically have to forfeit power to people that don't have substantial skin in the game for purposes of making their way towards decentralization, right? And then going back to something we've talked about for years about sufficient decentralization, this just came to me in the last 3 minutes, but maybe one could say that sufficient decentralization is achieved once a project is censorship resistant while still being governed by people who have skin in the game, right? When you get to have both of those things, right? When it can't be shut down, but it's also not governed, by just one central group, and it's governed by people who actually have a stake in the outcome. Also, one last thing I want to add, it's not my background, it's my camera, right? Because I don't want to be on camera because my apartment is too messy. But if you look at the background, I don't know how much you guys can see, I feel like this view is a good maybe analogy, not an analogy, it's a visual analogy for the regulatory environment, right? You have a little bit of sun peeking through the clouds, and then you have like a darker part of the sky with more clouds, and it's kind of a light rain, right? And you don't know if like shit is about to hit the fan or not, right? Is the sun going to come out in 5 minutes, or is it about to be a crazy rainstorm? So, well, just thought that was interesting.
Yeah, my view is a little, I'll go dark with this, right? We have some clarity around these 3 stale restrictive no action letters, and we have the sufficient decentralization test that the SEC and the Ripple case is now saying, we didn't do that. Hinman was on his own. We weren't even involved. He didn't even talk to us. So we're all like in the middle, in this beautiful marina here, just floating along without any guidance on like what the proper path forward is. But I really think how it plays out, just to be the pessimist of the group, is that, Gensler is a functionalist, and Gabe has a really great article on this, but he uses a duck test. And if something looks like a security to him, if securities laws would fulfill their legislative purpose by being, applied, then he will apply them. So everything seems like a security to him, or a duck to him, right? And he's made the point, even if it's a robotic duck, and you can argue I'm a robotic platypus, and he says close enough, I'm going to go after the project and check it out. So I feel like the sort of regulatory layout here is that the SEC pursues, a decent amount of projects that have noisier launches. The benefit of a private launch is that it's quiet, it's done not in the public view. So there's just, among all this uncertainty, and I don't know that the SEC has picked a path forward here. We're subject to that,
Yeah, I think something that could be helpful in thinking about fair launches is, does the manner of distribution change the equation of the harms we perceive with how these tokens are distributed? I think the larger goal of sort of securities regulations are to close so-called info asymmetries, where you have a core team that is privy to special knowledge. They're the only ones that bring products to market and actually give tokens value. I think in those contexts where there is sort of unfair distribution of advantages in a launch, you can't really call it fair, and it's therefore more likely to be a regulated sort of instrument. But I think the goal here is to create a sort of new type of company or community where people have ownership stakes, but they're also on fair footing. So it's kind of a combination of like skin in the game, but also a sort of like flat distribution of power. I think we're seeing that evolve, and I hope that gives regulators some pause that even though there are these financial transactions that might remind them of, sort of a equity sale, that the actual relationships are a bit different. And what might be different here is this sort of like social graph of ownership. It's not just a core company that's selling tickets to some product launch or something. So maybe that's something we could examine is the manner of a fair launch aimed at sort of alleviating some of these issues and goals of securities regulations, even if we can't get a sort of safe harbor. What do we think the appetite is here? And I kind of like your idea, Gabe, that regulation is a forcing function for teams and communities to actually figure out if they're truly decentralized. So maybe fair launches are an attempt to sort of do a truly decentralized new type of company that like we really don't have as much reason to regulate. So that's a larger topic, and you guys have written a lot about this, but kind of throwing that out there, like, are we able to automate away some of these perceived risks, right?
Yep. Yeah, totally. You make a good point. And certainly one of the SEC's, yes, there's a disclosure regime, and the fact that you did a fair launch doesn't mean that you did good disclosure, but it does lessen the chance of investors having economic harm, right? Because there isn't this structural discount structure built in where VCs have like a specific exit price above which they're making a profit and below which they're not making a profit. And it does seem to me that if we were to reform securities laws to recognize the different risk in the fair launch scenario as a result of that versus the non-fair launch scenario, it would be smart. So the next question is to Ross and Umakase, who are the true builders here. The two of you are active builders in the SushiSwap ecosystem, and SushiSwap has a very interesting history, which I'm sure most people are at least superficially familiar with. And just to talk about the present day, as I understand it, there's no SushiSwap tech development company, unlike Uniswap, which does have an entity. And correlatively, there are no venture investors in SushiSwap's tech development in the classic sense. In other words, it didn't start out as some people with a company. VCs didn't buy equity in that. They didn't buy tokens in that. There was recently a proposal in the SushiSwap forums that VCs might buy some sushi out of the Treasury, but that's different because the project is already mature. And it wasn't proposed to come along with elaborate information rights and governance rights and all these things, right? So SushiSwap is different. And could you describe a bit more about how SushiSwap, based on its history in the present day, fits into the spectrum of fair launches, how that's impacted the legal setup of the project, for lack of a better word, and what your experience of that is? I assume that you guys don't have invention assignment agreements like most technology workers do. You don't have non-competition agreements like most workers do. You don't answer to a CEO like most technology workers do. So I would love to hear more about that.
Sure, I could start and then turn it over to Omakase to add some more color to this. But yeah, I think Sushi Swap started off as a pretty eccentric project. In the fair launch sense, it was kind of an offer to Uniswap LPs to join a different set of smart contracts and get rewards. Or some people consider that a vampire attack, but for me, it was more this kind of offered to the community a kind of fair play notion of, if you add value to this system, you get these sort of tokens that don't have any specific rights attached, but they represent maybe some sort of stake or a way to account for value added to this system. From that sort of chaotic start, I mean, we had an anonymous founder, Chef Nomi, who I think stirred up a lot of chaos and created a lot of mixed feelings about the start of the project. But kind of it started as almost like this experiment in crypto economics that has now grown into a sort of like multi-billion-dollar project. But what I think is unique here is, like you said, Gabe, there is no sort of no Sushi Swap labs, or there's no sort of formal tech development company. We are kind of, to use a term that Omakase has used, a contract organization where we have different smart contracts that are allowing developers to coordinate, such as the Sablier streaming platform for payroll. We have multi-sigs that allow us to coordinate as well. And then we're kind of coordinating with these other sort of contracts. We have a Treasury multi-sig that was elected on Twitter, which I think is pretty unique and idiosyncratic. And from that sort of primordial stew of like interests that were kind of united by this Sushi token launch, which is just like enter our system, swap, trade, do these things, you get almost free money, valueless governance tokens. From there, we've seen a sort of progression as a team that we're still developing and coordinating with token holders. But like you said, there's no invention assignment agreements. There's no sort of formal policy for how that relationship should be carried out. It's still, I think, very kind of day by day. But yeah, no, Omakase, do you have color you might like to add? You're there from kind of the get-go, I would say.
Sure. I think, out of all projects, Sushi Swap could arguably be denoted as the fairest, if not the most decentralized project out there, just by how it got its start. Every developer was from the community. The community is still actively participating. Regarding information transparency and asymmetry, right? All of our repos are, GLP 3.0 open source. Everybody can see our commits. We even have some dedicated Twitter followers who are tracking every single commit that we push up, right? So building in the open is, kind of this new paradigm. Working in the open, anybody can, if you have experience with GitHub, anybody can, make a fork and open a PR to add a feature. All these discussions are being discussed openly, right? In all sorts of, on our forum, on Twitter, on our Discord, etc. So there's really this, as Ross called it, this kind of stew, right? Where everything's just kind of fluid and fluctuating in motion towards kind of this goal to create kind of this ecosystem. And I think what's super interesting about this ecosystem is that it really does give us the ability to kind of define standards, right? Because our community is so expansive and et cetera. We can kind of, everybody's, every contributor's, best interest is at heart, right? Because like we had such, kind of a tumultuous, or you could say an eccentric start, right? Everybody who's been, contributing and actively, working on the project since then, there's definitely mission guidelines to say, hey, how do we prevent something like this from happening again, right? How do we, how like what sets of contracts or infrastructure, right, can we bring up that kind of makes fair launches possible, but also, can, kind of set the standards around, safety, consumer safety, et cetera, right? Because, DeFi, unfortunately, is very, very, very new, right? It's kind of the Wild West. And Sushi, we host so many projects that it really gives us the opportunity as an ecosystem and as a community to kind of define like, hey, here's how, projects should be launched, and here are the certain protections that are applied to them, right? So internally, right, like internally within the community and, you know, on our infrastructure, et cetera, right, there's a lot of like opportunities to kind of enforce these, you know, what we would call like, you know, safety standards and, you know, contract safety standards, because there are good ways to write contracts. There are malicious ways to write contracts, right? Obviously nobody wants malicious contracts. And, you know, one way, you know, at the end of the day, why safety is such like a paramount, you know, paramount objective in the open source space is because all your contracts are out there for everybody to see, right? If you're malicious, people can see it openly, right? If you're trying to do good, people can see it openly, right? It's kind of not like these older paradigms or older regimes where, you know, for example, Google can claim do good, but there's some kind of information asymmetry into whether or not they're actually doing good internally. Whereas on the contract side, you can physically, and everybody in the world can physically see whether or not the contracts are doing good. So that's basically, I guess, what it comes down to. You know, it's a very fluid organization where, you know, contributors are coming and going, and, you know, contributors are adding to the project and adding certain features, you know, even if it's a bug fix, even if it's a feature recommendation, right? The community.
That's very cool. And did I hear right that you guys don't use private repos, that the GitHub repos are public, or are they mostly public?
Individuals probably have their own private repos, but all of our like live production, you know, most of our main repos, right, our main contracts and also like main interfaces are all open source, right?
That's fantastic. All open source and also all public, so that people can see, you know, that you're working on future features that haven't been deployed yet, I guess.
Definitely, yeah. You can see our feature branches. People track them all the time. It's a little stressful, right? Because at the end of the day, sometimes, you know, competitors, you know, or competing ecosystems are definitely looking at our repos, and we welcome them, right? Because at the end of the day, it's not so easy to just like clone software and run it again, right? Because we truly believe at Sushi, right, we have such a dynamic, vibrant community. You know, you can't copy that. That's not a control C, control V kind of operation.
So community is really your mode, and therefore you're quiet. You don't need NDAs. You don't need trade secrets, and you build openly. You know, when a corporate securities, you know, type of lawyer hears this sort of thing, you can't help but think that it shouldn't be shoehorned into, you know, the traditional regulation, right? Because, you know, it's really not a business in the traditional sense at all. Yes, people are making money from it. You know, the smart contract charges fees, and you know, Sushi holders can get you know, a percent of that. Ex-Sushi holders can, that is, and the devs obviously get paid for their work in one way or another. But it's just so different. The information asymmetry. You don't need to do quarterly SEC reporting because everyone can look at the blockchain and see exactly how much the smart contract is making. That's its revenues, right? It's at least its gross revenues. They can also see how much the Treasury is spending, and they can even see what you're building basically in real time. And so it would just be that is fair, whether it's launch or just maintenance. It's sort of like fair maintenance or fair operation. It goes even beyond fair launch. And you know, it would be quite unfortunate, you know, if regulators tried to stamp out these immaculate conceptions like Sushi Swap, where you can't really plan for it, you can't buy it. A bunch of people came together, they just loved the community, and they've kept it going in accordance with a set of values very transparently. So I think that's really fantastic, and that's what this is all about. So Sarah, my next question is to you, and I guess a little bit to myself. As we just heard from Sushi Swap, you know, there's a certain tendency of fair launch projects to also end up being no company or DAO only projects. This is true of Yearn as well, you know, which is also a fair launched project. So, you know, these projects have sometimes been described as a lawyer's nightmare because there's no entity. Could you tell us a little bit about why this situation might be considered a lawyer's nightmare? Tell us about what it means when people say that DAOs or multisigs might be general partnerships and the consequences of that. And tell us, how do you allocate liabilities in a DAO? What if you merely work for a DAO, but you don't vote in it? What if you vote in it, but you don't work for it? What if you hold an infinitesimal percent versus holding 10% of the token? Does having an entity to make lawyers feel better carry downsides in terms of legal risk, or is it pure upside? So it's a no-brainer. You should always have an entity. Tell us your thoughts.
Sure. So on the lawyer's nightmare part, you usually try and identify a client. It's very easy to establish your ethical obligations. When you have an entity, it's to the entity. In this space, if there is no entity, you do end up usually signing an engagement letter with a specific team member. And there is a stressful worry that at some point, if there is an enforcement action, or if those incentives become sort of misaligned between the person that you represent and the rest of the project, that you no longer know which way is up as a lawyer. And you can kind of play that out, that if there was an enforcement action, your client, is singled out by regulators, who's funding your bill? Are you representing your client's best interest, which may be to settle, which would be really disadvantageous to the project? So it's stuff that you kind of have to figure out, hopefully in advance of representing the DAO, and whatever model you work with through that. And then I'll do the lawyer as boogeyman with the general partnership nightmare stuff. So this is the premise of this, is that you have inadvertently formed a de facto general partnership, and you, through some nexus to the DAO, now have unlimited liability for the acts and obligations of the DAO. And that can kind of play out through tort claims, someone suing you, and therefore your personal assets, because you have unlimited liability. And you would be forced to seek contribution on the back end if there were a judgment from your fellow anons, that if you can find them. And so that sucks. But whether that actually plays out, there's a lot of uncertainty around how it plays out, and to the extent
And just to put a little flesh on that, because I think it's good that people have. So what you're talking about is something like the following scenario: a smart contract is deployed by a loose association of developers who are paid by a DAO. Might be Ross and Omakase here, for example. They deploy a new Sushi Swap feature, and turns out there's a bug in the code. There's an exploit, and someone exploits it. They drain a lot of liquidity, and that money is lost. Right. There's no insurance. The users can never be compensated. So the users are furious, and they're like, Ross, you were negligent. Omakase, you were negligent.
My nightmare.
How could you develop such bad software? And we're going to sue you. We want our money back. You give it to us. And if a general partnership exists among Ross and Omakase, then they're jointly and severally liable for those damages, if it's a good legal claim. But even worse than that, if someone else, like just an ordinary sushi holder who happened to vote on the proposal to pay them, is part of that general, then even that person who had nothing to do with writing the software, they might be liable. And so because there's no entity, this is the fear, all these people could end up having liabilities.
Right, and these laws are really based on old case law with like closely held companies, three dudes in a bar in Pennsylvania, right? So if you have, a multinational team, and you're looking at having some sort of certainty where this was formed and what jurisdiction is going to claim that their laws apply, so you can kind of look at your risk. A lot of times it's based on principal place of business or something like that. So it's much harder to figure out how it plays out. But the risk of this, coming true to date, where someone has successfully put one of these through and someone was liable, it just hasn't played out yet. But the other thing to you know.
Although there was a case where a plaintiff's lawyer in New York successfully got kind of a rubber stamp judgment based on the idea that all Bitcoin node operators are operating Bitcoin as a partnership. And I don't know if he was ever successful in enforcing that judgment.
The fallout was immense.
Right. So there's that.
We all owe him
precedent.
money.
Yeah, that's right. Exactly.
We owe him some Bitcoin.
Yeah,
That's
I mean,
right.
that's the uncertainty when you go to court. It's like, yikes. But you know, when you're talking about who's a general partner, the closely held sort of paradigm isn't very helpful because those stakes are liquid. There's no one coming in and out of the partnership. And here, you know, you're looking at theories of agency. You know, your connection is that you work for the DAO, or maybe you know, exercise some sort of managerial function control, or there's, you know, a control stake in terms of your governance tokens. And what is that threshold to shore up liability there?
Sure. Another issue I'll just quickly hit on because we're running out of time is tax. And I think this is a bit of a sleeper issue, but, you know, in the US, if you pay someone for work, you know, more than, I don't know, I think it's $600 or something, you're supposed to file someone's supposed to be filing a 1099 on that person to show that they did that work. If you're distributing money to a person, like the Sushi Swap DAO kind of does to ex-Sushi holders, you're not supposed to give anyone money unless you first collect a W-9 or a W-8 Ben from them, showing that they're not subject to backup withholding. They owe money to the IRS, right? There are all these kinds of things. And so it gets very tricky very fast because a DAO can a DAO collect W-9s from ex-Sushi holders? No, they don't even know who the ex-Sushi holders are, right? So this is the problem. So Raf, what do you think? Does this mean that we should give up on DAOs, or every DAO should just be an LLC or a corporation, and we'll somehow trick ourselves into saying that a corporation can be a decentralized autonomous organization? Is this just like a depressing reality, or is there some hope or mitigation for not having this parochial type of business entity?
Sure. So, well, for the tax issue, I have no idea, and I'm not a tax lawyer. And it also seems like the IRS has no idea, at least for the short term. I mean, it's not something that they seem to have talked about or, you know, have dealt with yet. They're just a couple years behind on that, and let's hope they stay that way, I guess. But well, to the last topic, which is related to your question, I wonder if for purposes of mitigating the risks that come along with the general partnership idea, to the extent that a project needs to use or wants to use or chooses to use the general partnership framework as a regulatory defense to say that the tokens are general partnership interests and not securities, now they have this other risk, the everyone is liable for everything risk, which is very, very bad. Also, although it's totally absurd, and I don't know, not sure if there's an absurdity defense for this, but somebody's going to have to make it at some point. It will be made. That the result would be absurd, right, for everyone to be jointly and severally liable. But I wonder if one way to mitigate that, if it's possible, and you guys, curious to know your thoughts on it, is like if when people interact with whatever the protocol is that's supposedly a general partnership, if there's just a way to disclaim as much of the liability as possible to say, look, if you use this thing, it's at your own risk, and you know you might lose all your money, and we don't have a relationship with you, and we don't know you, something like that. Maybe it's not foolproof, and there's also the difference between the interface or the entrance to the protocol versus the protocol itself, right? The protocol itself, I don't know if you could build disclaimers in there. Maybe you could just add them at the bottom of the code or something. But if you're running a website that is an interface, then you can have a terms of service that might provide some protection. And if you combine that with the fact that the outcome of the other, it would otherwise be absurd, plus that should hopefully be some kind of a defense.
Right. So in other words, you know, unlimited liability is only a problem if there's something to be liable for. And we do have a lot of mechanisms in our society, for better or worse, for limiting liability on the front end through contractual arrangements. I would also say that something that, you know, I've been encouraging DeFi communities to look into is, okay, you know, and a lot of times people have gotten very wealthy from involvement in these communities. Can we pull a bunch of funds together and put together like an indemnity fund and just agree that out of those escrowed funds, if there is some type of problem, that'll be the first recourse. Because insurers are not currently insuring this type of thing. It'd be very, very hard to get insurance for the Sushi Swap team, I think, unfortunately. So Ross and Omakase, I guess I'd put it back to you. If Sushi Swap had to become a Delaware corporation, does that kill the magic? Is the extra risk that you're incurring from this non-traditional, somewhat anarchic arrangement, is that worth the extra risk to you? And do you think that eventually there will be some entity, or do you think no, it's integral to the culture that there not be these hierarchies and these prescribed levels of accountability, and the juice is worth the squeeze here. We got to stay chaotic. What do you think?
Yeah, so I mean, I feel like it's premature to answer the question mark of like, what is Sushi Swap? What is the DAO? And to plant the flag in Delaware or any jurisdiction and try to contain this, like we said, this sort of stew of activity that is loosely coordinated around the Sushi token. However, I think kind of the approach that I've seen that is positive is kind of to Raphael's suggestion, like disclaimers, sort of caveat emptor, suggestions to users to kind of really make them confirm and understand that what they're doing is entirely at their own volition. It's their wallet, they're signing a financial transaction, they're doing something with their funds, and our technology is merely routing and enabling them to do more complex things with smart contracts. So it's like they're actually in control. I think those sort of disclaimers have been helpful. I've seen, Wi-Fi, they have ape.tax, and I think it says like, this is an experimental experiment. We might shut it down any time. Like, buyer beware. I think it might be difficult to have sort of terms of use, because then we might be, we might need to actually establish a legal entity to have some sort of privity of like, who are you entering into this sort of disclaimer agreement with? So that feels premature, but yeah, I think the self-regulation approach of really putting it on users and just saying that we're a technology provider has been sort of the way forward here, in that we're not in control and we don't want people to think we're in control.
Great.
But yeah, I think a Delaware corporation would kill the golden goose of this whole enterprise, right?
I tend to agree.
Like
although I am a lawyer, I do, I just kind of feel like, it's so parochial. How can this world-changing, revolutionary thing, just be a Delaware corporation? It just doesn't make sense to me. But on the other hand, there are risks involved. So I think we're out of time here. Everyone, thank you so much for your contributions. This has been great. And I think I would say this is really the tip of the iceberg in terms of the issues we've hit on here. So do pay attention to the crypto law sphere, regardless of whether you're a lawyer or not. Do feel free to reach out to us. We all have different projects that we're working on, different things we're writing about, and we will all make progress on these types of issues together.
Thanks, Gabe.
Thanks, Gabe.
Thanks, everyone.
Thanks a lot, guys, for taking the time to join today. Another great panel we had there. So the next panel we have up is called Scaling, Team Structure and Coordination, Incentivization and Onboarding. And on this panel today, we have Sal, who's the moderator and a panelist. He's from the Alchemist project. We have Joseph from Sushi, Zach and Zem, who are both from Yearn and Coordinate, and CL from Eagle Capital.
Yo.
Hey guys, you're all live now. Can everyone hear me?
Yeah, I can hear you. Yeah.
Awesome. I'll jump out now and let you guys take it away. Thanks a lot.
Cool.
Hey, everybody.
Hey, yo. I think, are we actually like we started, right?
Yep. Yeah, you're live now.
Awesome. Okay, cool. Yeah, I guess it'll be good just to start with some introductions. I'll kind of be moderating the panel, but I hope that it'll just be a natural conversation. I think. I'm Sal. I work with Alchemist. It's a bit hard to nail down a role for me because it's a community project and kind of everyone does a bit of everything. But I'd say I've most been involved in kind of just helping coordinate certain teams and efforts and maybe a little bit of business development as well. And that's kind of why I chose to join this panel, because I've been, helping to coordinate different teams and what not. So I guess I'll just hand over to Zach, because he's the next person on my screen. If you want to kind of introduce yourself and give a bit of info about what you do.
Yeah, so I am Zach. I am one of the core contributors at Coordinate, which is a platform that allows DAO contributors to gift each other and incentivize and reward each other for their contributions to DAOs. Previously, I was and still am a co-founder of Converge, which is a design consultancy all about designing and launching networks for social environmental impact. So I am new, relatively, especially to most of the people I meet, very new to crypto, and I'm bringing sort of that real life network leadership IRL perspective to what we're doing at Coordinate.
Awesome. Joseph, do you want to go next?
Yeah, hi, I'm Joe. I work at Sushi, and yeah, we're just helping with technical direction and steering of like our development process.
Nice. CL.
Hey, yeah, nice to meet you guys. You guys can hear me, right?
Yeah, I can hear now. Yeah. It's kind of cut out for me. Is that everyone, or?
Yeah, I think you've cut out, CL.
Cool. Well, let's move on to Zem, and we'll come back to CL maybe if give him a chance after Zem goes.
Sure. Yeah. I'm Zem. I'm also one of the core contributors at Coordinate. Also been a contributor at Yearn. My background is in actually in technology, but also in art creation. And a lot of my interest in DAOs really comes from.
Does it work?
Yeah, we can hear you now. Yeah, but we'll let Zem finish off, and then we'll look back to CL.
Right on. Yeah, a lot of my interest in DAOs and in this space comes from an interest in studying how artists collaborate on projects and how creative teams negotiate meaning together. So that's sort of where I come from, and an interest in how DAOs can collaborate better.
Awesome. Let's CL. Do you want to introduce yourself now? I'm not getting anything. Is anyone else getting anything?
Oh, does this work?
That works. Yeah, can hear you now.
Okay. So I'm at Ego Capital. We aren't necessarily like a DAO, but we kind of like a grassroots group of about like how like we came together and like how many others can do the same.
Cool. A little bit choppy there, but I kind of got that you work with Eagle, and you guys, you're not really a DAO, but you kind of maybe developed in a similar way to how community projects do. Okay, seems like we have some.
Right, yeah.
Yeah, I think there's some intonations. It's a little bit choppy. I think let's just launch right into
sorry. It. Maybe we're far away.
Yeah. Are you still there? Cool. Well, let's just launch right into it and see how to try to chip in if your internet is working a little bit better. But yeah, we'll launch right into it. So I think just to get the conversation started, we're here to talk about team coordination, incentivization, and onboarding. And I think one of our panelists kind of suggested that would be good to discuss. Before we launch into the actual scaling, what motivates people to join a community project? Because knowing people's motivations, I think, is key to how to help coordinate them, how to incentivize them, the onboarding process. So what does everyone think about what are the motivations for joining a community project or a DAO for developers or anyone else that contributes?
I don't know, man. It's right now it's not a great deal to be in a DAO. I think that we have to offer additional incentives to work at Sushi to offset, like, I think some of the perceived risk. And I think the only reason that you do it right now is because you really care about like what the project is and what they're up to.
Yeah, I think also potentially that just the experience of being able to step into someplace and contribute right away. It's sort of worth that risk reward that Joe was just talking about, to be able to come and say, I want to contribute something, I want to do it, and there is no bosses or blockers. It's really a chance to exercise your own creativity and autonomy. And for a certain set of people, that's super appealing. And then to be able to connect with others who have that same sort of mindset, I think is a big driver.
Yeah, I think I think that's a really good point. It's interesting that Joe, you mentioned that that the risk reward and that kind of built onto that. I think there's kind of two groups of people in crypto. That there's those that have made a name for themselves and are kind of they're already involved in a bunch of different things, and maybe the risks of joining something that is not their own creation compared to the rewards of launching their own project. That balance might be a bit tilted towards not participating in DAOs, and to kind of make up for that, they really need to be passionate about the DAO or the community they're contributing to, either because the product area or the the culture and the vibe really. And then you got another group of people in crypto that maybe aren't so involved, and they just need something that, they're really incentivized to work with DAOs and community projects because it's really easy to just step into. As Zach said, if you launch yourself into something and you just make a name for yourself by doing things, right, you'll immediately start to kind of rise through the ranks, right? So it's almost like just an open society rather than a company. So I think that's my experience in Alchemist. It is quite hard to attract people to contribute that may be more established in the space, because they're perfectly capable of just launching their own thing and probably making millions, but and so unless they're passionate, it's quite difficult to attract that kind of we call it founder level talent. But other than that kind of small group of people, you generally find that just being able to step in is enough, and take control of something without having to get permission necessarily is enough motivation to attract a lot of people to contribute. So that's my experience. Zen, do you have anything you want to add to that, or from your experience or time in crypto?
Yeah, I mean, I would add to what you're saying, kind of. I think that like what's really a really well-tuned and a DAO that's really in sort of like its prime or whatnot, like when you step into it, you feel to some extent like it is your project. Like you can kind of add the kind of value that you want to add, and try out things and see how they resonate with the group, and that there's some kind of equity exchange that helps the value that you add sort of give back to you. So the project itself becomes partially yours, and you become part of the project in this very symbiotic way. I mean, I've sort of experienced that in different ways at different DAOs in the last, I don't know, what is it, year or so I've been messing around in the space, but and it's never quite the same. But I think that that's like the really the vibe that really makes it attractive, is the sense that that you're building something that's very much a part of your own sort of passion, and that can be welcomed into a space, and you kind of get the rewards that is due based on the value that it implies.
I just add that as someone who's brand new to crypto, I mean brand new, working it for about a year. It's I think people that have been in it a long time forget how special it is to be able to just like walk in the door of some place and start doing something. That's been my experience at a handful of DAOs, to walk and say, have you ever actually had like a designed and run all hands group call? It's like, no, you should do it. And then you start doing it, or through Coordinate, like being able to connect with, founders and leaders of major protocols just through Twitter. Like that really doesn't happen in any other industry, I don't think. So having that kind of ability to quickly collaborate and get your ideas put into practice is a huge motivator for certain type of folks.
Yeah, I definitely agree. That's kind of been my experience, and I think that kind of point you finished off with maybe gives us a nice kind of shift onto maybe talking about how we onboard people. Right? Is how do you scale this? When you first launch a project, there's a lot to be done, isn't there? Right? There's plenty of things that need to be done. No one knows who's doing what, who wants to do what, and you kind of get a lot of people stepping in. But my personal experience is, as products start to launch, and you kind of have these kind of I wouldn't call them hierarchies, but almost kind of social structures forming around different areas of the DAO or community project. That kind of special magic of just stepping in and doing anything, it becomes a little bit more difficult, just because maybe the low hanging fruit is gone. And as the organization grows, you kind of people start to have different visions of where it's going, and it might not, you might face some pushback when you try to launch something new. So just kind of I thought maybe a good point here to start talking about how do we keep scaling this kind of natural onboarding process of people just launching themselves in. Like, it's not really an onboarding process for a lot of communities. You don't necessarily have to interview anyone. It's just kind of people step in and do stuff. But as you grow, that becomes less and less easy, because low-hanging fruit is gone. Maybe you might start conflicting with other people in the community, for a multitude of reasons. So how have you guys, maybe at Yearn and Sushi, it'd be really interesting to get you guys' perspective as well. How have you kept that magic going? Is kind of the question with onboarding. How have you kept this natural onboarding process ongoing?
Yeah, I mean, I think I've seen it play out at Yearn quite a few times, that it's definitely like contribution first seems to be the model. There's sort of like individuals out there that are just doing something that had some implied value to Yearn. Maybe it's making a graphic, or it's like actually coding like some front end that kind of like analyzes Yearn data in a specific way that's unique and useful. And when somebody does that, then the community is very quick to invite them in, because they see the mutual value of that, oh, this person can really add value to our group if we get them onboarded. It's sort of a social process. It seems like there's various layers of telegrams, at least at Yearn, and a lot of it is this sort of socialization of that individual. We hope also that Coordinate can kind of aid with that by letting there be like an easy decentralized compensation space, that allows that participant to kind of enter in and potentially get compensated for future work that they do.
So would you say it's almost a culture thing with you, and that's kind of what keeps the process going, is the culture of the community recognizing, constantly recognizing new contributors and kind of bringing them in?
Yeah, definitely. There needs to be like a culture of generosity, which I think a lot of DAOs, I feel like, have recognized that. Like, it sort of seems like it's the de facto stance of DAOs for the most part, is welcoming and being grateful and recognizing with gratitude the contributions that people are doing, both deep within the DAO itself and sort of externally, and welcoming that as well.
Joe, I think you were going to say something. I think I might have spoken over you. Do you want to?
Oh no, you're good. Yeah, no, I think that's right. That's how we do it as well. It's like we wait for a contribution first. I mean, and we kind of like spend time and just kind of like evaluate the performance like long term, and we kind of don't really want to elevate someone onto the core team unless we think that they're just super A+. Because like, as you were talking about before, just like, or maybe it was in like the questions that we got like presented with before this, is like the structure of a DAO like has a bit more of a leadership vacuum, and so it has to be like self-motivated people, and those self-motivated people have to be pretty good. So if they're not if they're like not self-motivated people, it like becomes very apparent in that like kind of the first like 30 days. The one thing that sucks about this process is like having like, this is like not considerate of the counterparty, and I wish there was like probably a better way to do that. Like, people have jobs, people have other regular jobs, and maybe they don't have time to kind of contribute to a DAO for us to find out that they're like highly talented. But I also think any other measure might be like not as good.
So yeah, it's quite interesting. So would you say at Sushi maybe there's almost maybe this is the wrong way to describe it, but almost two layers to contribution. There's kind of the open layer, the just community layer, to do whatever you want, do whatever you can, start to get noticed, and then as people start to show those qualities you described that you kind of select for, they'll kind of be elevated up to the kind of core team level and be able to contribute in a much more organized and maybe not so much kind of a community way, but more like organized, structured, almost business.
Yeah, we're like, I don't know how Yearn works, but like we're more explicit about what is core team, or we're very explicit about what is core team. Like there's kind of this hourly grants kind of like tier, and then we have core team where we kind of put you on a Sablier and kind of have you as a full-time contributor.
Yeah, I think Yearn has a similar model, and I'm sure it's similar for many DAOs. Like people start showing up and contributing, and the ones that are consistently contributing quality, there's more and more for them to do, and at some point it makes sense. Like, hey, come join, on board full time. I think it's interesting thinking about like how leadership is different in a network space. And two things that I've noticed both in my work with sort of in real life networks and DAOs is the first is just that we need to rethink about leadership in terms of like coordination, that it's really, I think of leadership in a DAO like air traffic control, where you're not setting the roadmap and keeping everybody on task, but you're just trying to keep everyone aware of what everyone else is doing and what's going on. I think there's a lot of room for all of us in DAOs to get better at that air traffic control function. And then also just, working on our own muscle for tolerance for ambiguity. I think sometimes we can, in DAOs, make it a problem when things are kind of chaotic and people are duplicating effort and there's, all this kind of, someone's got their skunkworks project that they're just working on that everyone thinks is a bad idea, but they're still gung-ho on it. And I think, in companies, they were sort of developed to minimize and streamline that. And DAOs, like part of the magic of it is that it does have that open innovation and just recognizing that it comes at a cost. And so, being more comfortable in that ambiguity and kind of bearing it rather than trying to say like, how can we be more and more organization-like? How do we embrace it? I think is an interesting problem that DAOs are going to wrestle with.
It's really interesting you mentioned that, because I think that's kind of, and we're kind of moving on to maybe a bit of coordination here as well. But that's kind of been my experience in Alchemist is as people take on more responsibilities and you get kind of this more structured, organized way to developing, I think it's like it's a two-sided process where this kind of core group, and it's not necessarily a bad thing. They self-organize, they start to almost plan and have a vision, and they build, and things are happening in a structured way. And then if someone just random starts doing the same thing, people can feel like toes are being stepped on, or what they're doing. This is kind of what we're working on. And at the same time, the community itself might start to feel that, hey, there's a core team now, they've got it under control. I don't need to contribute as much. The team is dealing with it. And you kind of see this with kind of crypto projects that aren't community based or aren't DAOs, where the community is basically non-existent. It's barely involved, and they're always asking the team, when marketing, when this, when that, when this, when that, when this, when that. So I think I think it's like a two-sided process where the team itself might have some difficulties in maintaining an open approach to having contributors come on board and do some of the stuff. But at the same time, the community itself might start to become almost complacent and feel like these guys are getting paid, these guys are doing the job, we don't need to be as involved anymore. And that's kind of something I found maybe in my work in Alchemist, and we're kind of working on ways on, we launched this thing called Chaos Lab recently, which it's basically almost like just a rotating reward for anything the community wants to do and reward. And that's a way to keep the community involved, despite the fact that there's kind of a more core group of contributors that are maybe paid more regularly and are doing more organized work. So it's really interesting you mentioned that, because we have, we faced a very similar issue, and we're also kind of working on trying to resolve that. Cool. So yeah, does anyone else have any any comments on this, or should we kind of try to cover something else now?
No, I mean, I think that that's a super intriguing part about what DAOs are all about, that there's this balance between like this kind of almost autonomous creativity that can bloom from a group of people that are collaborating on something, and then some sort of cohesion points, like some sort of entrainment around ideas or around groups of people that you know, lets that become more fluid and more centered. And you know, it's sort of a dance, hopefully. You know, those two things can really, I think, be balanced in a way that I think is going to make some of the most creative, you know, sort of like groups of people that we've seen yet in humanity. So yeah, I guess that's the big hope for me and on DAOs.
I'd be curious to ask, like maybe Joe and maybe Zach and Zim, if you guys want to chip in here. Are there any kind of particular initiatives that you guys have taken to like combat this, if you found it to be a problem? Like I mentioned, Alchemist, we came up with this Chaos Lab idea, and this is an initiative specifically targeted or strategy to kind of help mitigate this issue. Are there any kind of particular initiatives you guys have taken that you maybe were successful or not that try to deal with this problem?
I think you're talking about incentives, like for teams.
Kind of, yeah, incentives plus coordination. As in, as you have more core teams and central teams, it's kind of a bit more difficult to. You get this complacency from the community, and it's kind of a bit less accessible as well. What kind of initiatives or incentives do you guys have that kind of are targeted at resolving this problem?
Yeah, like we currently are looking into it. It's like some of the like this is a really, I think, like in terms of like human organization, there not much has changed. Like even in the DAO structure, it's like just kind of like leadership naturally emerges, and teams and sub teams form like almost naturally. But the for incentives, I think that they're like really bad, especially for fair launch projects. If you follow like what's happening at Wi-Fi, where they had capped the supply and they needed to mint more to kind of continue operations. It's like, and the idea that was even controversial was pretty astounding to me. Like for Miso and Kashi, right, we've had to make these really shitty deals because there's really no way to build incentives the same way. It resulted in weird licensing, bad, super high costs, hurt feelings. It's just like it was not. Those were like it. I'm really open to hearing ways that kind of like DAOs or fair launch projects can incentivize kind of core teams long term to kind of be committed, because we are asking, like you guys mentioned, like founders, right? We're asking them to be founders in many ways, and like why wouldn't they just leave and start their own organization? Which I'm sure Yearn has had problems with that. We've had problems with that. People who are kind of in for near-term gain, but like are really talented, and we would like to retain them, but we just can't because the incentives are all messed up.
I guess I would say that Coordinate is kind of an attempt to address some of that same issue as well, with being able to engage the community and sort of avoid that complacency. It's a way for the community to be constantly giving feedback to each other about saying thanks, giving gratitude, and also one of the big benefits of Coordinate is it creates a sort of self-reflection for the DAO to look and say, like, what do we think is valuable? Who are we rewarding and what for? And so being able to start looking and asking those questions. I 100% agree, Joe. In some ways, it's like DAOs are a completely revolutionary, and like they're people, and it's people in relationships. No matter what the structure is, like it's always going to come down to, like, you can have the perfect structure and then there's people in relationships and it's a mess. But if you have this way of sort of looking at a shared display of saying, here's what we think is valuable, I've seen it I've seen it really allow like for good team hygiene, you know, to start having those questions and be able to have the hard conversations about like, yeah, you contributed a lot, you did a lot, but you didn't receive a lot of give for it because it wasn't actually perceived as that valuable. Like, you know, how do we, those conversations are hard to have with colleagues that you trust and have been working with for years. Like, how do you do it with anonymous people who, you know, have the best intentions and are trying to contribute? So, you know, to really engage the community, I feel like you have to have sort of some of that, some stakes to it, and some shared display of saying what's happening around here. So we hope that Coordinate can help contribute to that.
I definitely agree that, you know, I think there's an element of, you know, the problem you mentioned, Joe, about, you know, a lot of these people contributing could just leave and launch something worth millions. I think to some degree it is a kind of a hard problem in that, you know, the potential upside of something that's new is probably always going to be bigger than the potential upside of something that's big and established. And, you know, Sushi, for example, it's a $1 billion, you know, organization. It's unlikely to 10 times from here in a week, you know. Whereas if one of these founders launched something new today with their own coin and they did their own thing, that's very likely that they'll 10, 20 times, maybe even 100 times the value of their own share or you know, or their own, you know, personal profit. So I think to some extent it's a hard problem. But at the same time, I do recognize, Zach, that like I do think having open, transparent conversations mitigate you know, this hard problem to a degree, because not everyone's just purely motivated by money. And I think a lot of the time the problem is more a problem of relative rewards rather than absolute rewards. So like if I'm working on this awesome project in Sushi or Yearn and you know, everyone's really excited by it, but you know, maybe it doesn't necessarily produce a massive amount of profit for the protocol, and then someone working in a more profitable area of the business is earning a share of the revenues and making 3 times as much as me, that can be a lot more toxic than the fact that, you know, this hard problem of me being able to launch something that's worth millions. So yeah, I mean, I don't have a solution, but these are just some of my thoughts. That there's an element of it which is relative, which is probably what Coordinate and you know, Zach, you guys are working on. But at the same time, there is a real problem where if people come to the point where they just want to choose what's worth more money to them, you know, they will always end up launching something themselves. And that's something we kind of have to accept. And I think DAOs probably need to become a sort of conveyor belt of talent where, you know, you accept that as people reach the end of that conveyor belt, they're probably gonna, you know, at some point just make more sense to them to launch their own thing, leave. But because you've set up a conveyor belt, you've got, you know, a horde of talent kind of almost ready to take their place. Maybe this isn't the case with Solidity because everyone's struggling to hire Solidity engineers, but maybe in other areas of the business, this could be a potential solution.
And not to be like too naive about it, but I think we are. I mean, this has certainly been true, you know, in my experience in the corporate world and sustainability over the last 15 years, is that sustainability strategy has become like a really key hiring. You know, it's like one of the most important recruiting things because people that have options care about things besides just money. So not to say that like money is always going to be a motivator, but I think if you can develop a culture where people feel really like, you know, valued and challenged and like they're innovating and they're part of something bigger than themselves, like, yeah, there'll always be a new project to start, but you know, I think that's because we're so early. Like there aren't going to be endless opportunities to go 100x some new thing in crypto forever. You know, we're building out the ecosystem and the niches get filled. And I think, you know, a lot of these big projects that I mean, folks like Sushi who are, you know, from my experience, just outside looking in, like constantly innovating, and everyone seems really excited about what they're doing. Like all the people that are there, like you're building something that'll have staying power, and that, you know, a lot of those people that go out and say, oh, I'm going to make a 100x. Oh, this is really hard. This is lonely. Great. I made my 100x. And like, I miss being a part of something and actually doing something cool. And so, you know, I think that the conversation around purpose for DAOs will increasingly become really important too, because ultimately, it's my view, and it might be naive. Money isn't everything, and the real founder level talent wants to work on something important.
It's funny you mentioned that, because I'm not going to mention names, but we have one of our kind of tech leads on a product that we're launching. He's always said that he's he's addicted to building money making machines. So he's not addicted to the money, but he's addicted to contributing to these big projects that have potential, and he's kind of forged relationships in the team he's worked in, and that's really the only thing, in my opinion, keeping him. Like he could easily go do his own thing and probably make a lot more money than we're able to pay him. But yeah, I mean, Zeb, you kind of dropped off, so I kind of want to give you an opportunity to kind of chip in here. Do you have any thoughts on this problem? We were just discussing the issue of how do you balance incentivizing top talent when they could kind of leave any time and just do their own thing.
Yeah, for sure. I mean, I don't think this is like an area that I have like a ton of like direct experience. But I think that the incentives are there because at the end of the day, like anybody that's building something needs a team around them. And, most of the folks that have found their way into these DAOs and have been active and productive and found some gratifying, results from it are, that's a pretty valuable thing. So, just in the same way that, that there's a lot of good things about working in a traditional company when you've got a great team around it. That's not something that you necessarily give up lightly all the time. Yeah, I don't know. I mean, I think that there's a lot of different ways to incentivize that, but the culture of the organization is really vital there, I think, to letting people have that kind of freedom. I've also seen a lot of people that are doing great building within a DAO kind of like split out something that has some relationship to the DAO at the end of the day, so that sort of process of like building isn't really about like leaving. It's just about like sort of starting something new that's also has some kind of communication with the prior project or some kind of relationship. And that seems to happen more fluidly at DAOs than in other places, which is another thing I think is super interesting about DAOs, is that that sort of like borderlessness. So I think that there's like a lot of different ways that people can be incentivized to stay within something, but also to find their freedom within it and sort of like do something that's beneficial to the group, to their relationship with that group, and still to satisfy that need to build that new thing or to create that that innovation that may have some outside presence as well.
Interesting. Someone sent a question about, just while we're on this topic, I thought it might be relevant. If someone can just make millions by kind of forking, or something that someone else has innovated, or kind of taking that idea and building on it, how do we kind of incentivize the original innovators to keep building? Is it NFT royalties? Something that could be added to open source code. I'm just mentioning it because it's kind of on the topic we were discussing, and it's quite a new idea to me personally. I've never thought of it, but I was wondering if anyone else has any thoughts on this, because someone could come out with this awesome protocol, launch it as part of Sushi or Yearn or whatever, and then a few other devs just fork it onto BSC, Polygon, or even on Ethereum itself, slap a new name tag onto that, and literally have a 100 million token there and have earned millions out of it. So how do we kind of keep the innovators incentivized when this is quite a risk, a common risk that we find in DeFi?
Man, I'll talk about this because this is my specialty, is forking other projects.
It wasn't intentional. I'll tell you that.
But let me just say this. There are plenty of POSIX compatible operating systems out there. Why Linux, right? Like why? Because Linux is the Schelling point that everybody gathers around, right? That's the kind of the platform that we've all collectively decided to use. It's like the same idea, and I'll go to the fair launch idea. Is I think many people miss the boat on understanding fair launch. Under the guise of saying, oh, they're forking this project or they're forking that project. It's like for years, the extractable value that has come from projects has gone directly to founders, rightfully so, and venture, right? Those are the two, like a platform would come out and almost the entirety of the extractable value will have gone to those two parties, ignoring the idea that the community that would be around the project is users, enthusiasts, contributors, as those people had no value to the project. But I think from Fair Launch, what we've discovered is that's almost the entirety of the value. In fact, we had this Phantom Troop call number one had 500 had 500 community members on it discussing this Phantom Troop proposal. Like, if you and they've really refactored this Phantom Troop proposal to make it seem more appealing for the project. And if I don't know, it's hard for me to say that that's not valuable. That's almost the entirety of our value.
Yeah, I think I agree. I think you made a good point where you know, the act of forking something isn't in itself, you know, positive or negative, and maybe in itself shouldn't be seen as something that causes, you know, the original creator of that thing to be, you know, feel negatively or positively towards that. It's kind of more what's done with it. So I think like you rightly pointed out, you might have this great innovation. And everyone starts using it, but really the value is in the users, the value is in the community, the value is in those who are involved. And if you know, if that thing is kind of feeding back all the value of those users to itself, then perhaps, you know, a way to incentivize new innovators is to be a bit more open about forking, because they could take this innovative idea, open it to a community, and have people build on top of it and take it a lot further than in a different direction than it was going to go in itself. So yeah, I think you know, I think I kind of agree where, like, I don't necessarily see, you know, the question that was passed on, you know, that you know, why should people develop if they're just going to get forked? I don't necessarily. It kind of depends on the nature and kind of where that fork goes, because the way that fork is done could actually create 10, 20 new innovators, you know. So I don't really see it as an inherent contradiction. It's more about the circumstances, if we call it, surrounding that fork. If it's an extractive fork, then maybe it's not nice, and we should maybe as a collective not you know, not support that kind of thing. But I don't really see I don't know what the opposite of extractive is, but I don't see a fork that isn't extractive as necessarily an, you know, inherently bad thing that disincentivizes innovation. You know, that's the nature of open source. You know, it's open source, and anyone can take it and do something better, bigger, more innovative with it.
I want to touch just one more piece on that is, like, going from Trident. We're releasing it all GPL3. We don't, as a DAO, we don't actually believe in this idea of like source code licensing and like trying to prevent forks from the platform. I invite the challenge of someone to fork the Sushi community. I just don't think that anything will have the meme power, and so we don't have any fear around that. We're just going to release it as open source, and anybody can free to fork and deploy as they see fit.
Zach, I see you nodding. Do you want to add anything?
Yeah, I mean, I think it's interesting. I feel like fork is often sort of framed and used derisively as like it's, you know, it's always a bad thing. I mean, the mission of Coordinate, the reason we built it is really, you know, how can we make DAOs successful? We think that DAOs as a structure offer a huge amount of potential for, you know, human coordination globally on some really important challenges. You know, DeFi just one among many among them, and DAOs have to deliver on that promise. They have to actually work for people. They have to, you know, be able to pay and incentivize. So Coordinate is like a small contribution to this bigger ecosystem. If someone, you know, can fork it and do it better, like, go for it. and that doesn't mean that we're going to stop building. You know, we're like building the thing that we think will be most helpful to help move DAOs forward. And, you know, sort of like welcome if other people feel like they have a better solution to help DAOs actually work, then go for it. I think we need to take a broader view of like, what are we really doing here? And if someone, you know, is working on something because they want to make a bunch of money at token launch, then you know, go for it. There's a certain amount of room in the market ecosystem for a forked project that a bunch of people ape into and then flames out. I think that'll always be around, and like, you know, knock yourself out. That's your thing. But I think people that are really innovating and building are going to work on their project kind of regardless for as long as they believe in it.
Yeah, I think that's well said. You know, I think from our perspective at Coordinate, but also just add that, you know, one of the goals, and I think this is probably true for a lot of different kinds of DeFi related projects or DAO related projects, is it's not to build like a singular thing that's out there and coherent and, you know, can't be, you know, modulated and changed. That the best goal is to make something that becomes a base layer for a lot of other kinds of activities. So, you know, I think that that's like one strategy or one way to think about forking as a risk or something like that, is that if you make something that's really fundamentally of value and you let that be open in a way that makes sense to others to contribute to and to add layers on top of and to build on top of, like, you don't have to worry so much about forking because you're building out that sort of like network buoyancy, the same way that ETH has really managed to do that, right? That you have a you know, a protocol that people are just building on top of, and that sort of becomes a bit of a moat. So I guess one way to think about that too.
Yeah, I think we kind of reached a consensus amongst ourselves, at least, you know, regarding this point. I think I'd just like to maybe have the last 5 minutes, maybe, you know, to deal with a question which I think is quite relevant to DAOs, and that is, how do you prevent kind of silos from forming within the organization? Whether that's information silos or silos of particular roles where, you know, someone works on something, they establish themselves as the person for that thing. It could be marketing, it could be a certain product, it could be anything in the organization. And that basically closes the door to anyone else, because this person has wrapped this role or this information around themselves. You know, no one else can access it, and it's kind of dependent on them. You know, how do you prevent that in a DAO? I'm really keen to hear this from you guys, because this is something I didn't ask the question, someone asked me, but I think I'm also quite passionate about, which is, you know, breaking down silos within DAOs, because it's kind of the antithesis of what a DAO is. It's preventing anyone from contributing because you've wrapped this role or this information around yourself.
Yeah, it's an interesting. Oh, go ahead, Zach. That's an interesting question for sure. Like, I think that I mean, I think that there's like two ways to think about it. One is that some silos have some natural, you know, if they have the natural evolution and there's somebody that has a level of expertise and trust, that's really useful for an organization. You know, that's like something that grows in an open organization naturally and is of value at times. But also it's good to recognize that can become, you know, too ingrained and that there's problems with that. And so, you know, I think one take on it is in the sort of governance 2.0 model that like Trake and Gabe Shapiro and others at Yearn built. You know, there is this idea about being very formal about that, to build out these like Y teams and to sort of consider those to be, you know, these kind of touch points around things that are natural silos, but to make sure that has like a governance-based rotating, you know, openness, so that it's you know, would be very challenging for that to remain, you know, illegitimately tight. You know, there's some sort of structure around that sort of changing out, in the same way that like civic governance has structures for changing out the guard.
Yeah, I was gonna say, I often talked about like, we don't need to break down silos, they just need more doors and windows, because silos are really useful. And I guess in the specific case that you talked about, and I think this is across DAOs in particular, like sometimes we try and build all sorts of structures or, you know, processes or things like that, when really what's needed is like a frank conversation. Sometimes the hardest thing is just to go to someone and be like, hey, I really respect your expertise in this area, and like you're hoarding or you're boxing it out or you're getting too rigid. Let's talk about it. And I think in DAOs, like especially, we sort of see like that there's going to be some magic process or some, governance model that will obviate the need for just these like, there's just tough conversations when you're working with people that have to happen, where we kind of like, take a risk and talk about what's hard or what's not working for us and find a solution for it. So, I mean, that's what your question brought up for me. It's like, there's no silver bullet for like, how do you deal with people? And that's what I think is going to be one of the real next layers of innovation in DAOs. Like, how do you turn all these anonymous avatars on Discord into like people who are actually connecting with each other? Because in my experience and from, a lot of research is that people don't collaborate on issues or projects, they collaborate on relationships. And so how are we building those and how are we tending to them is really critical.
Yeah, okay. I think those are all really valid points. I always say, like in Alchemist, when I'm kind of talking to people, there's no hierarchy, but there's no organizational hierarchy, but there is a social hierarchy, right? so yeah, I think you're right in that. At least from my experience, it kind of goes a lot more back to how people interact than necessarily rigid processes. And I mean, maybe some areas in the business do need processes because they might be sensitive, or you don't want things to get out of hand. But I think in most cases it is just having a conversation and getting people to trust each other enough to give up their silo, if that makes sense. Also, like you said, open a window into it. Yeah, so we're kind of coming towards the end. But I'd just like to get some maybe Joe, if you have any comments on that topic, and then we can maybe get some closing thoughts from everyone, if that's good with everyone.
No thoughts on that topic. I actually do have to jump. I have a next thing I have to go to. I'm really sorry to do that. Thank you very much for having me.
Any closing thoughts?
Yeah, DAOs are made up of people, and people are fundamentally flawed, and like what Zach said, is like there's no like process that we can come up with that will make like human interaction super liquid. It's just going to be a grind, and you just have to have frank and difficult conversations that make everyone feel uncomfortable.
Thank you. I won't keep you too long. You'll probably eager to go to your next meeting. Zach and Zem, any closing thoughts?
I mean, sort of building off of that, DAOs are made of people, and I think we can, get really focused on the tech, or be in it for the tech. But I saw somewhere some brilliant person on Twitter said that DAOs are a movement disguised as technology, and so I do think that DAOs are a really important innovation in how are we going to collaborate, how are we going to deal with some of these global wicked challenges that are coming really fast, and I think the most important thing as you're getting involved with a DAO is to really embrace that network mindset, that ambiguous, there isn't a path forward and that's okay. Trust not control is like the mantra, I think, for DAOs. And so as you're getting involved with it and you get frustrated because no one's telling you what to do or no one's recognizing your work, stay with it and recognize that in itself, like being able to deal with the ambiguity and to deal with the multiple paradoxical things that are happening, is like one of the most important skill sets that you can develop for the next several decades. So that DAOs in themselves are an awesome training ground, just being a part of them.
Yeah, I guess if I was going to have any closing thoughts, I would just say that I think what we're experiencing is a kind of like passive, like cultural movement, like Zach said, and DAOs have kind of asserted in this very ad hoc way, like this new way of being and this new way of working together. And, the tech is part of that. And, I think that like the goal of the tech that's rising up around DAOs is basically to chase this like developing culture that's happening at the intersection of kind of, trustless technologies and just like the growth of internet culture at large. And, sort of bearing witness to it and also being a part of it is really exciting. And I think that, there's going to be a lot of development around it and also within it. It's a real crucible. So yeah, that's pretty much all I got.
Yeah, I think I totally agree. If I was to just wrap these final thoughts and how they kind of how I feel about them, I think that's it. Experimentation is key. Not everything's going to work. Be prepared to experiment and create new approaches. And secondly, values over processes. It's very much a trust human thing rather than a formula that's going to make it all work for you. With that, we've overrun slightly, so apologies to the organizers. But yeah, thanks so much to Zach and Zem and everyone else. Joe and also CL. I know his internet kind of failed him, but thanks for putting yourself out there. And yeah, guys, hopefully a lot of people benefited from this talk, and I guess we're all free to go. Catch you all soon.
Awesome. Thanks a lot, guys, for joining the panel today. Another great one. And yeah, it's important to remember that at the bottom of every organization, it's always people. I mean, hopefully it's always people unless we end up in some Skynet situation. But yeah, it all boils down to people in the end. So yeah, in terms of that, the next panel is called The Road from Inception to Community-Led Decision Making. And on this panel, we have Church from Alchemist. We've got Jack from Pocket Network. We've got Tracheopteryx, I hope I pronounced that right, from Yearn. We've got Kevin from Boardroom and Eve from Bankless DAO. So Church will be moderating this one. I'll jump off now and let him take it away.
Thanks, Daniel. I think I'm also a floating video today. How you going, guys?
All good, all good.
Coming through loud and clear?
Yep. Hi.
So as Daniel said, I'm with the Alchemist team. I've been working on the marketing team for most of my duration with Alchemist. It's my background. It's where I've worked for the last several years as well. Today we've got Jack from POCT, Tracheopteryx from Yearn, Kevin from the Boardroom, and Eve from Bankless. Jack, I wanted to start with you for a couple of questions.
Hey, fire away.
So the question we're covering here is the road from inception to community-led decision-making. In terms of token governance for DAOs, do you think this is the right overall approach? Leading DAOs via a token holding basis?
Well, to be honest, I think it depends on the project. It depends on the product that you are maintaining. I don't think it's the right approach for most projects. But I can see an argument to be made that DeFi projects, which is where DAOs have really taken off in the last year or so, it does make more sense to have token holder governance since the token is more intrinsically linked to what the product is. But yeah, I personally am not a massive fan of token holder governance. I think token holders should be a part of governance, but shouldn't be the only stakeholders who are represented. I mean, if we think about how traditional organizations have been governed, they don't bundle the owners of the organizations with the decision makers of the organizations. And if we're inventing new organizations, we have an opportunity to think deeply about all of the stakeholders that are involved in the sort of common resource that we are maintaining, and to balance their interests. We should be thinking about how we can represent the interests of builders, how we can represent the interests of users, or customers, which depending on the product don't necessarily overlap with perfectly with token holders. Obviously there is some overlap, but it's not always perfect overlap. So yeah, I would like to see the DAO space considering how we can evolve beyond just token holder governance and how we can look at mechanisms that will involve other stakeholders in decision making.
Did anyone else have some thoughts on that point there? I think Jack raises really a strong case to explore alternative methods here.
Yeah, I agree. I think there's been a lot of issues pointed out with coin vote governance for a while, and one simple way to look at it is that outside of who's being represented or not, it's just one consensus finding mechanism, and it's not particularly well suited to most of the decisions that need to be made by an organization. So to think about governing all of the diverse and confusing pieces of a live organization with just a coin vote consensus mechanism doesn't make any sense.
Yeah, just to add on to that, I couldn't agree more. I mean, I think for the most part, these systems are being built to properly represent stakeholders, or at the very least, act in a more representative manner towards stakeholders. This theory is like nothing new either, right? Like stakeholder theory has been around for 30, 40 years. We've just never seen it at this scale in a global manner and completely like open and transparent in air quotes, of course. But I think it's pretty like. It doesn't really make sense to assume that every single one of those stakeholders necessarily has to be involved in every single managerial style decision that the project has to take care of, especially as these projects scale and evolve in size and in organizational structure. It's pretty nonsensical to assume that every single decision is going to be impacted by every single stakeholder. If anything, we just have to build systems that are a bit more representative, or at the very least empower that stakeholder that will be affected by that end decision, right? So I'm very curious to see how these systems evolve. But yeah, I mean, all this conversation brings up a lot of very interesting potential pathways forward into like how to structure these systems. And as Jack mentioned, I think it's completely dependent on use case, on community, and on type of project, but curious to explore those a bit further.
Yeah, I think there's a competing case here in terms of how you find consensus and how you find the most throughput. A few of the other panelists mentioned this in some of the previous panels in terms of the speed at which you're able to make decisions in relation to needing to get things done and being able to ship and deliver, but also being able to adequately represent the interests of the entire community, the builders, the devs. Where do you think the best way forward in intersecting and sort of covering each of these different consensus layers might be?
I think we need to think about separating the types of decisions into sort of fast-moving operational decisions to slower-moving sort of rule-setting decisions. Obviously, we want to build consensus on the overall rules that govern our ecosystem. But when we're thinking about the day-to-day operations and enabling the people that are on the ground to make decisions on the fly, it makes sense to have more of a consent-based approach where we default to action with the option to have disputes and to escalate towards more consensus building if something has been done that people believe is a violation of the rules that the overall organization consented to. There's a principle that I've been trying to embed more deeply in pockets governance, which is within Ostrom's principles for commons governance, that we should have nested ecosystems, and those ecosystems should be congruent with their local conditions. I think this applies nicely here in that the people who are on the front lines of the organization should be able to adjust the operations on the fly, and as long as what they're doing complies with the overall rule set that the organization has agreed to. And if we think about it this way, then we can start to think about tools that we might use to implement this, like optimistic governance tools like SafeSnap, where you could potentially have some kind of off-chain constitutional rule set that everyone agrees to, which then gets enforced on certain decisions, or a tool like Colony, which allows people to just execute without building consensus, as long as no one objects to the decision. So if we think about it with that framework, that might help us to point towards point us towards certain tools that can help us to actually implement these new ways of working.
It's an interesting distinction you raised there in terms of the objection-based model. So rather than seeking consensus first, sort of do something and ask for forgiveness later in that sense, or a highlight that you're doing something and see if the community responds in a negative way, rather than seeking positive affirmation. Have I framed what you said there correctly?
Yeah, I think it depends though on the importance of the decision, I guess. Some decisions can be faster than others. And I think you also do need to build consensus initially, when designing the original rule set that everyone agrees that we're going to follow, and those kind of things. But once we're actually once we've hit the ground and we're running, then we can start to sort of delegate some of these decisions to the front lines.
So there's a sensitivity that's needed in terms of which decisions are going to make a lasting or sort of overhanging impact. It would be difficult for people to change within the community versus sort of action-based decisions that maybe don't have wider impacts, and sort of entrusting those to, as you're calling it, the front lines.
Yeah, we looked at decision-making space in a similar way at Yearn, when if you look at all of the different types of decisions that need to be made in an organization, there are some that need to be made faster, some that can take more time, some that have a bigger impact, some that require more domain expertise, some that are better made by a wide range of stakeholders, some that don't need that level of consensus. And that was part of what formed our governance 2.0 model, which we've been using for a few months now. So we have pioneered this model. Gabriel Shapiro and I wrote Governance 2 and of constrained delegation, where we make each of the specific decision-making powers a discrete object that can be assigned to different groups. So Y-fee holders basically delegate these specific discrete powers to a set of smaller teams, Y teams. We have about 9 Y teams that have a balance of powers such that operational decisions can be made quickly, but all with accountability, and these powers can be retracted by Y-fee holders or redelegated at any point.
Oh, go ahead, Kevin.
No, just really quickly. I mean, you can't see me, but I'm nodding my head because this is like Gov 2.0 for Yearn, and I think it's fascinating the way that they've structured it. And just harping on what Jack, also mentioned, the importance of categorizing decision types, right? Different decisions are going to impact different stakeholders and different decision makers, and just mapping out that properly and developing a governance system like Gov 2.0 for Yearn, right, around that basic premise is just so crucial, so important, and can increase, that efficiency of decision making. Also, something we're experimenting with at Boardroom as well. We just launched a new feature called ideation, where folks can categorize different posts that on the pre-proposal phase into different categories. We're already seeing different members of the DAOs interact with different threads depending on their categories. You see just a natural, organic kind of like distribution between folks that might be interested in treasury discussions, to longer term vision, to marketing strategy, etc. So that's already fascinating to see, and I love hearing about gov structures that are actually built around that basic premise that we can properly map and categorize different decision types around different stakeholder types as well.
It's a really interesting balance between what you've both just phrased there in terms of sort of the 9-team split that you highlighted there, Tracheopteryx, again, if I'm saying that correctly, but in terms of distributed but teams that are operating under the policy consensus, so you can move quickly as well as move slowly in the right context. And then sort of what then what you're saying there, Kevin, in terms of in trusting on the basis of people who push with initiative and have the natural passion for a certain area or a certain strength for that area as they demonstrate it going along. Just to push that back on you both, how does that intersect between your views, do you think? Do either of you have a comment on how the other is working beyond what you've said so far?
I'm sorry, what is the question? The comment on how what's working?
Sorry, the question is there's still a bit of a distinction in terms of how Kevin has highlighted the operation at Boardroom and how you highlighted the operation at Yearn. What do you think about each other's various models?
Well, just to clarify, Boardroom is a DAO aggregator, right? So we actually just built tooling for DAOs. So for example, Yearn is a project that is integrated into the Boardroom portal, where folks can vote on Yearn proposals, see top Yearn voters, etc. So Boardroom is more of a DAO infrastructure tool. So we actually don't have Boardroom specific governance itself. We're more of a traditional company building Web3 tooling. But it's been pretty fascinating to see all these different DAO models converge right on our platform and on the UI as well, because we just get to watch how all these experiments play out and all these different governance models play out, and also try to the extent that we can standardize the user experience around participating and engaging in DAO governance. Then please let me know if you want me to expand a bit more on what Boardroom is and what we do. But we've been lucky to, for the last 6 months, observe how Yearn stakeholders engage with the DAO and Gov 2.0, and it's been really cool to see evolve.
That's really interesting. I'd love to come back to Boardroom in a minute, but I'd also like to Yves. You operate at Bankless and Olympus, from my understanding. Could you chime in on the differences you see from your perspective?
Well, I mean, it's super interesting that both communities have grown really organically and quite sizably. It's basically a couple thousand people that are thrown into a Discord that and that all have that shared goal and ambition. Both in Bankless, it all started with incredible podcast of David and Ryan, all the premium subscribers and people that have donated to Gitcoin and all kind of other criteria that played in the distribution model were airdropped tokens. They ended up all in a Discord, and then now suddenly there's a couple thousand people throwing out ideas in season 0, where we formulated huge aspirational ideas, like onboarding 1 billion people onto DeFi, which is kind of ambitious. And so obviously you end up with some sort of enjoyable chaos. And luckily there are these Web3 tools today that were non-existent the past few years. And they help incredibly to structure such a large group. But in the end, I really liked the previous panel, where in the end it's just a group of people, and I feel like most of the consensus and most of the the ideas that really gain traction, they are being formulated in situation like this, where there's there's maybe 5, 6, 7, sometimes 12 people from a certain guild that meet like on a weekly basis and that find soft consensus among themselves. And then when that idea gets traction, there's a soft consensus vote on Discord. If it takes one step further, there can be like a more formal post on Discourse. And if it involves budget and money, then we take it to Snapshot. And so there's different layers of governance. And I think that's really needed because like the tools that are there, like Snapshot and like Coordinate that we've used and that we love, they are super crucial, like from a bigger perspective. But like from a micro perspective, it's just about a group of people trying to ship a product and to try to execute on ideas. And often the consensus is really during voice calls. So that's what I find fascinating. That I mean, we've been organizing the whole DAO with Notion and like with the whole process of onboarding people and all of that. But in my experience, like most of the progress has been happening in discourse in Discord actually.
So you're making me think of an interesting. Well, you raise an interesting point there in terms of how you coordinate, not just in terms of how you make decisions at a policy or action level, but how you actually coordinate a community. Because you can have everyone chiming in, as you said, in that sort of level of enjoyable chaos, but then it can be quite hard to directly track and extract meaningful value from that. And I've come over to the Olympus DAO and the Bankless DAO, and I've seen the different organizational styles, and I understand what you mean there in terms of you can get a lot into Notion, you can get a lot into various tools one way or another, but it's not until people actually have the chance to have that sort of human conversation and sound each other out do they really align. I think that's an interesting balance in terms of how you actually get people on side and build leadership, build consensus in sort of more dialogue and more conversation than necessarily just tracking things in tools and building governance methods that rely on fixed rules and decision-making policies. Although I think overall this depends on what you're trying to accomplish and what scales and methods that you're developing for your either ecosystem or your platform. What do you guys think on that in terms of how you can best coordinate the community that aren't necessarily directly involved in something like Coordinate or some other tool that you might use to track action? Jack, did you have any thoughts there?
Yeah, I think you've definitely hit on a valid point there. I think it's important to make sure that the tools that you're using don't impose bureaucracy on the organization and stifle natural emergent coordination. This is something that I've come to realize through experience. Yeah, it's important to make sure that you're not enforcing specific processes or tools at the cost of that sort of communication and rough consensus and so on. So that's why I think Eve has observed Discord being like the best source of consensus building as opposed to other tools. So yeah, definitely something I think to keep in mind when designing governance structures.
Track the lyrics. Oh, sorry, Kevin, you're about to chime
No,
in.
yeah, I know. I mean, I think it's a very fascinating perspective from the Bankless DAO. It seems like for a lot of DAOs, like 90% of decision making still kind of happens off chain. Like in more traditional models of like coming to consensus, like calls, Notion docs, etc. And we do use like a lot of really interesting tools to like anchor the decisions, right, and like come to an actual consensus and signal to the community that there was some sort of consensus around that decision. But I don't think that the DAO tools are suddenly going to solve all of our problems, right? Or like very human coordination issues and human problems. Like lobbying and, political aspirations and power dynamics and collusion, to a certain extent, and activism. Like that stuff is not going to disappear, right? And like there's no way to completely fend that off from your DAO. And I think like the sooner we can accept that premise, the easier it'll be to also structure more secure mechanisms, but obviously depending on decision types, more like efficient and formal mechanisms to come to consensus in different DAOs. So it's been amazing to also watch like Bankless DAO and Index Co-op evolve, and these DAOs that have grown to like thousands of contributors so quickly, because the growth has been so organic, but it's also required very fast adoption of like really interesting on and off chain decision making tools and mechanisms. So just really fascinating perspective from Bankless. Really cool to see.
And I would just add that there's an important distinction between engagement and governance. So there's a lot of ways to coordinate a community, or a lot of mechanisms that a community can coordinate around, but not all of them necessarily need to be governance based. Or a lot of them are just engagement, or like using the products that we have at Yearn. And the Wi-Fi token itself is a massive coordinating, or governance tokens are wonderful at coordinating large groups of people around, into a specific community. And those, I think, become a entryway, a funnel to further engagement and further actual decision making and governance, but don't necessarily shouldn't also be, on their own decision making systems.
I think that speaks to the importance of having delegation to the people that are working closely on an issue, because you might measure the effectiveness of a governance system by voter participation, but if every decision is made by consensus by the overall body, just like overall community, then those decisions may not necessarily be the most effective because you haven't delegated to the people that are closest to the issue. So I think it's important to keep in mind that, as you said, engagement count, or stimulating engagement with the tools that you use doesn't necessarily substitute for having good governance and being thoughtful about which stakeholders you give decision-making power to.
Yeah, for sure.
I think there's a few interesting perspectives to sort of tease out there. It sounds like you're all somewhat agreeing in the sense that there's no really going to be one size fits all tool, but then there's a matter of how you actually select those people that you're going to delegate to, or the what structures you can put in place to work for that. I think in terms of a matter of throughput management, it becomes something that as a process you kind of have to navigate over time. It might be that one process works at one scale, but then as an organization or a community gets bigger, different processes may be needed to continue building that. And I think I've seen, from my perspective, I've seen various projects in other spaces. They'll often try to accomplish this with more tech, just piling on different methods and tools of tracking and keeping interface of everything. But I think there's something to be said for the stronger approach of actually really sounding out those communication pathways and how. And I think Sal touched on this in the previous panel in terms of information silos. There's appropriate times to have information shared and information kept sensitively behind closed doors. How do you think the information parity across a DAO or across a community-based organization plays into how we build up these governance processes? Yees, do you have some thoughts there?
Well, on that level, I think that's where, I mean, the tools come in play. I mean, like if you're once you've created different islands, because like at Bankless we have like 13 different guilds that own like manage basically their own island, and the DAO is basically our way of building bridges between all those islands. But then there's also like other ships that arrive, new people, and for those new people, the documentation and the way that we onboard them is super crucial, because anyone new who arrives at the Bankless server is going to be totally overwhelmed, because we've got like a zillion channels on Discord. And that's why all the work that's been done to like document our processes and all the tools that have been set up, like not really tools, like more like the processes actually, that's where they can find that information. But even then, while our like Notion is now pretty much like on point, even that document right now is just as overwhelming as the Discord. So again, I come back to the same thing. It's a people's business. So we've been like working on bots, and they like they take away a lot of the weight for all the things that can be automated. But in the end, you just need to welcome people, like they walk into your cool building or cool bar, and then just give them the tour. And giving people a tour around is not just like saying, "Hey, there's the link for wiki, figure it out." So once again, I mean, like in my experience, like the best onboarding experiences for new members have been one-on-one calls, and that's something that is not scalable. But as we all know, often sometimes the most important progress has been made by things that really don't scale. And then the tools are there for the things that you can actually scale.
Now, I would say that one really important point in talking about governance, and just stepping back a bit, is like, what are you trying to do, right? Because I think like a lot of people, like 90% of governance is a lot of theater, right? And that's okay. It can be derogatory. Sometimes it's a marketing thing. Sometimes it's a way to generate community engagement, or sometimes it's very theoretical, you know, and it's like, let's make all these structures and spend a lot of time bike shedding about them. But if you're trying to make, there's another reason to do governance too, which is because it's actually a very good way to run an organization. And that these new breeds of organizations that we're all working in actually thrive with thoughtful governance systems. And if you're doing that, then you really need the thing to work. And it can't work without transparency, right? And it can't work without there being communication between different teams, without the people that the power has been decentralized to having access to the core information of that, you know, organization to make decisions. So yeah, I think the transparency is an essential piece of it actually working, if that's the goal.
Yeah, and it's sometimes not only about transparency, but also just like, yeah, I mean, as you mentioned, access, right? And like, I think information asymmetry is going to be one of the bigger issues that DAOs face as they scale. I mean, I think it's pretty obvious. And it's really complex because, you know, maybe I mean, you don't really need everyone to be completely informed about like every single vertical of the DAO or like what everyone's doing, as long as they have some sort of like mechanism you know, to veto or to impose, you know, their will to some extent, as far as they're going to be impacted by the decision that's being made. So yeah, you know, I think there's a ton of solutions, and obviously something, you know, data, information and standardization of data and information, something that we're really focused on at Boardroom. But I think, as you know, something that is inevitable is that as these DAOs scale, there's going to be information asymmetry that might lead to managerial and political like balance of power shifts, right, and different dynamics. So I think it'll be really fascinating to watch evolve, and something that's very, very pertinent to systems with delegation as well, and you know, delegates, you know, these protocol politicians, which I know is a horrendous term to phrase, but I think that'll be really interesting to watch those power dynamics evolve, based on information symmetry.
If you could, Kevin, could you unpack a little bit more on that information asymmetry there? Again, you were talking about raising a bit more about what Boardroom does with those tools there, given that you're the DAO aggregator in the room.
Yeah, no, I mean, I think, we're seeing a lot of consensus and decision making happening off chain, right? And access to that is really complex, and it's really hard to open that up completely to every newcomer or every stakeholder type or every decision maker in a DAO, especially when you're scaling to thousands of contributors. So, I obviously, we're seeing a wide array of like different tools being used, and that is extremely important. That whatever DAOs should develop like their own niche processes, right? Whatever works best for that community and that goal and that specific use case. But what that also causes is a lot of fragmentation and like understanding how decisions are made, especially from a third party perspective or a newcomer's perspective. And just that fragmentation and honestly just the amount of like overwhelming information will essentially cause power to centralize. It could be in a good way, right, through like delegation mechanisms and stuff, but it could also just act as a gate for access to folks that want to get involved or will be impacted in the decision that's being made, but honestly are just overwhelmed by information, don't have actual like access to, or it's really hard to find like where that decision's actually being made or where you can get informed about it. And it leans heavy towards core contributors that have been involved and engaged for a longer period of time, and that might be a good thing. I don't know. I really don't have the answers to everything. We're at Boardroom specifically, we're just focused on indexing governance related data to start off with, and standardizing how that's actually presented, how mutations happen, delegation, vote casting, et cetera, across different governance frameworks and across different tools. So a vote on for Bankless DAO and Snapshot will look the same as a vote on compound proposal or an Aave V2 governance contract from the Boardroom interface, right? Not just the interface, but also the platform, the SDK, and the APIs. But outside of that, what we're really seeing is that most decisions are anchored by that governance process. But as folks mentioned on this panel, a lot of the engagement and decision making, early decision making consensus does actually happen outside of the bounds of that process, right? And that's where I'm a bit more worried that there might be some asymmetry of information based on just the sheer volume, or just like different accessibility issues that may cause some stakeholders to be a bit misrepresented. How we map that and how we measure that, I have no idea. Welcome suggestions. But even today, I'm already hearing from some folks that are large holders of some governance tokens or are actually building things on different protocols and different DAO communities, that they honestly feel that there is like a little gate to access, just because maybe they don't know how to use Discord, right? Or maybe they like have never interacted with a discourse forum, right? And all these different things that right now are very, very close to like folks that are pretty crypto native. And just opening up that process and that access, I think is going to be really interesting. I definitely don't have the answers, but it's really interesting to watch evolve.
So there's elements of technological as well as social gatekeeping that you raised there. Jack, did you have any views on what Kevin was raising there?
So I do have one. I don't know if it's directly relevant to what Kevin was talking about, but when we're talking about transparency and information asymmetry, obviously we all believe that we should default to transparency as much as possible. That's partially what DAOs are all about, but sometimes there's a requirement for information asymmetry as a result of the DAO's interaction with other traditional organizations or the regulatory landscape. Like as an example, perhaps like the DAO's product is being beta tested by a large enterprise organization, and that enterprise organization wants a little bit of discretion. They don't want there to be like a major fanfare or partnership announcements, etc. And there's a bit of a tension there where in a traditional B2B type relationship, it'd be quite easy to keep that under wraps. But if this traditional organization is collaborating with a massive permissionless community that anyone can join, how does that relationship, how is that discretion obtained? And so sometimes there is a requirement to have some level of information asymmetry. In progressively decentralized organizations, that tends to default to just the founding company or the foundation or whoever is starting and managing that relationship. But it gets a little bit more interesting when it's a DAO first, fair launch type organization. And I'd be curious, like how the rest of the panel feels about this as a topic, and what the solution is. How do we navigate that tension? Is it just that we have to delegate to these organizations? Like we have to delegate, like let's say an enterprise committee or a partnership committee or whoever, or is there something a little bit more compatible with the transparency vision that we can do? Yeah, that's something that I've been thinking about, and I'm curious how other people feel about that tension.
Yeah, I'd love to jump in on that. I think it's a good question. And I think often what a problem that can happen is these concepts become construed as monolithic ideas. Like transparency doesn't mean that every piece of information needs to be available to every single person at any time. I think certainly there is a need for private conversations in any group, you know, and it's very hard to find the line between what should be private or what should be public. And I don't think we should try and find that line. I think transparency is something we aspire to, and we try and make as much transparent as we can, and through systems and also just through personal behavior. But then there's going to be needs for private discussions, and particularly around things like you're saying, like new partnerships that you don't want to announce too soon, or regulatory discussions, or any number of things. So then the concern is, okay, it's going to create a new power elite, you know, that's going to be actually running things behind the scenes, and that's how most organizations work, actually. But it's not how they need to work. So just because you want to make a private group doesn't mean that it needs to be only one set of power brokers. For instance, in teal organizations, you can have groups that are, you know, there's one organization that is AES, is like a 30,000 person power company, and their board seats would be filled by the first people that showed up. So if the janitor showed up, they're on the board that day. You can have just basically special interest groups form around things based on whoever is interested. And if you trust your community, then you don't need to have any selection process for them. So that private group can be formed by whoever in the community is interested to do that, and they're entrusted to keep that information private. That's another way to think about it. But yes, I think delegating to groups of people in order to handle private information makes a ton of sense.
Yeah, that's
Yeah.
actually an interesting.
Oh, so go ahead, Yees.
What I find really interesting is that none of us have the answers, right? We're all winging it. We're all filling it out and experimenting in this new way of organizing ideas and people. What I see as really groundbreaking is that while we're figuring it out, there's this collaboration, not just like within the DAO, but DAO to DAO. And that is, for me personally, my biggest enlightenment, and that really warms my heart. Like, for example, in season 0, there was, like I said, like enjoyable chaos, right? Which is normal if you throw 7,000 people in a group. And so you need to set up structures, you need to find, you need to like fix stuff. And we don't know, we never have all the answers. But then there's like people from, for example, Kevin from Gitcoin came to talk about governance. There's Jack from Colony who's is going to share his ideas. There's like all these different DAOs and all these different organizations, or sometimes even LLCs as well, like actual corporations. And that's something that I've never ever experienced in my professional life, where usually like information and insights are being like kept as almost like IP within a corporation. And I feel in DAOs there's this almost organic vibe of sharing thoughts and sharing knowledge and sharing insights and experiences, and in essence just wanting to help each other succeed. And that is really a game changer, I think, in the way we're gonna figure it all out.
Yeah, I think you all raise really strong points on this, and Jack, thank you for taking that line exactly the direction that I was hoping, in terms of how not only do DAOs within themselves and how they handle information in terms of delegation and bottlenecking of islands or specific structures, but as well as how they handle the governance with external parties and business mergers, partnerships, or all this sort of stuff, high level clients. It sort of puts in a position of I think, what, chiming in on what Tracheopteryx said, is that traditional corporate organizations tend to run themselves that way anyway, or rather they run themselves where you've got powerful actors behind the scenes pulling strings and making things happen without much transparency anyway. I think part of this discussion and sort of what we're talking in Fair Launch in general, it highlights that, well, as a mimetic shift, how are we governing this, not just in DAOs, but in organizations as a whole? There's a sense of stability that needs to come from sort of due process, the right types of minds and actors handling the right types of information. You wouldn't want someone without a legal background having a legal discussion and so on. And there's no point putting a non-technical person in a dev lead role and so forth. But in terms of how we can learn from the experiments of DAOs and how they're evolving and now growing, do you think there are any reflections in terms of that we can either lend from the rest of society or lend to the rest of society? I feel like DAOs themselves are a sort of big melting pot for how we organize ourselves as people.
One of the things I'm quite excited about as a thing that DAOs can lend to society, and I think we in the DAO space we sometimes maybe forget to think about it like this, which is that what we're really talking about is giving the users of platforms control over the platforms. In traditional organizations, you have teams or experts on the company analyzing the preferences of the user and then incorporating those into new product features and whatnot. But what we're doing is completely flipping that on its head and making the users the ones who are in charge. So I think if you think about what DAOs can do for the rest of the world and for traditional organizations, I think that could be something quite compelling that traditional organizations could really be attracted to, is the idea of basically eliminating the middleman in terms of interpreting user preferences and allowing users to directly make changes based on their preferences.
I think that's a really good synopsis of the point in the space there, Jack. Yees or Tracheopteryx, did you have any points to chime in there? I see you've got yourself unmuted.
Yeah, I mean, it's what's happening over the past couple years with this revolutionary kind of change in organizational development is just really astounding to me. And really seeing these groups functioning like organisms, right? Like really trusting, without there being somebody always at the top making the decisions, with communities coming together to operate their own tools and own their own products through decision making and governance. I mean, I think it's the most powerful thing I've seen in my lifetime, and it's going to fundamentally change how work happens in the future, how all human endeavor and coordination is going to happen, and we're just at the beginning of it. Yeah, it's the most fascinating thing in the world, so can't do anything else.
Yeah, I couldn't agree more. That's a good that's the whole thing. I mean, like, for example, like in a previous life, I was involved in marketing in a big brand company, and we were basically trying to figure out what our customers wanted. But right now in a DAO, you are basically you are governed, or the user gets to choose what the product needs to do, and that feedback that marketeers are looking for is right there. You have the users governing and building the product, and that is totally changing the game. It will make products ship faster, and it will make products better. And I think it is yeah, it's amazing to see how it can also apply, because we're basically all living in this bubble of DeFi and NFTs and all of that. But I often see like situations in the real world where I think, geez, man, this could have been a DAO. This could have been so much better managed and governed by a DAO. Name anything, like an art club, a book club, even an hospital, like my local government. I mean, I can think of 1,000 examples in real life that could actually operate better as a DAO. But yeah, we're early stage, and I think our learning curve will serve for the rest of the world. And it's groundbreaking stuff that we're trying to build, and it's difficult, it's messy, but it's super exciting.
I agree. I think we're at an effective ground zero in the last, shall we say, 18 months, in terms of where DAOs have effectively taken over a space of organizational development that we haven't quite seen in a similar way in the past. I think between Olympus and Yearn and POCT Boardroom, you're all covering a very, very broad set of mimetic and intellectual spaces in terms of how you're approaching these problems of governance and collaborative organization at scale, especially with the world at the moment, and how a lot of people's lives have shifted online. I think it's particularly pertinent to sort of look at how these issues relate to decision-making processes in other organizations, as we've all sort of touched towards and looked at. And I think some of the ethical concerns that we've raised and how we govern in relation to, sensitive data and delegation and experimenting and evolving processes as they go is, I think, a really wise approach, and something that we really try to echo at Alchemist as a whole. And I'm sure you all know that, how our tagline of the only plan is there is no plan is intended to give us the freedom to actually experiment and reflect on what we're doing, rather than, I think, make the big promises that some specific directions or overarching ideological or ideal abstractions might try to apply to a situation. And I think it's really, really healthy to see in DAOs that the more that we let things evolve and trial things and, find what works and what doesn't, find the strengths and weaknesses in conversations as groups like we're having now, I think the more we can really hope to take away something that can not just make a lasting dent in terms of how we organize finance and various projects, but in terms of how we organize societal decision making and impacts we have there. I'm really attracted to the idea of seeing a world where pretty much every sort of ownership structure can be something that any person can participate in. And I think this is something we haven't fully uncovered yet in terms of how that'll work in terms of, smart contracts and various chains and architectures. It's difficult to sort of give everyone that fair launch opportunity over the course of history. And I think the legal government's panel made some really good cases in terms of how Bitcoin, being something that took so long to build that mimetic awareness in the space and tap it into people's mentality is something that could really form that direction. I think this is sort of what we've surfaced as a whole with the Fair Launch Summit so far, is that by participating in Fair Launch, as well as open and transparent governance processes and throughputs of decision making, we're left with a space where, as much as we might not necessarily have the additive answer, we're at least subtracting the things that we know don't work in this space. So DAOs and fair launches in this conjunctive sense provide the opportunity for a distributed community to come together in a way where executions that may have not been possible before are now made possible. Do you think that provides some synopsis to governance in the DAO space and how we've been looking at this so far, or is there anything anyone would like to add to that?
I would add one.
That's well said. It's well said. Go ahead.
Yeah. Oh, sorry. Just that how important these new structures are, right? It's not just about like regulatory compliance or activating a community or or decentralization for some theoretical importance. It's like the coordination mechanisms that have dominated on this planet for the series of them over the past few thousand years. They've reached their end of life. Like the top-down control structures and closed membrane companies, these gigantic mega corporations that are just extracting from the earth and then continue to produce crap plastic shit. It's not because people are evil that these things happen. It's because the structures that we have developed in order to create decisions in these large groups of people are limited, and they can't think in ways that we need them to anymore, and they're no longer functioning. So we have to, as a society, as a planet, create new methods, new minds, basically. What these DAOs are, new type of mind that is just orders of magnitude more capable than a traditional corporate mind, right? With this incredibly limited bandwidth of small executive committee and then thousands of people, and all these levels of direct reports. Like when you have a group of people that are forming together to make decisions in the way that we're all pioneering, that we're all figuring out right now, this is actually the only hope we have, of solving these problems. And you're seeing these totally revolutionary things happen already with, people working in multiple different networks at the same time. Like, what if 1/3 of Apple employees also worked at Microsoft? Like, you can't even imagine that in the world, but in DAOs and DeFi, you can imagine that. And you can see that there's no need to just grow like cancers. Like, where they're just, it's a new way of thinking. It's a new way of making decisions that hopefully will allow us to tackle some of these just massive systemic problems so that we can live a few more years on this planet.
I really like sorry to chime in, guys, but I really like a point you raised there in terms of sort of the multi-DAO individuals, in terms of being in a position to various extents, comment, participate, and hold interest in multiple different projects, not just have this, as you phrase it, sort of growing cancer of one project taking over the entire space, rather the integrative strength between projects accomplishing strength in different directions actually sort of reinforces the whole of what we're doing. I didn't want to dominate there, so did Yves, Kevin, Jack, any closing thoughts?
DAOs are just a mindset, and it's really hard to go back from that. Once you catch that type of mindset and you see the ways you can improve the world, not just DeFi and NFT space, but just the world on itself. I mean, there's so much potential out there. There's so much exploration to do. While these are kind of dark times on a sociological and ecological and all kinds of levels, basically, the world is not in the best place, let's say. And then still to have this kind of framework to chew on and to make the world a better place, that's pretty cool.
Well, we're just about at the end of our time here, guys. If there's no closing remarks, we might call it there. Thanks so so much for coming to this, guys. It's been a blast to discuss all these ideas with you.
Thank you.
Thanks.
Thanks, everyone. And really epic conference. I took notes for 5-6 hours. It was amazing. Every single panel, all the people that came up, it was like so much giga brain stuff, so much good ideas, so much good vibes. So well done, guys. Incredible conference, really. Thanks.
Thanks, everyone.
Awesome. Thanks, guys. Well, I'm going to hand back over to Daniel. Daniel.
Awesome. Thanks a lot, guys. Another great panel. So yeah, that's all about time we have. That's all about what we have time for today. Before we wrap up, I'd just like to thank everyone who came to watch the summit, especially those that submitted questions and asked questions throughout the panels and the presentations. Special thanks to Alchemist, to Sushi and Yearn for putting the event together, and to all the participants that took the time to join and to share their insights. So we put this summit together really to try and understand the biggest issues and hurdles in the fair launch space, and to try and develop best practices for the scaling, governance, and the operations of decentralized projects. As you know, we are still very early in this industry, and we're essentially forging new trails into the unknown. Therefore, learning from each other provides immense value in ensuring that projects aren't making the same mistakes and we're not having to learn the same hard lessons. The great thing about crypto and decentralized projects is the openness. There's generally a lot of space to contribute across a wide scope of disciplines. And as has been echoed across all of the panels today, there are still a lot of problems that need to be solved and optimizations that need to be made. So it's essential that we bring in all the people we can into this space so we can keep building and iterating at such an amazing pace. So I encourage everyone to come and join and interact with our communities. Discord's generally a great place for this, and I'll leave some relevant links down in the description of this video after it ends. You can watch a replay of this summit on YouTube after it's concluded. So I encourage everyone to share it around, especially with any people or projects that are considering a fair launch or who are in the process of scaling a decentralized company. So yeah, thanks again, guys, and have a great day. See you later.